invest for, as I do, then the more important fundamentals are. But I still look at charts, even so, though I go mainly on fundamentals.
That's right.
And the other Simon, if I can just say, the other big thing is, the other third prong to this is your gut feeling. Don't underestimate your gut feeling. Whatever the charts say, whatever the fundamentals change, sometimes your gut feeling is important.
Gut feeling. Well, nature versus nurture. Are you born a good trader? I've just started to read the story of the turtle traders from the early 80s.
And what I always say is, if it works for you, go with it.
Well, we are all different, of course, and this is
indeed, we are all different. Some people are good at some things. I mean, if you're good at spotting how the price of gold is going to move, well, buy and sell gold. I'm certainly not going to stop you. It's not for me, but if it works for you, then go with it.
Fantastic.
That's what makes money.
Just in case, there's a very small risk that somebody here hasn't heard of you, Rodney. So by way of an introduction, of course, we've known each other for many, many years. I know that you've written a great selection of books that have helped novice investors through to sort of intermediate level investors understand the markets in particularly in share investing in smaller companies. Is that fair to say that's your...
That is fair to say. I do talk mainly about investing on the London stock market, and my talk will be aimed more at that. The general principles apply to any respectable stock market anywhere, and of course I do look at economic issues and political issues, but in terms of how they affect stock market investing, I do tend to write mainly for less sophisticated investors, but I hope that there's a lot of what I say applies however good and however experienced you are at investing. So, yes, I'd like to feel that there's an awful lot of people out there. I used to work on the Daily Mail City desk, and I was business news editor for the Times back in the 80s, and I found a lot of people rang up, and they simply didn't understand they'd got shares through privatizations and building societies turned to banks, this sort of thing, and they simply did not understand what it was they'd got. And so I felt that there was a great need to write and help people who can make money out of investing if only they've got confidence and knowledge how to do it.
Absolutely, absolutely. Well, I know that you're in demand. You said you were on Share Radio again the other day as well. So
yes, it's a fairly new radio station. It's been nearly 2 years now, and I think it is growing. It's gone nationwide now, and you can get it on your digital radio. If you reach in your digital radio, Share Radio should come up, or you can get it through the internet. I do speak on there quite a bit, and I usually do a tweet before I go on, so any of my Twitter followers can listen if they so wish, or switch it off if they so wish. You have been warned. So yes, Share Radio I think is very important, and I do go on there. I shall be on there on Monday, next Monday at 5 p.m. doing the wrap-up of the market for the day.
What is your Twitter handle?
It's at Rodney Hobson.
At
least that's not too hard. That's not too hard to forget.
There we are. I'm just going to send that through the message box to everybody, so they can start to follow you as well, because that would be great.
Yes, indeed. And if anybody wants to pursue any matters, my email address is rodhobson, all one word, rodhobson@hotmail.com. And I am very happy to help anybody, answer any quiz as far as I can, as long as you all understand I can't give individual personal financial advice.
That's right, and that goes for us all on these events. Pretty standard disclaimer. Well, Rodney, we're just past 11 o'clock. I can see people they're still coming into the room, but for those that have been here and ready to go, can we maybe begin the presentation? As I say, I've got your slides, so everybody's looking at the moment at the title slide. So if you just let me know when you'd like to turn the slide.
Okay, well, if we'll move on to the next slide now. The thing is that I always say is that from time to time, however experienced or inexperienced you are, you should sit back and look at your investments and decide where do you want to go from here. investment needs changes. Investment needs change, and all of us from time to time wander off our objectives, and I sometimes sit back and look at what I've bought, and sometimes I've bought shares because I thought, oh, that's a good buy, I'm going for it now before the share price moves. I don't stop and think, does it fit my strategy? So it's always good from time to time to go back and think, where am I up to? What am I doing? After all, it's your whole financial future ahead of you. And if Brexit, the Brexit vote, I should say, it's a vote and we're not out yet, but if the Brexit vote isn't a good excuse for going back and thinking about where we stand, then I don't know what is. Theresa May has said famously that Brexit means Brexit, and while everybody's saying, what does Brexit actually mean? What does that mean? I think we must now work on the principle that we are going to leave the European Union. Before the vote, I thought that even if there was a tiny vote in favour of leaving, which I even thought that was unlikely, I thought we would vote to remain, but I thought that even as a vote to leave, it would be so small a majority that Parliament would block it. I think that the majority of 4 points was enough to sway that. I think that Parliament is unlikely to try to block this, and on that assumption, as Theresa May indicated this week, our likely departure date is March 2019. She will almost certainly, within a month of that, possibly slightly earlier, she will invoke Article 50, which takes us out, starts to take us out. I think to delay it any longer is really going to look like government dithering. There is just the possibility that Parliament will try to block this, in which case our departure will be delayed but not stopped. It will be postponed, not cancelled. Because if Parliament blocks this, Theresa May will go to the country, she will hold a general election, the Conservatives will be returned with a much bigger majority and with a mandate to actually bring us out, and I don't think even then the House of Lords won't be able to stand in the way of that. The Conservatives, in my view, will keep all the votes they got last time, and they'll pick up 2 million UKIP voters who were still doing the protest. If you were voting UKIP to come out, then there really is no point in not voting Conservative next time in a snap election, because that's the way you are going to get out. So, as far as I'm concerned, Theresa May is right to say Brexit is Brexit. We don't know the terms yet, but we are most certainly going to come out, whether you like it or not. So let's work on that basis. And on the next slide, as I say, this will be painful. And there is some danger that this will hit economic growth not only across Europe but elsewhere because of all the uncertainty that's caused. Let me just say that there's an old saying that markets hate uncertainty. I think that's absolute rubbish. Markets love uncertainty because it creates buying opportunities. And we've seen since the referendum that share prices can fall very heavily. And if you hold your nerve and you go in on the dips, you've been very well rewarded. And as we noted this week, the FTSE 100 and the FTSE 250 indexes have both hit new highs, or the FTSE, I think, just slightly short of its all-time high. The 250 actually did set a new high. So there have been good buying opportunities there in the meantime, even since the vote, and there will be more. One of the problems is that it was argued before the vote that Europe won't cut up its nose to spite its face. Do you think Germany will stick out for a hard Brexit if it hits its motor manufacturers? Well, people and politicians do actually do stupid things. I don't think we can assume that Europe will sensibly go for an arrangement with us that suits Europe. So I think the Brussels elite, who are keen to keep the project going, may very well spite the voters in Europe because they're not elected. So certainly there will be uncertainty over the next 2 years and things may start to pan out. One thing I would mention is that the scare stories, project fear that it was all going to fall apart if we voted to leave. Well, yes, it's possible it will all fall apart. The IMF, I noticed, is the latest to reduce its growth forecasts for the UK for next year, and also Europe's not much better either. So yes, there may be more pain, but I think that one of the reasons why I'm sure that Theresa May would win a snap election if she's forced to call one is that we all thought that things would fall apart very quickly. We're now 3 months beyond the referendum, and it hasn't fallen apart yet. So the message so far is work on reality. You have to work on the basis of what is most likely to happen. There will probably be some pain, but there are great investment opportunities. Now, if we move on to the next slide on safe havens, one thing that experts have been trying to encourage people to say is that we need a safe haven. If the economy is going to be in difficulty, it makes a safe haven more attractive. I have to say that in my view, safe havens can very much be an illusion. The idea that gold, which gives you no income, which actually costs you money to store, which the price of which can fall as well as rise, to me that's not a safe haven. I think that this is a complete misnomer. And the thing with gilt-edged securities, the idea that gilt, putting your money into the government, is a safe haven, I think that is an illusion as well. And even company bonds, to my mind, are not as good as buying the shares. So do be very skeptical when people start talking about a safe haven. Things are not always as they appear. Let's look on the next slide at government bonds. Now, it's true that if the government fails, we're all up the creek. So it's reasonable to assume the government isn't going to fail. Governments can default on their bonds. Argentina did so spectacularly about 10 years ago. Greece has had a partial default already, and if it stops being propped up by the ECB and the IMF, Greece is going to default again. So governments can go bust, so it's not entirely a safe haven. We like to assume that the UK and the US in particular are safe havens. However, the fact that some countries are in financial difficulty has driven more and more investors who want treasury bonds to buy those bonds in countries such as the UK and the US, where there seems to be less risk of default. The outcome has been to drive down bond yields, drive up the price of the bonds, and the yield come down. And the latest gilts issue early this month was actually at a negative real return of 1.77% a year over 36 years. Now, who on earth wants to lend money to anybody when they know that it's going to fall in real value? This, to me, is certainly not a safe haven. To me, this is not a sensible investment. You can, if you want, for some security, because at least you know what sort of interest rate you're going to get, you can, for some sort of security, buy gilts in your portfolio as long as you don't overload it. Now, pension funds are forced into buying gilts by the rules, and several other funds do likewise. Insurance funds do likewise. It's supposed to be because it's a safe haven, but it is nothing of the sort. And in fact, we have seen the massive pensions deficits, which I'll come to for a moment. These deficits are built up simply because money has been invested in gilts rather than into shares. And if you think that gilt yields might improve soon, I'm afraid this latest issue was 3 times subscribed, and now a great deal of the government debt, I don't think anybody's worked out the exact proportion, but a lot of government debt now pays a negative return. And we're not alone. Other developed countries, there's estimated to be about 1/3 of developed country debt is actually paying a negative return. This puts no restraint on governments who are now merrily borrowing money like there's no tomorrow. But the most important thing about this is actually worse than a savings account. Now, I actually scorn people who put money into savings accounts which pay very poor rates of interest, but at least they actually pay. Even if it's 0.1%, they actually do pay interest rate. You do get a positive interest rate. Your value of your money goes down, but you get an interest rate. Whereas with government bonds, you're certain to be worse off. I think that is quite frightening. In looking at this, one interesting point is how will rates move? We know that the Bank of England Governor Mark Carney, on the next slide, how interest rates will move. Carney has threatened another bank rate cut this year. I think that is now very unlikely. He was working on the basis that the economy would suffer much more than it has. The one casualty, as we know, of the Brexit vote was the pound, which has sunk very considerably, but most parts of the economy, particularly manufacturing, is doing better than we expected. So there probably won't be another bank rate cut this year. I think it will be some time before we get an interest rate rise, although we will almost certainly be getting one in the United States, probably after the presidential election next month. But someday interest rates are going to rise. Now, I've said for a long time that we should be prepared for a rise in interest rates, and that anybody who's loaded down with debt wants to start cutting that debt as soon as possible. George Osborne seemed to take rather the same view, not much I agree with him on, but that certainly. If you keep saying it long enough, it is going to be true someday. The point is that when government debt starts to get more expensive for the government, that is, they have to pay higher rates of interest, gilt prices will go down. So holding gilts will actually turn out worse. You'll actually not only getting a lousy rate of interest, you're actually going to see the value of the gilts fall when that happens, and it will do someday. To me, gilts look increasingly like a short-term investment, and not a very good one at that. On the next slide, talk about company bonds. These do offer a higher yield than gilts, and they are generally safe. The thing about bonds is that you are, unless the company goes bust, you are actually guaranteed you get your fixed rate of interest. So that's why they are regarded as safer. Nonetheless, that rate of interest is fixed. Bonds take precedence over shareholders, but shareholders can always hope that if the company is doing well, and why would you invest in a company that wasn't doing well, whether it's the bonds or the shares? If the company is doing well, then the shareholders share out the rewards of that improvement. The bondholders are stuck with what they've got. And if the company goes bust, then the bondholders lose out just as well as the shares. So to me, this is not all that much safer than buying shares, and in some ways shares are actually safer. As with gilts, if interest rates start to rise, then the value of any bonds you already hold are going to fall. Now, as with gilts, there's no harm in putting these into a long-term portfolio as long as you don't overload it. It can be a hedge against falls in share prices, but see it as a hedge rather than the basis of your investment portfolio. And the third haven, gold, on the next slide. As we have seen, gold can be a very good hedge against economies going sour. And a lot of people think you should have a small holding in gold. I think that 5% is quite sufficient. I don't hold gold myself, but I can see the argument for holding it. And I can certainly see the argument for holding gold post-Brexit, because if the wheels do come off, if in the UK and Europe there's a trade war which will have repercussions around the world, then gold is likely to rise in price. Certainly, gold has been a bad investment for the past 5 years since it reached top side of 1900 US dollars. But it could come into its own again. I would just stress this last point on this slide. Gold, for me, is a hedge, not a safe haven. It is a hedge against economies doing badly. There's one other thing about gold for those of you who live and work in the UK and have all your money mainly in pounds. If you go into the next slide, I'm sorry this is a rather dull slide. It's not a very sharp one, but it's the only one I could find, courtesy of Bullion by Post website. The gold price in sterling, you will see that that's not the same as the gold price in dollars. And you will note that at the end of June, when the pound fell, the price of gold in sterling terms actually shot up quite heavily. And it's interesting to note that gold has been top side of £1,000. Not so long ago, I thought that gold might drop below $1,000. So it's one of the points about gold. It is a hedge against the pound falling. If you believe the pound is going to fall further, then you're obviously better holding gold than you are pounds. If, on the other hand, you feel that we will come through the Brexit crisis rather better than expected and the pound will eventually recover, then the opposite, of course, applies, that you may find as the pound recovers that the gold does worse in sterling terms than it does in dollar terms. It is part of the risk. So, on the next slide, we'll turn to equities, which is the investment that I favor. I was speaking just before the webinar started, but those who didn't hear it, I am basically an investor in shares listed on the London stock market. It's what I look at most. So if you feel I'm biased, you're entitled to your view. But in terms of equities, it is the one investment apart from property that offers you the scope for capital gains and income. And if you invest in companies that are improving and growing their dividends, then you have the means of offsetting inflation. That is why, to me, if you're thinking of investing for the long term, you're willing to ride out the storms, equities has to be the best. Now, I also mentioned just before we started talking that I look at the fundamentals of a company. The longer term your investments are, the more important the fundamentals are, because charts can go up and down quite wildly, but you can trade your way through it. You just hold on, and it should come right in the end if the company is solid. Now, if you are thinking in terms of short-term investing and the shorter term, the more important the charts are, because yes, charts will move, shares will fall even in strong companies, and shares will rise even in poor companies over the short term, and the charts then become very much more important. But for me, at the moment, if you're investing in equities, look for the dips in the market, and there has certainly been plenty of those. And one of the things that we tend to feel, particularly for a nervous investor, is when you see erratic movements on the indices, you tend to think the market is falling. This very often is not the case. For long periods of time, the stock market tends to move sideways, and certainly the FTSE 100 and the 250. Within those indices, certain sectors may swing quite wildly, but the indices on the whole move sideways until they lurch either upwards or downwards to a new band. So don't panic if shares fall. It's a buying opportunity. Now, if we look at the next slide, some sample yields, can I stress, as I do on the slide, that this is not a recommendation to buy any of these shares. I have taken the prices as they stood on Friday night's closes. That was the month end, September the 30th. There have been share movements in the meantime. On the whole, shares have gone up heavily this week. Remember that if the share price has gone up, the yield will have fallen. If the share price has gone down, then the yield will have risen. So these figures, the figures for the yield, are changing all the time. Bear in mind also that I've taken the dividend payment for the last financial year. I've translated dividends that are paid in dollars at $1.50. So another factor in considering yields is that at $1.30, those dividends actually shoot up in value in terms of pounds. Another of the advantage of having a wide portfolio that does have some foreign interest in it. But you can see here that there are yields of big solid companies. I've picked well-known companies all in different sectors. They're all paying decent yields. I generally reckon something like 3.5%. That is, for every £100 you invest in a company, you'd expect to get back £3.5 per year in dividends. And you can see here that there are solid companies which are paying dividends higher than that. This is also, as anyone will know, a damn sight better than anything you're going to get out of the bank savings account. And it's a good deal better, as I mentioned earlier, than you're going to get out of gilts. It's probably nearly as good as you'll get out of government bonds, and it's certainly a lot better than you'll get out of gold, which doesn't pay any dividend at all. However, no talk of this nature would not be right without the dangers, and on the next slide I mention one or two of the dangers, and the first one is the pensions a black hole which we may be walking into, and there has been quite a bit in the newspapers of late about this. Fears are headlines such as dividends set to disappear into a pensions black hole, pensions fund deficits loom for 23 years. I've seen those headlines. Yes, it is an issue. The pension fund deficits apply only to pensions where you have defined benefits, i.e. where you get a certain percentage of your final salary. Most companies now have moved over into defined benefit schemes where your benefits are based on the amount of money you and the company has put in, and if things are going badly in the investment world, then you don't get as much back. But the defined benefit scheme is the one that is the problem, that's got the black hole. Sorry, I think I made a mistake a moment ago. Most companies now moved onto a defined contribution scheme. Let's make this clear. The contributions are what set the pension. The defined benefits are the problematic ones, which are being phased out. And I did think the pension black holes would gradually disappear as fewer and fewer people are in them and the old pensioners die off. It hasn't gone away yet, and one of the problems is the pension funds have been forced by the government to invest their money in this supposed safe haven of gilts, which certainly suits the government because it means the government can borrow cheaply, but it does mean that this black hole has arisen, and part of it is an accounting fix. If interest rates start to rise, then the black hole will start to be cut artificially. So don't take the figures too seriously, but yes, it is a problem. If companies are forced to put more money into their pension funds, they have less money to pay out in dividends. Brexit, we've already mentioned. Clearly, the uncertainties that derive from Brexit could affect share prices, and there is an uncertain global outlook. And I note that the IMF is warning that the result of Brexit will be to reduce growth generally next year. The IMF has reduced its growth figures for UK, Germany, Italy, Japan. US is expected to do better next year. The economy is growing there. I would just say that I don't take IMF forecasts too seriously, nor do I take their policies too seriously. They have no better record at forecasting the future than I have. Nobody really knows what is going to happen next year. It's hard enough to forecast what will happen tomorrow, let alone the next 3 months, and let alone the next year. And if forecasts tend to be wrong, and the IMF has certainly been proved wrong, Nonetheless, it's right to bear in mind the possibility of an economic downturn. On the next slide, more dangers. The UK government debt is now 1.6 trillion, and it's trebled in the past 9 years. Even during austerities, nearly doubled. So much for austerity, and it now looks as if George Osborne's target of balancing the budget by 2020, which will be used with great political effect to destroy at balls, is now going to be scrapped. At the Conservative Party conference, we did think we might get more as indications on policies, specific policies, that we really haven't got, so we're not no wiser. The next clear steer of what we're going to get from the government is next month when we get the autumn statement, and I think that the new Chancellor Hammond will unveil something more specific by then. So we are working a bit in the dark, but I think it is likely that government spending will go up, and that squeeze on government spending in certain sections will be eased. We're not alone in this. The US government's debt is too frightening to mention, and global debt is clearly, many people believe, unsustainable. I've seen a figure somewhere of, what is it, $150 trillion worth of debt. That's more than 100 million pounds worth of debt held by governments around the world. And if anybody starts calling that in, it's going to be serious. So we may see some government defaults. It's part of the dangers. But we have to work on the basis of what is likely to happen, where is the safest place to put money, and to me, that remains equities. Now, I just mentioned on the next slide the US presidential election, because that has been quite close. This week, Hillary Clinton seems to be moving further ahead in the polls after it was looking very tight, partly because she did so well in the first debate, or should I say Trump did so badly in the first presidential debate. There are two more debates. There was a vice president debate which Trump's man is judged to have won. I don't think that's too serious in terms of voting intentions, but Trump has a great habit of bouncing back. He really could win. Either way, it's likely that both presidents are going to find, as all presidents do in the US, that they have to win over Congress. This is going to be a much more difficult task for Hillary Clinton. It is likely that at least the House of Representatives and probably also the Senate will be in Republican hands. So she's going to be in the same position that Obama is. You may think that's a good thing. Since both the candidates are in favor of increasing the US deficit one way or another, either by more spending or by tax cuts, then any restraint on the president may actually be a good thing economically. If Trump is elected, he will almost certainly have both houses of Congress in Republican hands, and it is possible then that he will be able to embark on his policies. I think that if that is so, I'm not too worried on shares for the short term. Certainly not over the next 2 years, because I think what will happen, he will get the US economy moving. There will be a bill to pay, which I would expect to start biting in 2 years' time. Congress will put some restraint on this, but yes, it is possible that the US deficit will rise. But I think from the point of view of the economy and from shareholders, the next 2 years, which is probably quite far enough to look ahead, is likely to see more improvement in the US economy, and, as I say, possibly the bill to pay later, but we'll worry about that later. On the next slide, let's come back to the UK, and the UK economy is holding up. It is still early days, one has to say. The great collapse has not happened post the Brexit referendum, and I am working on the basis that what is happening now is quite good. Manufacturing is holding up remarkably well, mainly because of the strength of the pound. I think that manufacturing will suffer. We still have high wage rates. And seeing your currency devalue is not a panacea for anything. I know a lot of people say the pound's more competitive and so forth. Bear in mind that oil is priced in dollars, so the price of oil is going to go up, and if transport costs go up, that adds to the costs of the whole economy. It also means that raw materials coming in from abroad are going to be more expensive because of the fall of the pound. So manufacturing may continue to struggle. The important thing is that the services industry had a big bounce in September. Again, this may be linked to the value of the pound. It means that tourists coming in using hotels and restaurants and other services in this country, it's been much cheaper for them, so they've been more willing to come here and spend money, and conversely, we've been less willing to go abroad and spend our money there. So the UK economy, this may be slightly artificial. It has certainly had a boost from the pound, which if the pound recovers, or as if things even out, we may find that things shrink. However, against expectations, the second quarter showed growth of 0.7%, higher than the first quarter. Only 1 week of that quarter came after the vote, and it's possible that the economy kept moving because everybody assumed, as I must admit I did, that we would vote to stay in. So that may be artificial. Certainly, the forecasts for the third quarter suggest that the growth will be only 0.4%. Nonetheless, with the services sector, which is about 3/4 or more of the economy now, with the services sector doing so well in September, we may start revising that upwards. And certainly if manufacturing holds up, we may find that 0.4% is underestimating. Economists certainly underestimated the growth in the second quarter. Everybody forecasts that the UK economy will slow during 2017. Bear in mind that when everybody agrees, it's usually wrong. So we really don't know. You really can't forecast ahead of 2017, and you have to invest now in what is likely to happen. And certainly if the economy continues to grow even at 1.7% next year, which is what 1.1% next year, which is what the IMF is forecasting, and that's probably in line with other forecasts. Even at 1% growth, it's still growth. It may be less growth than we would have had staying in the European Union, but that's a matter of conjecture. But as long as the economy keeps growing, then there is scope to do well in equities. Let's just look on the next slide of the FTSE 100. This is over the past 6 months. We can see the big drop that was at the end of June after the Brexit vote. Incidentally, it's notable that in May, when we had wobbles on the FTSE, the index actually dropped more than it did over a slightly longer period. Certainly it was short and sharp, the big drop at the end of June, but May was a drop. There was clearly a good buying opportunity in May, and there was a good buying opportunity at the end of June. And you note here also, between April, the start of this, through to the start of July, the index, although it had one or two violent moves, ended up pretty much where it had started. So over that period, it follows what I mean, that the index moves sideways. And certainly since the middle of August, again, the index has moved broadly sideways, despite some lurches either way. The FTSE 100 is thought to be the index that will hold up best because the biggest companies have the more international exposure. We are already seeing that companies with earnings abroad are translating those earnings into higher pounds because of the change in the exchange rate. But on the next slide, if we look at the 250, in fact, the 250, which suffered more in the post-referendum fall, has actually not only recovered it, but has actually hit new heights. This is the 6 months to September the 30th, and Monday and Tuesday this week that index moved higher and actually set a new record. The 250 companies are mainly, but not exclusively, UK companies, much more dependent on the UK economy, and there has been a great feeling that they're going to come through. So not all doom and gloom. However, one does have to bear in mind that while these two indices are at such high levels, it's no longer cheap to get into UK shares. And there may be some argument for saying to hold back and hope that they fall back further. I'm holding off at the moment. I think that the market is now looking fully valued. One last slide, the UK dividends. I think this is the important thing, and I've kept this record of Capital Registrars, which is very good at these estimates, and the 2016 estimate is pretty good. We note here that although since 2012, total dividends paid out have stabilized somewhere around about just top side of £18 billion. That's an awful lot of money. It is £1,000 for every man, woman and child in this country. So if you didn't get £1,000 in dividends for each member of your household, you were missing out. And this is the great thing about the UK. There are fears that UK dividends will be reduced. Let me just add that this is the basic dividends in this table. Special one-off dividends I'm not included because it does distort the picture. In particular, for example, Vodafone made a big payout 2 or 3 years ago. That's not included in here. But there is always the possibility that you get special dividends coming through. The thing to watch for when you're investing is not just the dividend and the dividend policy of the company, it is also how well the dividends are covered. And it is true that some dividends have been held up well because companies have been reducing the cover. If the cover falls below 1, it means that earnings are not covering the full dividend. And I much prefer to look for companies where the dividend cover is 2. In other words, they're in half the profits come back in dividends and half is reinvested in the business. It's not a hard and fast rule, and the figure can wobble. But if it starts getting down to 1, it is a worry, and if it falls below 1, then it's certainly a matter of concern. So when you're looking at dividends, I would stress, do look at how well the dividend is covered. But that is the great thing about equities, and why all of my investment will be equities, and why I think that everybody should have most of their investment in equities, because you get the chance of the dividend increasing over the years, and you get the chance of the share price increasing, a two-way gain. So there we are. That is the end of the slide. If anybody who are new to investing are interested in the books, then the final slide does list 4 of them. The books are there. I'll be very happy if you buy them. And if ever you're near Blackheath in London, pop round and see me and I'll sign it for you. But Simon, I think is probably it.
Fantastic. Rodney, that's great. Can you hear me okay?
Yeah, fine. Yeah.
Great. Just 1 or 2 questions before you go, if we can. Now, Stuart, 2 parts to his question, really. In the first, he says, the economic data of the US is not thoroughly convincing. Why do you hold the view that the US is on the path of recovery? He thinks the data coming out spells of more volatility and not certainty.
Right, yes, good point, Stuart. Yes, certainly figures coming out of the US are patchy, and you seem to get 1 month good and 1 month not. And yes, certainly that's reflected in the newspapers, because sometimes people saying, oh, Janet Yellen will be forced to raise interest next month after this strong data, and then you read, oh, they'll be put off. Yes, it is patchy, you're absolutely right, and there is always uncertainty. In my view, on the whole, the US economy is growing, and on the whole, most figures are positive rather than negative, and that's the basis that I'm going on. I certainly wasn't convinced that the US economy was strong enough to stand an interest rate rise at this stage. Certainly not before the election. It's possible we'll get one in November or December, and I think it'll be a very small rise. Certainly the interest rate rise in the US, I think, will be slow and wide apart. But the data to me, on the whole, is for a strengthening of the US economy. But Stuart, you're absolutely right. It's not utterly clear. Well, as I said earlier, one has to work on the basis of what is most likely while sort of hedging your bets against the fact you might be wrong.
Okay, well, that might partly answer the second part of his question as well, because he goes on to say that there's no evidence of growth, not just China and India doesn't pack a punch, he says. Where is the growth coming from?
Yes, China is still growing. Now, admittedly, the Chinese economy is not growing anything like as fast as before, but the Chinese economy is growing, and it's a very big economy. Even slower growth does help the global economy. India, I have been disappointed with. I thought India might well take up the slack, and now and then India looks as if it's going to do so. But yes, it's disappointing. India, or the other country that's got more than 1 billion residents, if that got going, would certainly help. Yes, growth, it may not be as strong as we would like, but Germany, I think, is going to continue growing. I see no sign really of that turning down, and it's still the powerhouse of Europe. France, I think we were seeing some growth. We did fear that France would go into recession. France was seeing government growth, not a lot. I think Canada will do well. I mean, I stick to my view that the US will grow. I note that the IMF, although I scorned their figures earlier, so perhaps I shouldn't quote them, US, they think, will grow 2.2% next year. I think the US will probably grow faster next year than this year, unless Brexit does cause some real shockwaves, and I think it will help to drag Canada up with it as well. And again, I have to agree with the IMF on this. I think Canada will grow possibly best part of 2% next year. Italy, sluggish growth, but there is some growth there. And even in Japan, where the various measures have been taken to get this economy moving without any great degree of success, but there is still some growth. I think we're going to possibly have to get used to much more modest growth, but it is growth nonetheless, and I'm a pot half full man. Yes, growth may not be as good as a boom years, but growth is still growth.
Growth is still growth. Ripple is asking about gilts.
Yeah.
He said, if gilts are providing negative returns, why are they still seen as a safe haven?
Well, yes, quite. Couldn't put it better myself. As far as I'm concerned, they're not a safe haven. They're a safe haven in the sense that we're assuming that the government won't collapse, and that the UK government won't default. I mean, clearly buying treasury bonds in any country that might default is certainly not a safe haven. But in the UK, we are assuming the government will not default. So you are sure of getting something back, and I think that's one reason why people cling to them. But to me, it's not a safe haven. Gilt prices will fall heavily if interest rates go up. To me, any investment that involves losing money in real terms, which is how we stand with much of the gilt portfolio now, it's not a safe haven. So, I mean, I agree. One of the things if everybody keeps saying it, it must be true, and people start believing it. So whenever time the press refer to gilts or gold as a safe haven, I cringe, because it puts around this idea. They can be a good investment, but they're not a safe haven. You can't just invest in it and think that nothing can possibly go wrong. It certainly can. So I don't like the term safe haven, and I scorn the fact. So if you're skeptical about gilts being a safe haven, you're quite right as far as I'm concerned.
Another question here about Canada. Why don't you believe Canada is at risk of going into recession? given how weak the economy is fundamentally, is it just being propped up by the oil price?
Well, the oil price. Mm, Canada is not I'll have to admit, Canada is not a country I've studied particularly. It does have a lot of natural resources, and that does help. Canada has its ups and downs like the rest of us. I think that the Canadian economy, it has been growing. This year it's going to be growing somewhere just over 1%, which isn't great, but like I say, growth is growth. I think that if the US does well, then it does tend to help Canada, and a lot does depend on exchange rates. When the Canadian dollar is weaker against the US dollar, makes their goods and services more cheaper. So I think that Canada's got great resilience and does come back, but I can't guarantee it. Certainly, if you're doubtful about Canada holding up, you're certainly entitled to your views.
Indeed. Fantastic. Rodney, you've talked for 50 minutes. If anybody else has a last question, type it in now. Oh, there we are. Stuart's come back saying that he agrees that there is growth, but it's slower. Lower growth, and yet equity indices are near all-time highs. This combination spells high risk. Aren't assets inflated by quantitative easing all around the world?
Well, assets certainly have been inflated by quantitative easing, and now Mike Carney has embarked on another dose of it, then maybe that's an argument for holding assets. But yes, Stuart, you're quite right to raise this point. I mean, there's no absolute in this, otherwise we'd all be piling into whatever it is we were absolutely sure of. Certainly the fact that the stock market is at all-time high, and it's not just here because shares are heavily up in America as well, yes, it increases the risk. It means that shares are not as cheap as they used to be, and it is a consideration. And one of the things with stock market investing is people tend to pile in when shares are high because they think the rise will continue, just as they did with gold. And of course, this is entirely the wrong idea. My inclination at the moment is to hold back because I think shares will fall back and there will be better buying opportunities soon. But yes, it's a risk, and you're absolutely right. As long as you are conscious of the risk and take sensible decisions based on the risk as well as the potential reward, then you're going to be a great investor.
Indeed. Now, Rodney, I know you're not a technical trader, but Russell has asked a question towards the beginning of your presentation on stop losses. Do you use any stop losses, or do you have any opinion on?
Yeah, I do have an opinion. I don't use stop losses because I'm a long-term investor, but stop losses are like charts. The shorter term you're investing, the more important a stop loss is. If you're a day trader, you buy in the morning and sell in just before the market closes, then stop losses are clearly vital. If the shares drop, you've got only a few hours to make it up. Now, if you're investing for over 2 years or more and the shares fall back, you've got 2 years to make up that loss. So the longer term you are, the less important it is. But certainly, if you're a short-term investor, then I think stop losses are vital. Certainly, you don't have time to make up the loss. The problem with stop losses, firstly, is that where do you set it? Do you set it at 5% or 10%? Again, the shorter term that you're investing, then the lower the percentage loss you should be prepared to stand. So it's very difficult. You're setting always an arbitrary level. You're setting an artificial level. Now, if you're working on charts, the chart may throw up a level at which it's right to set the stop loss. If you're not working on charts, if you're working on fundamentals, then there's no such signal, and it becomes very difficult then to set any kind of figure. the one thing that you should bear in mind with the stop loss is if the shares fall and you operate the stop loss, then the one thing you've guaranteed yourself is that you've lost money. And that is one of the criticisms of it. But that's the general principle. If you're short-term trading, then I think you've got to run stop losses. If you're long-term, then don't set a specific figure, but look at the shares. If the shares fall heavily, look at it and say, did I get this wrong? And if so, if I've missed something and I now see it, I should get out. But the other side of the coin is, if the shares have fallen and you look at it and you genuinely believe that you are right, then this is an opportunity to buy in at a lower level. The important thing is, if you got it wrong and made a mistake, don't try to kid yourself. Admit you got it wrong and get out.
Wise words. What about fundamentals? You're more of company's fundamentals man. Ripple's asking, what would you consider to be the most important ratio?
Yield, I think, is important. Yield linked with dividend cover. Because in the end, if you are investing, you're investing to get dividends. So what dividend are you going to get? The yield, as I mentioned earlier, is you put £100 in, how many pounds do you get back per year? So that's important. It is important to look at how well the dividend is covered. The second ratio I look at is price earnings. The price earnings, unlike the yield, where you want, in many ways you want a higher yield, the price earnings, the higher the figure, the more a warning sign it is. I don't think it's as important as yield. Not to me it isn't. But it is an indication that the shares are either cheap or expensive. The higher the figure, and the more expensive the shares are. So don't just take the ratio on its own. Look also at reasons why. I mean, for example, if you've got a high yield, that may be on a historic basis, that may be based on the dividend paid last year. It's possible the shares are pricing that in because there's a fear the dividend will be cut. So you don't take these in isolation. But to me, particularly if you're a new investor, yield is the most important, and the price earnings ratio comes next. I don't look much at other ratios. I think you can get utterly bogged down in them. I know some people like to look at price earnings growth. I don't. I think that once you start getting so involved in things, you'll spend all your time working out the ratios and you'll never get around to investing.
Get caught up in
it's rather like a chap who I was in contact with on emails because he was an investor, and he found he never invested anything because he was forever checking all the ratios and the facts and so forth, and he found that he never actually, the figures had all changed by the time he got around to investing. And I said to him, you're overanalyzing. Sometime later, he came back to me to say he'd talked to his friends, and he said his friends all laugh at him when he goes up to the bar because he asks for where the brewery was, what's the specific gravity, what wheat's gone into it, and all this. And I said to him, why not just taste the beer and see if you like it, and if you don't like it, don't buy it again. Well, it's a bit the same with shares. You can overanalyze it, and yes, you have to be sensible about it, but don't get too bogged down in the figures. Investing should be fun.
Absolutely. I'm just following up on that, the PE ratio. Stuart has come back and he says he's assuming you're talking about a prospective PE, not a historic PE.
Yes. Well, this is another of the difficulties. Yes, on the whole, I think prospective PE is important. Probably more important to be prospective on the PE than it is on the yield. Yes, you're quite right. I think the PE has to be prospective because last year's figures are so out of date in many ways, and the PE can swing more year to year. The dividend tends to get flattened out a bit over time, so last year's dividend is not likely to be that much different from next year's dividend, but the PE is likely to be quite different. So yes, I would agree. It's the prospective PE. I know that's difficult with smaller companies where you don't have the wealth of analysts to give you a consensus, But yes, I agree. I think the prospective PE is more important than the historic.
Rodney, do you use any software programs yourself to
I don't. No.
filter all
I don't.
this?
No, I decide I go off my judgment. I mean, one of the things, yes, again, software programs are probably of greater advantage if you're a short-term trader because they can spot quirks in the charts and so forth that you wouldn't see for yourself. So shorter term, the software is more useful. Longer term, I don't see that the software does any good. I think it just makes money for the people who provide the software. Surely your own judgment, you can look at the figures yourself and make your own judgment. And I think that while one may look at charts, one may look at fundamentals, I said just before the program started that good feeling is also part of it, and you get a feel for a company that no computer program will ever get. Remember this, it's reckoned that computer trading now accounts for more than half of all trading, and something like 40% of trading is actually between two computers. So one computer is getting it wrong, and computers panic, and computers drive the share price down, which gives the human beings a chance to come in, and they drive shares too high, which gives you the chance to sell. Computers are not very good at the real thing, to my mind. I don't use a computer program. As always, if you've got a computer program and you find it helpful and you find it works for you, fine with it. But to me, investing should be about your personal judgment. Come on, stand up for yourself.
So where do you get your information from? Do you have a regular source of information that you prefer?
My main source of information is the London Stock Market, the London Stock Exchange's own website, which is easy to find. This used to be an appalling website about when I first started investing seriously in 2008 after the crash. It was a very poor website, very unfriendly. It's been revamped. It's a very good website. The most important thing is down the bottom left-hand corner of the homepage, you will see Stocks Search. There's a column of 5 items down that bottom left-hand corner, and the middle one is Stocks Search. You click on that, you can type in the name of any company, you can get the fundamentals on that company, you can get the statements that company has put out. I also look at the stock exchange to see. It shows you the top 5 movers on the FTSE and the top 5 gainers and top 5 losers that morning, so you can see how share prices are moving and see if there's something that sparked a rise or a fall. You can look at today's statements. You can call the company up and you can look back at its statements over the past 5 years. You can look at how profits have moved over 5 years. To me, this is the first tool you should use, is the London Stock Exchange's own website.
Fantastic. And just to qualify that, Stuart's also saying that digitalloop.com is also a good free source of information.
Well, yeah, fine. You can investigate, I think, does a stock market announcement as well. Reuters you can find. But for me, the great thing about the London Stock Exchange, assuming you're investing on the stock exchange, of course, it's no use if you're going abroad, but assuming you're buying stocks listed in London, to me, it's all there in one place, and you can see the market as a whole. It's a very good site.
Oh, that's good to hear. Fantastic. Well, Rodney, we're going to let you go because you've given us a full hour, and it's been very, very good of you to do that, and I appreciate it.
Entirely my pleasure. I enjoy talking.
Well, we've put the link in the chat box to the books at the Harriman House website. So if anybody would like to, well, in fact, there we are. Keith said he enjoyed already. Sorry, David's enjoyed the Shares Made Simple book. He's already read that book, so you've got some fans in the room as we speak. So thank you very much on behalf of us all, Rodney Hobson. Thank you for joining us. I'm going to take the roll back, and we'll let you go.
Thank you.
My pleasure. Thanks, Rodney. So there we are, Rodney Hobson, investing for the long term post-referendum. Thank you to Rodney for joining us to get us started for this day 4 of our London Investment Week webinars. And as the slides roll round onto this next slide, you'll see that our next speaker, Corvin Codirla, from FX Masterclass, is here, and he's in the room waiting to go with his presentation, Successful Speculation, How to Really Make Money. So let's just go straight across to Corvin now, bring him into the room, and see if we can say hello. Hello, Corvin.
Hi, Simon. Can you hear me?
I can hear you. I've already given you the controls for the presenter, so we can see your slide now, which is great. And we're looking at
okay. So, thank you very much for inviting me again on your show.
It's a pleasure. Sorry, you carry on.
Yes. Okay. So the purpose of the presentation today is to just hammer the point home that a lot of people approach trading from the perspective of needing to find the Holy Grail, and in actuality, generating wealth is straightforward. And the standard question that I ask people is, did you buy the S&P back in 1982 and sit on it? And you'll find that a lot of people wouldn't have done it. And of course, there's a very interesting study by Morningstar, the big mutual fund research house out in the States, and they asked themselves the question, well, let's look at the best performing mutual fund over the last 20 years, and surely investors in that mutual fund must have made a lot of money. And it turns out that the average investor in the best performing mutual fund actually lost money. And the reason for that being is that they traded this mutual fund like a share, buying the highs and selling the lows, and just wasting it. And so ultimately, the big takeaway here is that rather than trying to second guess the market, you need to try to understand what the market is paying you for and be diligent and disciplined, and look at not just on a trade by trade, day by day basis of what your P&L is doing, but have a long-term perspective here, where I define long-term to be of the order of between 1, 3, or 5 years. And that's where the real growth comes about. And so that ultimately is the aim of this presentation. And to tie in with what I just said before, I'm sure that a lot of the people who are attending today are probably trading their own money, and probably some of them are asking themselves, what is it about the professionals that I do differently, and what is it that I actually have to know to perform, just like the guys I read about in Hedge Fund Market Wizards by Jack Schwager, or read about in the newspapers like Buffett. And what is it that these guys know in terms of finding the factors that pay that I'm not doing? So this is really where the presentation is being addressed at. So the takeaways, as I said, that I want you to walk away with from this presentation are two components that drive trading success. And those components really are edge and risk. And so edge is a funny one, because people, when they hear the word edge, think that they have to be unique or in some way better than anybody else out there. Do they have the shiniest new toy machine, neural network, Kalman filter, wavelet? And on the risk control side, they think, every trade has to be a winner, and even losing one trade is a complete catastrophe. And risk management is all about preserving capital. Well, those two things are really illusions, and if you approach them from the right way, which tends to be slightly counterintuitive and different from what most of the stuff out there says, you'll see that you can really extract value out of the market. And coming back to edge, of course, I'm an FX specialist, as we'll see very soon, and so we'll cover what is it in the FX markets that really makes money, and then we'll end up this presentation with 3 exercises. I guarantee if you go away and you do these 3 exercises, you're going to be way ahead of most of the other traders or wannabe traders who are in the markets at this moment in time. So just to recap here, what the underlying message is that edge and risk combined can make you money, and you have to keep those two in your head and be able to identify, when am I focusing on edge? Am I looking to get paid? And when am I focusing on risk? Am I looking to reduce my downside and therefore be able to extract as much money out of the market as possible, as we'll see. So before we jump straight into the presentation, I'd like to give you a bit of background about myself if you haven't come across me. I've been working in the city since 2001, and for a long time worked at hedge funds and investment banks devising trading systems, and ultimately in 2011 set up my own hedge fund, trading foreign exchange in a systematic way, meaning computer programs executing intraday. And so this road to ending up with my hedge fund, was almost identical to even private investors in terms of information overload, chasing systems and sexy ideas, and making rookie mistakes such as over leverage and running losses. And ultimately then in 2011, when I set this fund up, the result of that journey was actually quite profitable. And as you can see, we were even awarded by Barclay Hedge, the big hedge fund database out in the States, an award for 2015. And you can also see the track record as audited in the bottom left-hand corner. So let's get back to the presentation. It's all about those two pillars that I discussed, edge and risk management. And of course, to be able to do that, you need the discipline. And discipline, for me, really means that you have a rule-based approach to the markets that you understand and have a grapple on. In particular, if you get yourself into the situation not knowing if you should execute a trade because you don't know which way you're feeling today, then that's not the way to trade. That's not rule-based. The rule should have a black and white outcome, and you should execute upon it. And if you in any sort of way hesitate to execute upon the rule, trust me, the biggest reason is fear, and the reason you're fearful is because you're afraid of the money you're going to lose, which means that your position size is too big. What you tend to find is when people approach the markets and they're afraid of executing, it's their position sizes tend to just cause them tremendous nightmare. And so my suggestion is reduce your position size by a factor of 2 or 5 or even a tenth of what you originally intended to trade, to the extent that the position size or the P&L fluctuation has no emotional impact. It's only then that you can start to exercise discipline, understand your rules, see how the system behaves. And as you become disciplined, you can, in essence, follow Buffett's advice, which is his own 2 rules: never lose money, and rule number 2, never forget rule number 1. People misunderstand risk management to the extent that they just focus on not losing, and not losing actually enables you to do something quite remarkable with your cash, which we'll cover shortly. And then when we come to edge, as I said, edge is a very misused word. I mean, imagine yourself as an investor looking to invest in a hedge fund, and you go to the guy and you ask him what he does, and he tells you, well, I look for undervalued stocks in the PE ratio. And you're thinking, well, should I really give this guy my money? I mean, I could probably do that myself. And from that perspective, hedge funds always face this kind of catch-22. If they tell people they do the obvious, then people start asking, why am I paying you 2% management fee and 20% performance fee? I could be doing this myself. So hedge funds tend to be very mysterious, not because they've really got something amazing and a genie in the bottle, but because if they were to show the emperor's clothes, people would more or less see straight through them. And that's the whole purpose of this presentation, to show you that finding that edge is very straightforward. So to recap, you need risk control and you need edge. Risk control is not just about losing money, and edge is much easier than you think. And having laid the foundations, let's actually dig in. So what do people understand under risk control? As I said, for the majority of them, it's all about cutting your losses. And the question is why? And as I want to show you, cutting your losses doesn't actually make you more money, which tends to be the implicit assumption and the illusion behind all this. What it, however, allows you to do is to leverage. You see, if you know that your downside is protected, you can take more risk, and that's the component that actually adds to your bottom line. So to really exemplify this, I want to give you an example with a rule-based system called the London Breakout Strategy. And it's a very straightforward strategy, probably well known. What you do is you look at your favorite currency pair. Euro-dollar tends to work very well during the London FX Open, which tends to be between 6 and 8 o'clock in the morning. So that's 2 hours when the currency sets a level between a high and a low, the range for that particular morning. And so once that range is established by 8 o'clock in the morning, you put 2 stop orders on the top and the low side of that range, and you let the trade just develop throughout the day. So if price breaks up and triggers your buy stop, you go long euro-dollar, and then you just keep it until the end of day, and you get out at the end of day. So having described the system, I want to show you how, if you implement those rules, it actually looks like. That's the red line on this chart. Now, as you heard me describe it, I didn't actually talk of using stops on that system, so that system doesn't have any built-in stops. So what would happen if you were to say, each trade I have has a maximum loss of 50 pips? Well, if you do that, you get the blue line. So if you compare the two lines, the red line is the system without the stops, and the blue line is the system. With the stops, you see a big difference, and the difference is not how much money you make by the end of this time period we're looking here, which is over the last 7 years, but by the amount the line wiggles up and down. And so that wiggling of this cumulative equity chart, i.e. your profits over time, is really a measure of risk. So the smoother it is, the less risk in the system. And to highlight the point, just because you're having less risk doesn't mean you're making more money, where for both strategies here we're using the same lot size. So what? So what can I do now to actually extract and use my risk management to make more money? Well, as I said before, the missing component here is leverage. And whenever you want to compare two trading systems, you really need to compare apples with apples. And the only way to do that is to make them equal in risk. So what that means is you need to leverage up the blue line, i.e. the strategy with a 50 pip stop, so that it has the same kind of swing size as the red line, the system without the stop. So if we were to do that, you can see on the next chart, the results are quite astounding. But to add another benchmark into this equation, see, a lot of people, a lot of investors, when they think of risk, they naturally think of equities, because everybody talks about equities. It's in the news, it's on the TV. 2001, the tech bubble is still very fresh in people's minds. So what I will do is actually equalize the risk of these two systems to the risk in the equity market, so that you've got some benchmark that you can compare it to. So let's leverage it up and see what happens. So the green line is the S&P since 2010. The red line is the breakout system without the fixed 50 pip stop, and the blue line is the 50 pip stop system. And as you can see, by equalizing the risk across equities in the two FX systems, you get a massive distinction between performance. So that is the real key to implementing risk management, not capital preservation. Yes, that's definitely true. You need to have capital to be in the game, but the ability to leverage it up to the upside, because ultimately, remember, trading is about making money, and nobody here is going to be happy at the end of the year saying, I didn't lose any money or I made 2%. No, you want to knock it out of the ballpark. And that's where the risk management truly comes in. So that's principle number one about risk. Risk means controlling your downside so you can leverage up in a controlled fashion and really hit it out of the ballpark. So now let's move over to principle number two, which is edge. So what does edge really mean? Edge is about understanding what you get paid for. So when you purchase an asset, you're implicitly taking on risk. Why? Because rather than going down to the bank and depositing your cash where you earn a fixed amount of interest that they promised you up front, you have to take on the risk of, is price going up, is price going down, is the market liquid enough, will anybody take it off my hands? So in some sense, you need to be remunerated for the risk you're taking on. Otherwise, people wouldn't transact for that particular asset. And so that risk that you're taking on, you're getting paid for, is called beta in hedge fund parlance. And by understanding the different factors, the different risks that exist in the market, and which one is favorable at this moment in time, you massively amplify your chances of being able to extract value. So if you look at the various kinds of beta that exist across markets, let's start with equities. Equities tend to go up. And various sectors of equities go up in various different fashions. So for instance, you've got the value sector, which are companies that for some reason or another have languished, have low PE ratios, low book to price ratios, etc., etc. If these companies turn around, they're obviously at this moment in time going for cheap value, and they're going to go back up sky high when they turn themselves around. And so you need to understand a lot about the management, etc., but you're being paid to hold this market or this particular company, and that's exactly what Buffett does. What other factors are in the equity markets? Well, there's growth stocks, stocks that keep on increasing their earnings like crazy quarter on quarter because they're new, they're in that particular sector of the market that's the newest fad, and everybody's on top of it, just like the tech bubble used to be back there. Let me go back up because I don't want to restart the computer right now. So, in commodities, what are the factors in commodity markets? at this moment in time? Well, commodities are interesting. They're driven by supply and demand, by seasonality, and the way that manifests itself, especially when you get weather shocks or other kinds of political shocks. For oil, for instance, you develop massive trends. Commodities are very much herd behavior all over the place. And you can see that in terms of the way that price runs away. So you get paid by providing liquidity to those people that want to participate in the trend. And by holding on to that trend, you get paid for providing liquidity to the market. So that's the real factor in commodities. By understanding when the big liquidity demands exist, that's how you can profit out of them. So commodities is really about trend following, whereas equities is about understanding value or understanding what grows in terms of earnings. So let's come to FX. I said I'd show you exactly what drives the FX markets, and similar to the previous two markets, FX also has an underlying set of rules that drive price. And the problem that a lot of people have with FX is that they see it as a secondary transaction. So if you go on holiday, let's say you go to the States and you're based in England, for you, your holiday is primarily about the experiences you're going to have in the States. And the transaction of having to convert pounds to dollars to be able to purchase in the States is a secondary afterthought. And that's how a lot of investors, especially equity or bond investors, consider FX. It's not their biggest focus. To them, it's just some cash transaction that doesn't add real value. How can you make money out of exchanging one piece of paper for another piece of paper, which is what FX trading really is all about, in exchanging these bills? Well, that's a slight misconception, because think about it. FX is about the exchange of one cash form for another, and why would you want to do that? The classic example is I just 2 weeks ago got from Lloyd's Bank a letter telling me that my savings rate has just gone down again. And that was fantastic, because the savings rate already was at something like 0.5%. How much lower can it go? And then you look at the world markets and you see that people in New Zealand at the moment are earning something like 2.7% annualized. And you're thinking, well, my money should actually be sitting in New Zealand and not in the UK. So a natural trade, therefore, is to exchange your cash and move it over to New Zealand. And part of that feedback cycle is to then just also appreciate the New Zealand dollar itself. Forget about that extra interest that you're earning. So that's called the carry trade. That's a very big factor. It's driven by interest rates and the difference between interest rates. Then the second big component is value. So how can FX, how can these bills that we use to pay things for have value? Well, think about the fact that FX is not just about exchange of cash, it's also about the exchange of goods across borders. So imagine yourself to be a tourist from the UK going to New York City, and you buy a bottle of Evian water. And it's plastic, label, water, plastic cap, and you don't drink it. You actually put it in your backpack and you bring it back to London. And when you arrive in London, you go to the closest newsstand, you find an identical bottle there, and it's going for £1. So you just paid $1.20 for this bottle, and here's going for £1. They're identical bottles. You can exchange them. So there's an implicit exchange rate there. Well, this implicit exchange rate, if it's $1.20 and £1, is $1.20 to the pound, where the exchange rate would be 1.20. But if you look in the markets, let's say the exchange rate is 1.3. Actually, now it's more or less at 1.27, 1.28. But that would effectively mean that the market is overpricing the exchange compared to what it really represents in terms of shipping physical goods across boundaries, where FX transactions are really required in real life. So that's the way you can formulate value trades, and these trades play out over the time period of 1, 2, 3 years. And over much shorter time frames, you have momentum. Of course, trend following momentum, it's one of the most favorite and biggest things out there. And why would you have these kinds of impulsive flows within the FX space? Well, again, look at, for instance, the relationship between the UK and Europe, as it's still part of the European Union. At the end of every month, you need to have sterling flows into the European Union coffers, and that must be exchanged sterling for euros. So you have month-end flows. Similar stuff is true for the Japanese, who have quarterly accounting, and as they repatriate dollars into the country, you see definite strong movements in dollar-yen towards end of quarter on the yen pairs, especially dollar-yen. And so these kinds of flows manifest themselves without you having to know the actual story behind it. Another example, of course, is mergers and acquisitions. When big rumors for cross-boundary company acquisitions come along, then all of a sudden you can see big moves as the market anticipates that these companies have to exchange cash to acquire each other. So these are the three pillars plus a couple of others, but these are the three main ones that ultimately combine to provide value. And why are these so important to understand? And I'm going to show you exactly that. You see, by trading these guys on a regular basis, when I say regular, I'm talking about monthly rebalancing. So you monthly rebalance your FX portfolio. You put a trade on once a month. You can create an index out of these three factors. So before I show you the chart, let's go back to equities. In equities, you've got the S&P 500, and the S&P 500 is made up of defensive stocks, and utility stocks, and consumer cyclical stocks. So all various components that represent economic factors going on in the market. And you combine them together, and you track the market at large. So similar with these three factors in FX, you can track the FX market at large. And that's actually a great thing to be able to do, you see, because FX traders face a very big challenge. They don't actually have anything they can compare themselves against. They don't know if making money or losing money is actually good or bad, or was the market challenging, or what is going on. Whereas an equity trader, if the S&P went massively down by 50% and he only lost 5% on the year, he's incredibly happy. He doesn't go home thinking, oh my God, I lost 5%, I'm miserable. So this is what these three factors allow you to do. So as you combine them in a very rule-based way, as I said at the beginning of the presentation, when you trade, it has to be black and white. You need to know what you should be doing. If you combine these three factors, you get an FX benchmark. And this is what it looks like if you apply these rules on a monthly basis going back to 1996. And what's really, truly phenomenal about this is that it generates value. And all of a sudden, you've transformed, like mentioned before, this idea of a secondary foreign exchange transaction that just comes as an afterthought in your travels or purchases of foreign goods. It actually turns out that FX itself has long-term growth potential. And that all of a sudden translates FX from just the meaningless exchange of two bills into an actual asset that grows for you. And that is the real key takeaway point here. By understanding those three factors and combining them in a very rule-based monthly way, you can generate value for yourself. So, obviously, we're talking about edge and risk on an ongoing basis, and the magic happens when you combine it. So what happens when you leverage up what I just talked about? And so there are various ways of doing that. One is called Kelly betting, but what I'd really like to do here today is, again, make it comparable to the equity markets, which most people love and see on the news every day and hear about it on the radio. So if you were to make this comparable to the S&P, you'd ask yourself, first of all, well, what was the maximum drawdown of the S&P over this time range? And it turns out that its maximum drawdown was of the order of 50%. So the question is, by how much will I have to leverage myself, or this FX benchmark, to achieve a comparable kind of drawdown? And so the previous chart I showed you was done on a leverage one, which means that if you have $100,000 in the bank, your total notional is $100,000. So how much more would you have to leverage yourself if you want to achieve equity-style risk? Well, 8 times is the answer. And here's the really fascinating thing. Since 1996, the S&P made 7% a year on average, whereas on 8 times leverage, the FX benchmark generated 41% annualized. That's the key message. You have an edge and you have a risk, and when you combine these two, you produce overwhelming results. And so this is what this would have looked like with the kind of leverage I'm talking about. You would have turned $1 back in 1996 up to $800 by the middle of 2010. Of course, you would have had drawdowns, but here's the main message. Just like breathing, where you can't breathe in without breathing out, you can't make money without losing money. The whole point is the long-term trajectory is up because you're basing your trading on underlying factors that are always going to be true. Guess what? People are always going to look for opportunity in interest rates. Nobody wants to keep their money in sterling if they're only earning 0.25% a year, if they can earn 3% somewhere else. Okay. Risk control and edge. So that was really the first part of this presentation. I said that I want to finish this presentation off with 3 exercises that will definitely set you apart from 90% of the trading population out there, be it professional or private. And so the first exercise is really about risk discipline. I call it the random coin flip experiment. And it's actually very easy to implement. It's actually intraday trading because you want to do a lot of these trades to get the emotional impact out of them. So what you do is you take a coin and you flip it. If it comes up heads, you go long. If it comes up tails, you go short. Pretty easy. In both cases, once you put the position on, you put a 20 pips initial stop on your trade, and after 5 minutes, it turns into a loss, and I don't care how much of a loss, even if it's just minus 0.1 pips, you close it out. If the trade shows a gain after 5 minutes, you let it run with a trailing 20 pip stop loss. And if the trade is profitable by the end of the week, if it just so happens, close it out. Keep an accurate log of when you did the trade, if you closed it out after 5 minutes from that, how you felt about doing it, and stick to these rules without exception. And these last 2 points about keeping an accurate log and sticking to the rules are what makes this exercise so important. So let me go over to the next slide where feedback from people who've performed this exercise. You see, the biggest observation tends to be that even if you're just minus 0.1 pip in loss after 5 minutes, the urge to keep it running and not sticking to the rules is incredible. And if you close it out, even if it's just a pip loss, a lot of people come out feeling incredibly angry. Now think about this. Let's say, and I urge you to do this exercise with nano loss, so a pip loss is more or less a cent loss. So if you do these exercises 50 times over, you might end up losing $2 or $3. That's nothing. I mean, you know, people go into Starbucks and buy themselves a coffee and buy a muffin for $5 or $10, but they get incredibly upset by having lost $2 in the markets. So there's something obviously wrong here. And this is what discipline is about. It's about stepping out, getting rid of these emotions of self-blame and wondering if I did the right thing and just sticking to the rules. And once you're over this chemical reaction, that's when you start to understand exactly how to implement the rules, and you can approach them in a very cold-headed way, level-headed way, and actually start to make progress. Otherwise, you're always going to be hampered by the fact that you know what you should be doing, but guess what? You're like a three-legged dog. You know where you want to get to, but you're never going to get there. So this exercise will definitely help you overcome that. The second exercise is one in getting to grips with the fundamentals of the FX markets, and I guarantee you even professional FX traders probably haven't done this one, or very few of them, and if you do it, you do definitely start to really understand the FX markets much, much better. So going back to what we said, one of the factors in the FX markets is interest rates. So who sets interest rates? Central banks. So that means that central banks must have a massive effect on the FX markets, and as we know, of course they do, and people, especially before FOMC meetings or ECB meetings, you read the rumors, the headlines, but what people usually tend not to do is look at it in a bigger picture, meaning what are the inflection points, what are the turning points, what are the consequences for a month, over 2 months of that particular statement. And so this is what the exercise is supposed to do. Take your favorite chart of your favorite currency pair, and on it, mark out the meetings of those central banks like I've done here in blue boxes. Next, observe precisely how did the market continue afterwards. Did it switch back? Did it flip around? Did it just wheeze out? Classic example here for Eurodollar at the beginning of 2011 actually was when Trichet opened his mouth and started to speak about inflation. Trichet up to that point had never thought or mentioned inflation. All of a sudden he's concerned about inflation, which leads to only one thing, increased interest rates. And as you can see from 2011 onwards, Eurodollar went from 124 all the way up to 149, and that was a massive shock to the system. Equally in 2014, when Draghi started talking about quantitative easing on the Eurodollar, collapsed all of a sudden from 150 almost all the way down to parity. So central banks very much influence it. So once you get a feel for their impact and the inflection points they generate, the next step for you is to ask yourself is, how can I exploit this? And this is where we go back to my rule-based approach. What you do is, on those days in which you had an announcement, you form a high and a low of that particular price range. Set yourself up with 2 stop-loss orders, a buy stop and a sell stop on either side of the range. And then the next day, after the announcement, let the trade take place the way it does and close out by the end of day. And if you follow that for Eurodollar, looking at ECB meetings only, you get this P&L chart going back to 2009. And guess what? It means that central banks have a definite impact upon the currencies, and you can exploit that. Now, this is just one central bank on one leg of a currency pair. What I urge you to do is to start doing this exercise across all major currencies and combine it and see what actually truly happens. If you do this exercise, I guarantee you the results are pretty astounding. And you can easily do this by looking at central bank meetings, Googling that, or looking at Forex Factory and getting some prices out of MetaTrader or any MetaTrader terminal that has prices, daily prices, or you can download that off the internet as well. And this is very easily implementable in the spreadsheet, so I urge you to do that. Now, the final exercise is to really take a step back and ask, well, how can I combine factors to really grow my portfolio? Because that was the whole point about mentioning edge, that people, when they say edge, think magic, leprechauns and neural networks and magic black boxes that nobody has an insight to. And the truth of the matter is that that's not the case. So how can we go about that? Well, first of all, we need to understand where risk lives. I've on purpose left FX out here because we've covered it, and it's a separate universe unto itself. But if you look at the assets that we do have available for the purpose of this exercise, it's equities, bonds, and commodities. And as we mentioned, for each one of them, we can implement a certain strategy. For commodities, for instance, it's trend following. For equities, it can be momentum or just buy and hold. And then we combine these two together. Now, a lot of people say, well, okay, so these are just asset headings. Underneath there must be millions of individual components that I have to manage. Well, we live in the 21st century, and the great thing is that the ETF, the exchange-traded fund universe out there, has exploded. You can trade a lot of those ETFs on leverage with people like IG Index or Saxo Bank who provide CFDs. So let's have a look at this. For equities, look at the SPY, which is the S&P tracker fund out in the States. For bonds, look at the ticker called AG, which is the Barclays iShares US Aggregate Bond Index, which looks at fixed income instruments with maturities of longer than 1 year, from government all the way down to high-grade investment bonds. And for commodities, look at the GSG, which is an ETF that tracks the Goldman Sachs Commodity Index. And there it's a bit funky. What you do is you buy that index if it's been up the last 3 months, and you sell if it's been down the last 3 months, implementing a very naive momentum strategy. And just to show you that even a naive momentum strategy can perform just like a hedge fund, have a look at the chart where I actually plot out the 3-month momentum strategy on the back of the GSCI. That's the orange line, compared to actual trend following returns, CTA returns from very big hedge funds. That's the blue line, and you can see that they more or less behave the same. The reason not quite the same is because those guys don't just invest in commodities, they also use trend following on equities and bonds, and we're looking at that separately. Now, the question, of course, is in what proportion do you actually invest? So 1 unit of commodities, 7 units of bonds, and 2 units of S&P. That more or less goes completely against what people tend to tell you, which is invest everything 60% in equities and 40% in everything else, bonds, for instance, because you want to have equity exposure. Well, it actually so turns out that the real way to trade is to have 80% in bonds, maybe the rest in risky stuff, and then leverage it up. And the reason you want to do that is because by leveraging and by investing in bonds and not so much in other risky assets, you generate a smooth equity curve. You control your downside. And what's the whole point about protecting your capital and your downside? You can leverage the hell out of it. So let's have a look at the unleveraged version of this portfolio and those ratios. This is what it looks like going back to 2007 when all these ETF prices become available. Looks pretty good. On a leverage of 1, you look 6% annualized with a maximum drawdown of less than 5%. Which is okay, but as we said before, trading is about making money. It's not just about eking out 6% on an annualized basis like asset managers and hedge funds. So leverage it up. So again, leveraging it up to make it comparable to the equity markets, you get this. You leverage it up 10 times, which is definitely feasible with different platforms out there, depending what instruments they offer. And you can see that all of a sudden, you make 60% annualized with a maximum percent of 40%, maximum drawdown of 40%. So how does that compare to the S&P 500? You can see that the S&P over the same time period with the same downside eked out only 6%. So this is very easy to implement. You've seen the proportions with which you have to invest in each of the individual units. You can get the price series from Yahoo. Again, this is monthly rebalancing. You trade at the beginning of every month. You implement your trend strategy on the Goldman Sachs Commodity Index. You work out the percentage returns. You should obtain this. You leverage it up. You should obtain this. This is all replicable. You can test it out for yourself and think about how that influences the way you think about the factors and the risk that exist outside in the market. So to recap, we've got risk combined with edge allows you to generate tremendous wealth using the right leverage And finding edge across various markets is not that difficult. A lot of it is well documented. For instance, what I've shown you here with hedge funds is really known as risk parity, and one fashion or another has been traded for a very long time, the last 10, 20 years. Ray Dalio of Bridgewater, the biggest hedge fund in the world, really made it public and popularized it. Now, I want to finish this presentation off with an introduction to a course that I recently launched, which really gives you an oversight how to implement a lot of these strategies within the FX universe, and predominantly because I'm an FX guy. As I said before, I ran my own FX hedge fund, focusing very much on intraday strategies, at times trading 100, 200 trades a day. And doing that as a private investor is a very difficult enterprise, from operational challenges to slippage to commissions to cost of trading, to always being on top of the way signals change. It's quite a pain on the backside. And as you saw before, even monthly rebalancing can generate tremendous amounts of wealth. So having exited my fund, at present I'm focusing very much on implementing these kinds of longer term strategies with the right leverage to extract value. And this is exactly what the FX Master Course Academy covers in terms of the basics, the fundamentals, the FX factors, and how to combine them into profitable benchmarks to trade. Now, the course itself covers more or less the pillars that we talked about today. It's about understanding the edges that exist in the market. That's pillar 2. It's also about understanding how to use leverage to extract the biggest amount of value. But pillar 1 here, I think, is the most fundamental of all the topics we cover, because as I mentioned earlier, a lot of people who trade the FX markets really don't have a clue if they're good or not. And I'll give you an example of a student of mine who made serious returns over a 6-month period using his own approach to the markets. And in 1 month, he lost something like 15, 20%. And he was very exasperated. And he said, oh my God, I can't believe I lost that much. So I said, how much did you make in the last 6 months? And he said, well, I made between 100 and 150%. I said, you've got to be crazy. You made that much money and you're excited about a hiccup like that? You're nuts. This is the whole point. Most people, when they approach the market, have no clue as to how to measure their performance and therefore set their behavior within a realistic framework. And at the slightest hiccup or bump in the road, they run around like headless chickens. And one of the big issue here is understanding the right formulas and maths, but more importantly, understanding who to compare yourself against. I always like giving the example of Warren Buffett, who is considered the sage of Omaha. Obviously, he did make billions over the last 60 years of investing. He's now in his mid-80s, but very few people tend to pull up a chart of Berkshire Hathaway, which is his holding company, and to actually see that in the last 16, 15 years, he had drawdowns twice over of 50 or more %. So here's a guy who's considered an absolute professional. Everybody thinks he's great, but he still draws down 50%, mix it all back, and even more so on top. So by understanding as to what it is that you can and should expect out of the markets, you set a level playing field for yourself to be able to succeed. This idea that you can make $1,000 every month, month in, month out, the markets are random. Random means they don't obey your desires. They do whatever they want to. And that means that there is a definite chance, because it's all about probabilities, that you will lose on a given month. And guess what? With the kind of technology that tends to be available to private investors, monthly losses, I'd guess maybe 50%, 60% of the months tend to be losers, maybe small losers. And it's really the 50, 55% of winners that are really going to knock it out of the ballpark. So that's something to bear in mind. And once you understand that, you can then start to really implement edge and risk appropriately together. Now, I'm offering the course at the moment for 4 times $167 monthly payments, or one-off payment of $597. And of course, there's a 30-day money-back guarantee. And if you sign up in the next hour, you also get 2 free half-hourly consultations with myself. And these are the testimonials from students who had live courses with me in the past, and their feedback with regards to the stuff that they learned. And what was really nice about the universe of students who've joined, they come from the city, they're students, businessmen, import-export themselves. So people who obviously have some numerical background and can actually manipulate spreadsheets and think about this. This is definitely not a course for somebody who just wants to plaster an indicator on the screen. and walk away thinking that this machine will do it for him. It's about understanding the methodology, implementing it. It's completely black and white rules. There's no second guessing, and then being able to stick to it. And once you have that foundation, of course, it's a fantastic springboard for you to start to implement, manipulate, and implement your own ideas. And now I'd like to give back to Simon and see if we've got questions and answers, and if people want more information with regards to the content of the course. But let me stress and reiterate here, the 3 exercises that I did give you, i.e. flipping the coin, looking at central banks, and combining that portfolio, you do those 3 exercises and you think about what they mean, you look at the results, you're going to be ahead of 90% or more of the traders out there. Okay, Simon, over to you.
Corvin, yes, I know it's a great program you've put together. It's great to put it all down. I know there's a few people already who've gone through your program, and we're getting good feedback about that. We do have some questions waiting. I thought rather than interrupt you, I thought we'd wait until the end and then see if we could just rewind a little bit. The first question: how did the FX benchmark perform since Brexit? The presented slide shown.
That's a very good question. So as part of the course, obviously, one thing I truly believe in is that, you know, it's not just so much about reading, but it's about people being able to follow a portfolio where somebody actually puts on the trades. So for the first batch of people who joined in April, I started a benchmark portfolio actually right at the end of May, 3 weeks before Brexit. For the second batch of people who just joined the last couple of weeks, I'm going to start and set up a new model portfolio for them as well. So through Brexit, what happened? The portfolio got clogged. I mean, it was a very interesting day on the leverage we were running. At one point, right before the announcement, as everybody remembers, when the sterling crept up to 150, it looked fantastic. The portfolio was up 15% since inception, which was at the end of May 31st. Then all of a sudden, it dropped 20% to the downside, and then went back up, and it just oscillated and jolted around. Now, that's the whole point about having a portfolio. So the portfolio at the moment is overall up 15% since the end of March. And if you look at the P&L chart, it's definitely a zigzag line of up, then down, and then up again. Sterling, now the system switched itself over to short since the end of June, and obviously it's continued way to the downside since then, has profited on that. And remember, sterling is not the only component. That's the whole point about a portfolio. You have other positions on there. If you look at the carry trades, which are the Kiwi pairs, they've performed phenomenally well. If you look at the value pairs in there, they've performed very well in the meantime. So whatever impact you would have had on momentum trades that might have not got wrong on sterling would have more than been covered by the movements in the other portfolio components. And yes, the portfolio did trade through the Brexit right as in the start on May the 31st for that first batch of people, and it's now up 15% since then. So that's over the last 3.5 months.
Fantastic. Could you put the slide back to let us see how much the course is? One or two people just asking about the the cost and the duration of the course. How long should it take you?
So the course is a video course, and the people who've signed up now for the video course, I mean, some people have managed to go through the entire material within 1 or 2 days. Obviously, people who are not necessarily burdened by full-time jobs, but their approach has been to just skim through it. I mean, it's a total of something like 18, 19 hours of video together with MT4 overview. I cover the MT4 terminal from the basics as to here's the power button to all the way how do I code up my own dollar index, because everybody wants to have a dollar index, or I can get more sophisticated in the yen index, together with all the other materials, spreadsheets that cover data, replication. Obviously, as I said, it's all about a rule-based approach, so the data is included together with the spreadsheet calculations to be able to replicate the numbers that you see, and so that you have some confidence in the way it's implemented and how you can create those portfolios. But, I mean, you know, on 20 hours, it depends how fast you go, how detailed you want to get. Some people are not that interested in terms of the theory. That's something they want to catch up on later. They just want to go over to the strategy section. So it's, you know, it's something that can take you from a week to maybe 1 month, depending on given your pace.
Okay. Back to some of the questions on your talk. Stuart's asking, how did the idea of carry, value, and momentum come about?
That's a very interesting question. So carry is an obvious one, and it's obvious because from an economic perspective, you'd expect carry to not necessarily provide you with a tremendous profit opportunity. The way to think about this is like this. If you know, so let's take a wonderful pair, which is Kiwi yen, or historically used to be when Kiwi or New Zealand interest rates were high and yen interest rates were at zero. So the fact that everybody knows that the interest rates in New Zealand are high means that everybody should be piling in.
Nope, I think we've lost.
And so if
there we are.
everybody's doing that, that means that the people who know that. Hello, can you hear me?
Yes, it's just breaking up just a little bit, but we can hear you again now.
Okay. So the people who know that Kiwi yen should appreciate should, in essence, front-run this trade and start selling Kiwi yen before other people can profit and get out of it themselves. So the idea is that there should be no free lunch. So the interest rate differential that you're making, i.e. high rates in Kiwi versus low rates in yen, should be actually outstripped or flattened by a Kiwi yen move that goes in the opposite direction. Well, that's not actually what happens in the markets. So what happens in the markets is that these trends in terms of monies flowing into the high-yielding currencies are quite protracted and go on for a long period of time, meaning that you get a double whammy on the carry. You actually get appreciation of the high-yielding currencies. Not only are you making the interest rate, but you're also getting price appreciation. So what I've just described is a rational agent's economic approach or understanding of how the markets should work. And that's what the academics formulate, versus what actually works in the markets. So when you actually can test for this, doing regressions, you can see that the markets behave completely differently from theory and actually have behaved so consistently since the breakup of pegged currencies in '74 with the breakdown of Bretton Woods. That's the last 40 years. So it's a bias, it's a risk factor in the markets, it's well documented. So that's how carry came about. With regards to value and PPP, or a purchasing power parity, that's also a well-known conundrum within the FX market. See, FX is not like a Yahoo stock. You're not going to have two well-developed countries like Euro and the States have their currency go from 0 to 100 like Yahoo did go from like 0 to 100 and then all the way back down. Their economies are stable. And when we go back to the idea of exchanged physical goods across boundaries, so should be the price relationships. Of course, short-term speculation, short-term momentum can deviate away from value, but the idea is that it should come back to value. And people have been creating models, again, academic models for the last 40, 50 years, trying to really measure this kind of mean reversion, and does it come back, and for how long does it stay away from the mean? So it's another very well-known factor. Momentum, well, momentum, especially in the 70s and 80s, in currencies were incredible, just like they were in most other commodity and financial futures markets, and certainly it has persisted with time. Less so maybe in the mid-2000s, especially during the quantitative easing and focus on central banks when FX markets were tended to be slightly more binary, but we start to see big trends coming back again. Just look at Euro-dollar from 2014 until recently, look at sterling. So momentum is there, and if you want to, that's not so much an economic reason as a behavioral reason. You know, people tend to act like sheep, they move in the same direction all at the same time. And there are a couple of other factors that we go in the course, not necessarily cover in this presentation for lack of space and time. But what I'm trying to say here is these factors, it's not like I went down, saw the Wizard of Oz in a closed room and said, those are the factors, and then we made it. You know, they're well documented. It's about how you combine them and how you implement them. What does it mean to trade value? So all of a sudden you go from academia to real life. How do I actually create these portfolios? How do I test them? How do I gain confidence in them? How do I measure how much I should leverage in them? How do I monitor them? And of course, the whole point of having a model portfolio is for people to be able to actually then see how it's implemented. It's one thing to just read or hear something, and it's another thing to see somebody do it, which is something that I'm setting up for the current batch of students who are signing up. So I hope that answers those questions.
Thank you, Corvin. Yes. Now, is the course that you're offering, it's not linked to any particular broker or anything? There's nothing funny about it, is there, in terms of opening accounts?
No, I have no broker. I mean, people ask me, yes, I can give them broker recommendations or the things that I use, but no, I'm not hooked to any particular broker.
Yeah. What about
Again, interesting because when people talk about are you hooked to a broker, the next question that comes up, do I have to execute on those signals that I show? And the answer is no. We're talking about fundamental movements in the markets. You can be a day off, 2 days off from the end of month or whenever. It's not going to make much of a difference. This is not about you got to execute 11 past 12 in the morning on this day, and if you don't, you're never going to make it. That's not what this is about. This is about understanding what drives the markets, and you can exploit it.
what about options expiry dates? Do you look at options expiry effects on movements in FC foreign FX? Do you
Well,
mean
that's
Ripple?
an interesting question. There's definitely pin risk. There is haggling around options in terms of different parties trying to defend what they have to pay out and the hedges they have on. Um, I'll give an analogy that probably people understand better who are not so familiar with options. Non-farm payrolls. So when you look at non-farm payrolls, there's always a lot of excitement, and probably there will be some tomorrow. And then people say, oh my God, it went up and went down. So I urge anybody who reacts like that to actually take a daily or a weekly chart of a currency and try to identify exactly where non-farm payroll happened. So you won't be able to. The whole point is that, again, taking a step back and distancing yourself from this intraday fluctuation, these things are truly noise. That's why I urge you to do the central bank exercise, because the big effects come from central banks. The average volatility on a central bank day is twice as much as a non-farm payroll day, and everything else is peanuts. So you really want to understand how markets move and follow through, get to grips with the fundamentals and how policy shifts happen. That's number one. With regards to options, options are interesting because what is the driver of an option? Forget just about price move. There's something called volatility, which is how much prices jiggle up and down. And that's effectively the same as the idea of options being insurance and the volatility being the insurance premium. See, an insurance seller cashes in premium against a catastrophic event happening. And here's an interesting fact about options, which there's many quotes about that, for instance, from Jim Rogers in The Market Wizards by Jack Schwager, where Jim Rogers says, 90% of all options expire worthless. So rather than buying options, he'd like to sell options. And what's interesting is talking again about factors and biases, we definitely know that short-dated options in FX markets are completely overpriced compared to where they should be given the underlying price moves. Now, the one caveat here is that I wouldn't recommend shorting options or writing options to any beginning investor. There are obviously massive downsides involved with that if you don't know exactly how to do that. But options in and of themselves are a very interesting other factor and component that can be exploited to generate value. So from that perspective, options is definitely something I do look at, but on that kind of level rather than trying to understand price fluctuations, their option effects on that.
Okay, thank you. Sorry, one more question. How do you arrive at the weightings of equities, bonds, and commodities in the portfolio? Was it optimized?
So that's a very good question. So I mentioned a bit the idea of risk parity. If you want to get a better overview, Google Ray Dalio of Bridgewater. Tony Robbins actually came up with a great book last year called Money, where he interviews a whole bunch of very interesting people, including Ray Dalio. I urge you to read that as well. He describes it slightly better there. So what is risk parity? So a lot of people think about allocating capital to stuff. So they say 60% of my money, so if I have $100, 60% should go to equities, 40% should go to bonds. Well, risk allocation, risk parity, or risk parity being the same as everything has the same risk, really goes back to that chart I had of the two breakout systems versus equities, where I said let's leverage them up so that they all show the same amount of risk. So if you want everything to have the same amount of risk, or better said, everything to have the same amount of P&L days, so bonds being less risky, obviously don't swing as much as equities, so I have to invest more in bonds to have the same kind of dollar up and down days as I have in equities. So that's where those ratios come in. So if I invest 7 units in bonds and 2 units in equities, then on those 2 ETFs I described, you'll find that your average P&L swing on those 2 channels are roughly the same. That means the risk on those 2 channels are the same. Same being parity, so risk parity. So how did the idea of risk parity come about? Well, we've got this guy called Markowitz, who won a Nobel Prize for his idea of portfolio optimization and allocation of assets. And in there, he uses something called a covariance matrix. which really looks at the hedging between various assets, meaning that if an asset moves up, another one moves down, and there's an implicit benefit protection from holding assets in various allocations. So it turns out that this covariance matrix can be estimated looking at historical prices, but it's very unstable. And its instability tends to whack you in terms of the amount you have to churn your portfolio on commission loss, and usually it gets the estimations wrong anyway. So people then said, well, screw all this hedging benefit. What happens if we just assume that correlations amongst assets are zero, so they're completely unrelated, which of course they're not, but that's a very easy assumption to make. If you do that, you come up with risk parity. So from a practitioner's point of view, the idea of risk parity has been around for 30 years. Of course, it's then been taken up, propaganda, and being more or less translated to other people, but the whole point about risk parity, or giving everything the same amount of risk, is that we ourselves are not really in the business of trying to predict correlation or hedging benefits. Let's just assume that everything is unrelated. Risk parity just automatically drops out of that assumption. And that's ultimately how the weightings came about, by trying to make everything equally risked.
Fantastic. Well, Corvin, it's now 1 o'clock. I think we have to let you go. Thank you very much indeed for coming on, giving us the presentation again.
Hey, Simon, you're still there?
Yes, can you hear me? Can you hear me? Oh, I think we might have a bit of a sound problem. Can anybody else hear me? Oh, okay, so you can hear me. I think it's Corvin that we're losing.
Yes, perfectly. Yes.
Corvin, great. Well, just to say thank you very much indeed. I think we've covered off a lot of questions there, and we've enjoyed the presentation for the second time this
week. I can hear you.
Thank you for coming back and giving us that presentation. Anybody wants to sort of get signed up?
Can you hear me?
Yes, we can hear you. I think you're coming and going. Yeah, I think Corvin's definitely got problems there. That was we only put enough money in for an hour, obviously, on the phone line. We'll leave it there, Corvin. Thank you very much again, and I'll take back the presenter role from you.
Okay.
Okay. Oh, I think you're back now. I think we can hear you. It was certainly coming and going at the end there. So we are. So now we are on 1 o'clock, and this is the London Investment Week Live, day 4, where we have live webinars going on throughout the day, and we've just heard from Corvin Codirla at FX Master Course Academy, and we are now waiting for Steve Ruffley, mt4switch.com, to join us. Steve has just pinged me a message to say that he is running late, so he sends his apologies, but he thinks it's going to be 1:15 before he can log in to give us his update. So that gives us maybe just about 10 minutes for a break ourselves. If you'd like to go off and put the kettle on, stretch the legs, we will come back, and hopefully we'll have Steve with us ready to go at 1:15. So that's just under 15 minutes from now. Okay, so we'll just put a little message up there letting anybody that's just joining now wondering where Steve is. He is just running slightly late and will be with us just over 10 minutes time from now, and to deliver his daily update at 1:15. So welcome everybody that's on the webinar. Thanks for attending. This is Simon Campbell speaking, your host for the day, in fact for the week. And just to confirm again about the fact that these sessions are being recorded, and rather than spending too much time slicing and dicing the presentations, what we're doing for the sake of speed is just putting them onto YouTube. And already there are 3 days worth of the presentations available there at our YouTube channel, which is IX Investor. If I bring this over now, actually, I could show you the channel. So there we have day 1, day 2, and day 3. So all you need to do is to go to youtube.com/IX Investor, and you'll be able to see the recordings there. And in fact, subscribe to the channel if you can, and you'll get updates whenever we put a new video up there. There it is in the chat box. There we go. Just incidentally, I can see a lot of new names on the event today. Just to remind everybody that we're doing a live event as well. For any of you in London, the Southeast, we will be holding our one-day annual live event, Round the Clock Trader Live, at the Grand Connaught Rooms in London, just off Covent Garden, on Saturday the 5th of November. And we've invited many of the speakers who we have taking part in these webinar events that we have going on, and I'm happy to say that a lot of them have accepted and will be making their way down to the Grand Connaught Rooms on the Saturday morning. So we're going to be there all day. It's very much an opportunity for you to meet the various speakers that talk about the various topics that gel with you in particular. There will be lots of different presentations going on at the same time. We have 5 rooms with almost 45 to 50-minute presentations going on throughout the day. I just pull the website over here just now. I can let you see at a glance. This is the website for the show, roundtheclocktrader.live, and as you can see, we still have a few spots to fill up. The FTSE Theatre, Nicole Elliott from the Society of Technical Analysts, Charlie Burton, of course, who we all know from Easy Trader, David Jones from Trade After, of course, formerly Chief Market Strategist from IG Index a few years ago. And going on, there we are in the S&P, Martin Walker, who we heard from on Tuesday, Alex Spiraglu, who we heard last night, Stephen Goldstein speaking later on today for a webinar, Corvin, who you've just heard, will be there, Alessandro Zambrano from Londinium FX, David Paul Wallace, Steve Ruffley, who of course we're waiting on now. So lots of great speakers there. Some we haven't heard from on the webinars before: Hemal Pandya here from Alpha Trading Floor, Ruben Miller from Investing Academy, Steve Ward, of course, excellent trading psychology coach, Alex Ong from Traders Corner. So really a fantastic lineup of speakers, and still more joining in the next few weeks as we run up to the event. Some of the supporters there, Society of Technical Analysts and Active Trades, and again, just a reminder of all the speakers. So it's Saturday the 5th of November. As an attendee of the webinars, we would invite you to save on the £15 entry and book yourself in with the special code RTC001. That'll give you a free ticket. So I'll put that in the chat box there for anybody that wants to go ahead and get themselves booked up. Should be a great day. Please get together, call your friends that perhaps you trade with, and arrange to meet them down there at the show. It will be a good day for it. So there is the code, the website and the code just punched in there. So you can go ahead and book that up. Oh, we're just waiting for Steve Ruffley, who will be joining us. Ripple, the event won't be broadcasted, I'm afraid. I did look into the possibility of doing that, but unfortunately it's a resource issue, and I will be more than likely involved in some presenting and running around myself, and can't be concurrently broadcasting it, I'm afraid. So at the moment, there's no plans to broadcast it. So apologies to anybody that is geographically too far away from London to make the event. But we'll see if we can do something. Perhaps maybe record some of the sessions. But unfortunately, no plans at the moment to do that. Okay, well, I've heard from Steve, and he is in the room, which is great. A little bit earlier than expected. So we'll go over to Steve and see if we can bring him in. There we are. Steve, I think it's microphone's unmuted. Are you able to hear me okay?
Yes, Simon, I can hear you. Can you hear me?
I can hear you. Fantastic. Great. Now, I did tell people that you were probably going to be delayed until about 1:15,
Sure.
so we're a few minutes ahead. So if we can just wait a couple of minutes, we might just deal with some of the more questions that are still coming in on the last session. Just so that people don't say, come back, and say, oh, I've missed the start now. Simon said it was 1:15 as the start time. How are you today? I think everything okay?
Yes, everything's fine, Simon. Yourself?
Great. Yes, very good. We've had a good day so far. We've started off with some longer-term investing with Rodney Hobson, post-Brexit effects, and now we've just heard from Corvin Codirla again, who does his FX master course, former hedge fund manager. And
so what was the long-term view then? What, sell stocks, buy the dollar? Well, long-term's not really my area, mate, so I'm not kind of...
Well, long-term, I think long-term view was that equities still are the best bet.
Really?
Don't get too hung up on safe havens, gold, gilt, and these sort of things, and stick with equities. But
interesting, because I was watching some Noel Chomsky yesterday, the Requiem for the American Dream, and all about how society's basically changed over the last kind of 80 years. To basically mean that big business really runs the global economy. It's quite interesting because I think stocks the exact opposite. I think they're absolutely peaked out now, and they're going to completely crash. I do the Reuters poll every 3 months, and my kind of prediction for equities come Q1 next year, FTSE's going to be around about 5,800.
Wow.
So okay. Yeah, I'm expecting a big drop. Not that I invest that way. You know, again, it's for me. It's more just kind of that's my commentary. You know, head. I'm happy to kind of, as you know, trade intraday and make money. You know, markets bouncing up and down. But long-term view, even kind of short, medium-term view, I think once the Brexit Article 50 has been triggered and interest rates go up, which I do believe after the ADP and therefore non-farm payroll on Friday, we're going to see the Fed put interest rates up by a quarter basis point. That's massive. It's actually massive in the grand scheme of things. So I think that people will migrate back to cash, and I mean, I think equities is going to absolutely be destroyed.
Well, we're going to keep an eye on that as we go. We will, of course. Okay, well we're at just about 1:15. Shall we cross over to your screen and let's take a look at where we are today?
Yes, of course. Okay, so you should be able to see my main screen as always.
I can. We can see the 8 windows. They're all open. Can we just ask everybody at home just to confirm with that chat box? James, there may well be fireworks on the 5th of November at the Grand Connaught Rooms. We'll see what we can organise with that. Indoor fireworks.
Okay, guys. Well, I'll just crack on as normal. I mean, basically, following on from yesterday and the rest of the week, we've seen gold really kind of consolidate towards the lows. I was very kind of surprised that this weekly level that I pointed out was such a pivotal point, and it was almost inevitable that gold had to make a new low from this point, but it hasn't really extended, and that kind of really powerful move down. But we know, I mean, we've got the lines in that have been here all week, that 1,253 and then down to 1,250, a beautiful round number, being a weekly, daily level. It's absolutely pivotal. So once we break that, then I think the gold's really in trouble again. Now, I've been a massive gold bull for a long time, and nobody a gold bear, and nobody can kind of take that opinion away from me. I just think that, as I've explained, the kind of things I read right now are going back to periods in history where we see the biggest inequality, the biggest kind of differential between the rich and the poor. Now, I'm not really political. I hate getting dragged into this political side of it, but when things get to the extremes, that's what you have to go back to. Because the most common denominator when you're trading is people. And there's more people trading, there's more money in trading than there's ever been. So what we have to realize is that people base decisions based on a number of things, on many kind of different multiples. But at the end of the day, when the gap between the rich and the poor gets the biggest in history, bad things have happened. Now, I'm not saying Brexit is a bad thing, but it's definitely a vote against capitalism, a vote against the political system. It's a vote from the North voting against the South for what they want. It's a vote against the imperialistic view that the small minority can guide us into prosperity. So when you look at, again, I've been reading a lot about Noam Chomsky and other kind of people that have been around when there's been significant changes in history. And, that's happened in the 60s, 70s, the black movement, the women's movement, all these different things. They're just history repeated themselves. Now, if you go back to the credit crunch of 2007, I mean, what's really changed? I mean, the subprime element may have been taken out of the markets and paid for by the taxpayers to plug up that shortfall. But this absolute lunacy of people, striving to own their own houses and, do it no matter what a cost is to them personally, and these kind of things, it has to come to an end at some point, because at the end of the day, it's property was never designed to be, your financial freedom. You started poor, you worked hard, you got a better job, you bought a house. If you did better, you buy a bigger house, and then you died. You left to your kids, circle of life. But now it's like you buy a house because you have to buy a house, because that's the only way you're going to supplement your income, especially in London. Now, there's only so much of that can happen, and a lot of people, I guess the millennial generation, I mean, sucked into this, and they believe that as long as they buy a house, that will supplement their low, stagnant wages. And that's what's happening. I see it firsthand. My sister has a great job. She manages Kew Gardens, but she earns a pittance. I mean, literally a pittance compared to what kind of people in the financial world earn. But she's still, again, she's making more money on paper from a property that she bought, a 2-bedroom flat in Camden, than she is by her actual wages. So you get to a point in history or a point in time where that'll just keep repeating, and just sell the house, buy the big house in the country, and stop looking. It's like, well, is that really going to happen in 2016? Maybe in the 80s, 90s, the early millennial kind of period that might happen. But this is the kind of the dream that's been sold to the younger generation. Just kind of keep paying into the system, keep buying, keep doing what you're doing. It'll all be sorted. It's not going to work. So for me, I don't think that translates to gold anymore. I mean, again, you see these big psychological levels like 1300. They're a magnet now to be smashed down. I mean, this is a really messy chart. I think what I'll do is I'll bring gold up, and I'll do it, you know, completely from a kind of newbie's perspective. You know, where it's been, where it's going to go. Let me just see what gold is. So if I was charting nakedly, you know, none of my clever lines, none of my kind of clever, you know, views, etc. This is where gold's been on a monthly basis. Started off down here, you know, just after the you know, the credit crunch and people didn't know what was going on. Ended up here, January 2011, and here we are here. So where's it going to go? What would you do? Well, the first thing I always do, my old friend Fibonacci. So it started off buying here, went to here. First thing I look for, 50%. So that 50% is at just above 1,300. Now that is an absolute pivotal point in gold. If you don't see that, then you should give up trading right now. That is an absolute decision point for bulls and bears meeting. So we got to this low point here, where gold had every opportunity to get down to that really critical $1,000 pivotal point. Now, trading's just people. So you have to go back to who trades the markets. It's just people. Now, it doesn't matter how clever you are as a quant, whatever you think, you know, mathematically you can do to predict the future. Markets traded by people. So unless you get rid of people and it's only traded by machines, then things like key psychological levels will always matter. So really, we're bounding now between this 1,300 and 1,000 level. We didn't get back above 1,440. We didn't get back above 1,500 key technical levels. The only real level that I'd expect, you know, gold bulls to be back in is above 1,446. Now, if we get above, you know, 1,440, then that really makes sense to me. That makes sense, you know, from a technical perspective and from a fundamental perspective. But realistically, as I've said before in these presentations, do you see adverts for cash for gold? No. Do you see people buying gold bullion? No. Do you see investment banks and hedge funds moving into commodities? No. If anything, they've reduced 60%, yeah, over the last 4 years. So who is buying gold? Now, if you go back to the central banks, who has big stores of gold? India, China. Who do we not like? India and China. No, we don't like them. But from a Western perspective, we're not interested in these countries getting richer by holding physical commodities. You know, Iraq had a huge amount of gold. Russia still has a huge amount of gold. Old-fashioned countries, old-fashioned thinking. Who buys gold? Old-fashioned people, old-fashioned thinking. So once you've absolutely destroyed the retail market and nobody's buying, you know, cash for gold anymore and holding gold bullion bars under the bed, and these are idiots. People that buy gold bullion are actual idiots. I know, because I know people that do that. So they're little poxy savings. They put £10,000 under the bed, little tiny gold trinkets. I like to pull them out and show you. Absolute lunacy. What a stupid concept. So anyway, as the real modern day investors come in, and the old people like Warren Buffett, I hope he dies soon. Same with George Soros. These people bore me. People that just got rich because all you had to do was basically sit on stock and hold it. In the real world, in the modern world, times have changed. You know, that decades become 2-year periods. So really with gold, for me, as you move from the monthly to the weekly, it's pretty much inevitable in my mind that we're going to target again $1,000, because we've had every opportunity to continue this uptrend. And you can draw any line you want. I mean, you can be a basic trader and go, oh yes, gold's now in a bull market because we've broken this weekly trend. We're above the 50%. But look what it does around the 50%. Tiny bounce. Double bottom, tiny bounce. Touches it, tiny bounce. I mean, this isn't coincidence, is it? I mean, how am I looking at a chart knowing exactly where gold's going to bounce? Just basically drawing one simple Fibonacci. Self-fulfilling prophecy. So you go from the monthly, weekly, down to the daily. We didn't just touch this line this time and do a modest bounce. We smashed it. So what's gold going to do now for me? Head back to 61.8, round about, you know, 1,150, back to this lower trend line that I've shown you and drawn from the weeklies, then $1,000. I don't bet long term. You know, if I did, I would be probably one of the richest people in the world because I'm always right. And that's really frustrating when you're someone like me. But I learned that that wasn't me. And I learned that when I tried to adopt that style, I lost money. So I had to go back to a style that made me money. And that was trading intraday. It was taking a wider picture and then focusing it down into manageable timeframes that I understood, that I got. I found when I held overnight positions, I couldn't sleep. So I'd spend weeks awake. That's not healthy. That's not good. You're going to die doing that kind of stuff. So I had to find a way of making money intraday. And that was really taking my views, my philosophy, my principles, and then shrinking it down into the smaller time frame. So we're still looking at a daily chart. I look at the daily chart for points of reference. I never trade from it. Hourly, again, all you have to do is widen, these lines up, and it's almost showing you, isn't it? It's like, no, we don't want to stay at that 50% level. We don't want to stay anywhere near it. We want to break it and make sure any longs in the short term were destroyed. Any medium term were nervous, and that's what it's done. It's broke through it with an absolute vengeance. One tiny spike, one kind of fake out, and again, do a mini fib from where it broke out. We got above the 28.3. We didn't get anywhere near that 50% again. Now, 80% of the time, a strong directional move will trace to 50%, and that is not the case here. So look, we're at 1285 spot 2. That is basically telling me that if gold doesn't make a new low today, I don't know what's going to happen in the world. And once it breaks that low, where's it going to go? Back down. The bigger fibs, the bigger trend lines. That's what's happening. It's pretty much self-explanatory. And again, you go to the 15-minute charts, and this is what you might do your entry from. When you see these big moves happen, then this is what you're looking for. Like, look for a key level to be broken. Bang, comes back down. 1, 2, 3, 4, 5, 6 15-minute candles in a row, smashing it down. One tiny bit of profit. 1, 2, 3, 4, 5, 6. Smash it down. One tiny bit of profit taking. 1. You can discount that. 2, 3, 4, 5. Tiny bit of profit taking around the lower fib. And then what do we do from that point? Continue downwards, make a new low. So these are things you have to look at. The longer term trends, they're great. You're going to invest for a year, 5 years, 10 years. And I've heard different presenters on Simon's webinars talk about following trends and making big wins, but you have to wait so long. For me, when you trade £1,000 a point, as I do, that's enough. This is enough for me. This is a bonus. This, that's great money. All you have to be looking for is really 25 pips. So you've got 31 there. You've got 103 pips. I mean, this is like when you're trading big size. 15-minute candles, all red. You can make 218 pips on that. If you're trading £20 a point, big money. £100 a point, massive money. £1,000 a point, boom. This is what you have to think about. Think about the big guys in the market. Think about the big players. So if the markets want to go down and not bounce, they go down. And gold's a great example of trading in that way, because it is very, very still old-fashioned institutional way of trading. When it goes, it doesn't come back. The DAX is very different than that. The DAX will bounce around. The FTSE a little bit more similar, but again, it's adopting the markets to your style of trading. So essentially for me, I think gold is still under a lot of pressure, and it doesn't really matter, what the kind of old school investors think. This protection against inflation, we don't have any idea what it is, really. We've kept interest rates historically low. We've got negative deposit rates. We've got infinite quantitative easing. How have we got any idea what inflation should be? I mean, you tell me. If you can tell me that, you're a smarter guy than I am. So at the end of the day, I don't see the value in gold as a physical commodity or as a protection or store of wealth. So moving on, I guess, the indices are quite interesting. If gold's going down, the indices should go up. I mean, that's a natural correlation, but how high can the stocks go? Realistically, as I've shown you a million times, you look on the monthly kind of charts, every time we've rejected the lows, we've gone higher. So I'd be amazed if the S&P didn't make a future high. But this is the whole point. We've been waiting, I guess, for maybe 3-4 years for the stocks to top out and sell off and crash. And that will happen, but it might not happen until here in the future, or here until the future. Remember, we can't really go off history because we've never had this level of quantitative easing. We've never had this level of too big to fail. The whole point, when I read about this Noam Chomsky guy, I read his books, but it kind of melted my mind, to be honest. It was a little bit kind of too too intense, too insane for me. So I kind of went and did a cheat, and watched the documentary. But again, it's this idea of capitalism. Basically we've employed the kind of people that made the crash happen, and they're the people we employed to then fix it. And what are they going to do? Well, they're going to pay their debts back with taxpayers' money, when it should be risky investors that lose the money. But they didn't, because they're too big to fail. So while that mentality is still in the markets, we're going to see stocks always be bought from the lows, because what's the downside? There is no downside. You're going to let Goldman Sachs go under. In Lehman Brothers was a bit of a chink in the armor, because everybody thought they were too big to fail, but they did. So if that happened 7, 8 years ago, why can't it happen in the future? And I'm not being funny. If stocks or a big investment firm failed, stocks would go from here to here in a heartbeat, down to here in a heartbeat. You could see 10,000 points knocked off the S&P in a matter of days. And that's what I think is going to come, to be honest. That's what I believe is going to happen, because we haven't learned any lessons. We're not any smarter. We're not getting any smarter in 7 years. I mean, look at the human population. Look at man. We haven't got smarter in the last 1,000 years. We're still basically just bald monkeys knocking around with iPhones. We're still pretty stupid. And there's a great passage in my book that I spent a lot of time writing to explain this. We don't protect each other with pointy sticks anymore, caveman attitudes. We protect ourselves with money. And everybody's in it. From the poorest people now to the richest people. And what can I'm privileged, and I'm just kind of have an insight into things that you'd never get to see. I've just done a deal today. Well, not a deal. I wasn't involved in it. I can't take credit for that. But part of my part of my involvement in different things, I've just helped a client of mine sell his Monaco property that he bought for 300 million, for 400 million 2 years ago. So a billionaire has made 100 million off one property in 4 years. Now, he bought this not because of any particular reason. He had to move to Monaco because he was worried about Putin taking his cash. So he bought this particular place because the car park could house the number of cars he had. So he bought it for that reason. Then he's just been offered some money even he can't refuse. And he's made 100 million quid in 4 years just because he has the money to splash around. Now, you tell me if that's the right kind of philosophy for the world, if that's the right kind of outset, that the rich continually make money just because they're rich. Now, I'm not going to get back to that political aspect, but this has to filter through to the markets. There has to be a point that the rich people involved in the stock market's down here. The really rich people involved in the stock market's down here because they know it's too big to fail. But the bin men, as I like to call them, the scroats, the people who know nothing, are here, long here, long here. So when they get smashed in, and when the market moves in a straight line, 3,000 points, which it will do, they get out. Because that's your doctors, your dentist, your retired teacher who's inherited, mum's house and sold it, for £1 million, because that's just what you do. These are the people that you can't rely upon because they're frightened, they're ignorant, and they're stupid. And that's what's going to happen when the crash comes. All those people are going to get out, and then the institutional investors are going to get worried. They're going to get out about here. Then the market's going to go bang here, bang here, bang here. And I really do think within the next kind of 2 years that the normalization, the kind of normal levels of the stock markets, and this goes with the DAX, the CAC, the FTSE. FTSE around about 5,500, maybe a little bit lower. The DAX below 8,000, and I'm pretty sure that the S&P is going to bounce around, 1230 and 1400, and that's what's going to happen in the next 2 years. Because when the crash comes, all these people, all these investors that have been so sure were too big to fail, and it won't be a failure. Because remember, every time the market goes down, people are still cashing in money. It's not a bad thing that the stock markets go down. It's this big lie they've been led to believe that if stock markets are good, happy days, everything's good. Oh, the FTSE's dropped 1.2% today. You hear on the last thing of the news. Oh dear, that's very frightening. It's not. Markets go down, people are cashing in money all the time because it's a long curve. People have bought here, people have bought here, 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 here. Money is some money go around. What goes up, what goes down. It's not necessarily all about markets always going up and people making money. Sure, you talk about your big institutions, your pension funds, but I mean, they've all been decimated. If anybody thinks there's going to be, you know, a public pension in the next 20 years, you're an idiot. If you think there's going to be, you know, a free NHS in the next 20 years, you're dreaming, right? The only thing that's going to pump up the economy is when the baby boomers die. And then all their property comes down to the kids just sell it. Because they never wanted that dream, they never understood that dream, and it's just going to go. And so the money is going to flow into the economy. You know, people will be driving around in Ferraris, and it's going to be great, just like the 70s. Will that be great for the stock market? Short term, maybe. But in the precursor to that, in the run-up to that, stocks can only go down. Because once they start breaking, these lows that have been propped up by false money, false dreams, are gone. And the people that invest that way are gone. Yeah? Because if you're a trainee teacher now, all you're seeing is your wages going down. So in like 5, 10, 15 years' time, you're going to be sticking your spare 50, 100, 200,000 quid in the stock markets at these low levels. No. You're going to be going on holiday. You're going to be doing stuff. You know, you're going to be spending it, living your life. Not like this generation of people that have just accumulated money over nothing. So once that goes, then every low in the stock market that's happened gets smashed. So people that tell you long-term equities, keep buying them, stupid. They don't know anything. They haven't read enough. They don't know enough about history. And anything that goes up on this kind of steepness, you know, that's not even 45 degrees. I mean, that's too steep to be continued. And that's all because of quantitative easing, all because of low interest rates, all because we're encouraging people to borrow money on a full stream. And when it all fails, then things happen even quicker. So, as I said, all my polls across the stock markets by mid-2017 and late 2017 were all substantially lower. And maybe I'm wrong. You know, maybe I'm wrong. You know, it's, as I said, it's not, for me, in my mind, a bad thing. You know, people get out of stocks, they're going to put the money into something else. The majority of big investors will have still made money because they bought early enough. So, essentially, that's how I see it. And if stocks go off, maybe a bit of big comes back into gold, but as we're buying gold, you'd be absolutely mad to buy gold now. You'd have to wait till it gets to 1,253, get down to the 1,250, because what's keeping it up? You know, there's no fundamental reason. There's no, as we know, you know, no kind of big central bank selling gold, no big investor selling gold. So it's going down because there's just less demand for it. So essentially, as we stand now, we saw a bit of a bid come into the stock markets, a bit of strength come into the dollar and weakness into the euro, dollar, and pound based on the ISM manufacturing yesterday. So we had the slightly worse than expected ADP, which is a precursor to non-farm payrolls. But I guess all eyes tomorrow will be on the non-farm payroll. An inline non-farm payroll, or slightly better than expected, really forces Janet Yellen's hand finally to put another rate hike this year. So I guess immediately what I'd see is a sell-off in the dollar, because the market seems to do the opposite of what it should do, and then the dollar goes back up. But then continued weakness in the euro. I can't go over the euro again because I'm so bored of saying it. The euro is finished, sell it high, it's getting to parity 1.0, and then down to 0.8. Everyone knows this, so it's just going to happen. Once Brexit happens, it's going to trigger contagion. Eurozone, look at Greece, look at Portugal, look at Spain. What do you think is a strong economy versus Britain? So, if anything, Brexit is the final nail in the coffin for the euro for me. If we don't see a north-south euro in the next 2 or 3 years, I'd be massively surprised. If you see a complete overhaul of the euro completely or get rid of it, I don't think that can physically happen. But I tell you what, the whole contagion thing and countries leaving the EU will definitely be the major worry for Mario Draghi. And I hope he has a stroke and dies, because he's been the most useless head of the central bank in ever. I never thought I'd ever hear myself say this, that I wish Jean-Claude Trichet was back, because I listened to him talk about price stability. Price stability. I've heard that phrase a billion times. I never thought I'd get bored of somebody else, because I just was sick and tired of hearing that. But if Jean-Claude Trichet came back tomorrow, I'd feel much more certain, much more safe about the European Union. Draghi has been an absolute joke. It's been a disaster, a mess. So pound is obvious. Yep.
Sorry, can I butt in with a few questions? Jeff saying, are the Fibonacci lines more important to you than the hatched lines?
They're all a combination. I mean, as I've said in the past, the dotted lines are previous points of interest in the higher time frames. So the dotted lines are monthly, weekly, daily points of interest. They've been calculated off the higher time frames. The fib lines, which are the green and red, are based on the hourly. So you get that combination of what's happened in the past based upon future movement, and that's really how I trade. I know what happened in the past is set in stone. The future is a little bit more volatile, so the hourly Fibonacci's really provide me with kind of entry and kind of trigger points.
Great. What about gold? Joaquin was saying gold is very volatile. When bad news hits, gold goes up still.
Yeah, I mean, it's still the way it goes, you know. I mean, it's still traditional, but look at the stock markets. Bad news happens and the stock markets recover. So it's not a direct or indirect correlation anymore. So what was normal a few years back is not normal now. So gold will go up and down on good or bad news, but the stocks are not acting the same way. The dollar's not acting the same way. So the kind of coefficients, as they're called, and the correlations are not as exact as they used to be. So this is why it's difficult. That's why you have to look at the markets as I do, an overview, because sometimes they're the best trigger in the world. You know, the best kind of trade is if gold's tanking, you buy some dollar, or you buy some S&P, but it doesn't always work that way. Gold's been quite aggressively selling off, and the stock market's not going up. The dollar's going up, but not as maybe aggressively as gold's going down. Again, it's all about correlations. It is what it is. I don't make the rules, unfortunately, for the markets. I'm just trying to commentate on what works. You know, things will work for a short period of time, then they'll stop. There is no cast iron guarantee. The whole point of being a trader is you have to be constantly adapting to the market conditions. So if you want to say I'm a swing trader in the FTSE, I'll give you 6 months where you burn your account out, because that will only work for 2 months of that 6 months, or maybe 3 months. You know, again, I don't make the rules in these things. You know, if you're not adaptable as a trader, you know, you will literally die. It's that complex out there. It's that difficult. So you have to have the basic thing you have to do is understand yourself. Once you understand yourself, your pain threshold, your attitude to risk, and the way you trade, you can adapt that to any product and any time frame. But that's the key. A lot of people don't like to do that because A, it's hard, B, it's boring, and C, it makes you think about yourself in a way you don't want to. And that's where I kind of come in. I tell you the way it is, and it's like, no, Steve, I'm not like that. Then I prove it to you, and you're like, oh, I don't like that. It's like, I have £100,000 in my account, and you can't tell me anything. It's like, well, no, I can't tell you anything, but if you don't want to lose that £100,000 account, listen to me. Because look at my past. I've helped people go from here to here. Why does Tiger Woods have a coach, a caddy? You know, why do some of the top sportsmen in the world have psychologists? Because everybody, even at the top of the game, just needs somebody just to point out little tiny things. It's the 1% I help with. That's it, the 1%. You know, it's history. History, guys. You know, you look at any famous actor, any famous person, the King's Speech, whatever. Everybody's had someone in their life that's helped them a little bit. I'm not saying I've got all the answers. Far from it, if anything. I'm the most honest person that does a webinar. I'm telling you I don't know all the answers, but I know more than you do. That's for sure. Anyway, any more questions?
Anything going up? David's saying gold, stocks, the euro, pound, everything going down. What's going up?
What's going up? Well, I can't get away from the dollar. I mean, you know, essentially buy the dollar. I mean, I've been saying this. You know, my philosophy is sell the euro at every high. Stay away from cable right now because it's too volatile. But buy the dollar. I mean, you know, all you have to do is flick down your charts and see what's what. I mean, look at anything kind of, you know, versus the dollar and just see where value is. The Western world is kind of crumbling under its own pressure and own expectations. So anything, you know, kind of in Europe, I'll be buying above the dollar. I mean, it's not quite as clear cut as that. I mean, again, I can't just broadly say buy the dollar, but, you know, just look down your charts of what could be a potential. I mean, New Zealand dollar, do I have any interest in trading that? Absolutely none, but I mean, let's look at a chart. You know, what's it doing? You know, so look at a monthly. Well, there we go. It's a perfect Fibonacci. Perfect Fibonacci. Started buying here, topped out here, double top. I mean, that's beautiful. I love stuff like that. Things happen for a reason. So it broke above the 50%. Fail, 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 fail. So what do I think is going to happen to the dollar against the, the New Zealand dollar against the dollar? It's going to go down. Simple. You tell me it's not. I mean, look at them fibs. Wow, look at that. Beautiful. Love stuff like that. Little kind of pop above. So where we're going to get down to? We're going to get down to here. 0.68648. Simple. You make an argument for me why the New Zealand dollar is going to strengthen against the US dollar. New Zealand dollar, New Zealand. I know a lot about New Zealand because I'm going to probably move there next year, just because, well, just because I can. But anyway, New Zealand, it's linked to the Chinese economy, doomed. Japan, that's right, doomed. Australia, dreams over, doomed. So who's going to start, bringing the kind of money I'm going to bring to New Zealand? Not many people. So in the short term, people are going to go back to what they know, go back to the dollar, because no matter what, the US has proved it's too big to fail. Anybody who knows it is going to invade it. Anything it does to kind of harm its American dream, it's going to pump the money in, it's going to do whatever it takes to kind of go. So New Zealand's not like that. Australia's not like that. They don't have the power, the resources. So always, in my mind, it's like, where's the risky investors going to put the money? Well, a proportion with the safe. Where's the really kind of safe investors, the millionaires, the billionaires that I know? They don't need a big return. So they put it in things they know inevitability, and that is the US. So S&P, as you say, might go up in the short term because of that mentality, but eventually it will break because everything does. But I still think the dollar in itself, its dollar. Think about the petrodollar. Think about the all commodities price in dollars. Just think about the dollar in general. It's the currency, the reserve of the world. It's only going to go up. So for me, all the advantages of selling other currencies high against the dollar and buying the low against other currencies. That's the only, not certainty, because I never say that kind of thing, but it's the only thing that makes perfect sense over a short, medium, long term. It's just buying dips against the dollar and then selling other currencies spiking against the dollar. There's nothing else I know that makes any kind of sense apart from that. And I can say whatever I want about the indices. They might go up, they might go down. Don't care. And gold, I can say whatever I want. It might get to $1,000, might not. But my kind of really underlying belief is that the dollar will remain to be the king of currencies until we have Armageddon. So how about that? So either you make a load of money buying the dollar, or we all die.
Okay, on that happy note, we've got a couple of questions asking about whether you offer any courses or training. I suppose this leads into the website mt4switch.com, which I've posted into the chat box there, Paul. If you go there, I think you'll see that Steve's offering mentoring packages that you can benefit from. So go ahead and look at the website. Steve, it's not really a course, is it? It's more of a mentoring.
To be honest, I mean, there's so much material. I've done so many webinars. I've done over 1,000 webinars in my career. I've wrote 5 courses, blah, 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 blah. My kind of skill is not really kind of taking newbie traders to be traders. It's taking people that have traded, been burnt in the past, to be better. Taking good traders to make them exceptional. At the end of the day, it's a simple fact, and it's a real kind of sad, state of affairs that you need money to make money, and if you're not prepared to put the money in, you cannot make the money to be a long-term trader, a successful trader, whatever it is. So unless you've got £5,000 to £20,000 to put into an account, you're probably not going to make it as a trader. So sorry to break the illusions of every other educator in the world that says anyone can be a trader. You can't. Anyone can be a trader and make money, but you have to have the capital, and that is unfortunately just the way it is. I can't sugarcoat it anyway. So yes, I will mentor anybody who's serious about trading, but you have to come to me with some money, because I can't help you if you don't have some money. If you can't buy yourself enough time to be a trader, then my time is just going to be wasted on you, and your time's going to be wasted. So yes, I will offer everything for me is always free. Always free. You can buy my book, that's 20 quid. I can't change that because that was the publishing deal. It's only 20 quid. If you want to read that, read it. If you want to come to me and speak to me, I will do that for anybody, no matter how much you put in an account. I will give you half an hour of my time, which is, a sizable amount of money. But if you want to kind of make it as a trader and kind of have a career or build yourself up, then you have to invest the money in yourself, I'm afraid, because if you don't do that, then our work is meaningless and pointless. And it's only because I've taught so many people over the years I can say that. I don't lie to people. I'm very honest. Trading is hard, and if you're undercapitalized, you will fail. You will always lose, always, and I mean
Great.
always.
Well, David's read your book. I can recommend Steve's book. James says, is MT4 switch different or better than iView charts? Might want to just explain.
Well, it's the same thing. I mean, the whole point of MT4 switch was meant to be a very simple site. It's not really come across that way. You know, again, it always amazes me how simple I try to make things. MT4 switch is, if you want me, you want my charts, you want some of my time, you want to go to a broker that gives you 10% rebates on every trade you do, switch to InterTrader. Simple as that. You know, you get iView charts as part of the package. iView charts is my charting software that I use to interpret the markets and make money. Simple. So it's all part of the same thing.
More or less the same proposition, yes. Okay. One more comment. What about oil? Do you have any view on oil?
Okay, I mean, oil's a tricky one. I mean, I've said this, you know, for absolutely since I began. I've seen a lot of people get rich quickly off oil and always lose the money. Oil for me is not for the faint-hearted, and it's certainly not for beginner traders. It just isn't. It isn't consistent. I remember, you know, people that tell you, you know, about oil, BP, you know, kind of people that actually control supply. So it's the biggest, you know, kind of oligopoly, monopoly, and you know, on the planet. I think where oil actually is now. I look at it so infrequently. Yeah, let's just look at Brent. For me, it's so difficult. Oil is one of these things. I just don't know enough about it, so I can only tell you from a technical perspective. First thing I do, it looks really basic, but you draw a Fibonacci. So oil for me is struggling. It's struggling to get back to upper levels. They tell me, Saudi Arabia tell us, you know, BP tell us it's going to go back to $100, you know, some point in the next kind of 5 years. Just don't know. Look at Elon Musk, you know, developing these electric cars. I mean, oil was the old school of thinking. Everything we manufactured, everything we produced, everything we consumed in some point had to use oil. That may not be the case in the future. It'll be the case to some perspective, but maybe that's cut down by 20%, 30%. So all these guys in Dubai, all these guys in Saudi Arabia, they're all panicking now because they're all run around driving the Lamborghinis up and down the strip, nothing to do because, you know, America has provided with, you know, a constant cash machine for the last 30, 40, 50 years. And maybe that's over. Maybe these guys don't have any plan B. So maybe this is the world just saying, you know what? We don't like you. We don't like you keeping oil above $100 a barrel. We're going to make an electric car. We're going to make a Hyperloop. We're going to make things that don't really require that much oil. And you're doomed. Goodbye. Maybe it's a political thing. I don't know. I mean, how else do you beat Putin? You know, you cut him off at the knees. You know, you can't beat him politically because he's a lunatic. He's got nuclear weapons. So what do? You know, you cut his major cash machine down by 50%. That's what's happened. You know, we're at 52.24 in oil. Can you see oil get back to 82, 113 anytime soon? Not of that chart, I can't. So for me, kind of peak out maybe at $60 a barrel, back down, and to get down as low as 20, you know, below 30. I don't know. I mean, this is the whole point. It looks bearish to me, to be honest. So as we go down the charts, you know, it looks very slow grind upwards. When you look at the monthlies, it's very quick downwards. So until we hit 62, I'm a seller. I'm a seller of oil. So I think it's going to go down before it goes up, and it may never get back to these higher levels that we've seen. And I think the world knows that. You know, why do you think, you know, Saudi Arabia's got the biggest kind of, you know, wealth fund ever created? Because what's the plan B? Dubai, all about free tax and tourism. You know, without the oil though, there's a lot of lazy people out there that aren't going to get their money back. Hey, you know, it's just sign of the times. What do I know? Anyway, oil, as I say, if you're a newbie trader, stay away because I've seen people wiped out. I've marched people out of offices for being, you know, too wrong on oil. So I would say, as trading investing goes, stick to things that we can kind of that everyone trades. The Eurodollar, you get a bounce. The DAX, you always get a bounce. Gold, directional but expensive. If you're you know, anybody who wants to make money consistently, stick to things that other people trade, not, you know, things that are traded by, you know, traders and institutions in masses. So, you know, oil for me, I can't stress it enough. It's a dangerous thing to trade. All right, guys. Any final questions? Any final thoughts? I mean, again, it's all about NFP tomorrow, so.
NFP tomorrow. I know you're going to come in earlier to give us a bit of a preview at midday tomorrow, which will be
12
great.
o'clock, yeah, I'll be there. I mean, essentially, it's the final nail in the coffin for rates. So if we see an inline or above estimate NFP, I cannot see under any circumstance that Janet Yellen won't put up rates. And that, take it how you want. For me, I think that's good news. So I think, regardless, the stock market after the figure will rally, but then maybe get sold off because traditionally, rates in a rising rates is bad. But I think initially, again, maybe this is the precursor. I've seen the sell-off in gold because the market's expecting a better than expected figure. So I think for me, it's all about rates going up. Look, the dollar against the yen, highs, pound lows, euro lows, gold low. Stocks, again, not really kind of spiking, but all the other indicators that I could see for a fundamental shift in that rate stance is pointing that we see a better than expected on-time payroll, and Janet Yellen has to put rates up in November, I guess.
So just one final sort of admin. Rajiv is asking. He says, "What about your trade maker? Is it also required along with MT4 switch?"
I mean, this just a kind of a downside for me of just being around the world so long. I mean, Trader Maker is just another site. It's just another site that I built a long time ago to educate traders. Trader Maker Pro is a piece of software you can use on Metastock. That's a deal I did in America a few years back. So if you want to use Trader Maker Pro, you can use that on the Metastock software. If you want to use iView Charts, then that is used on MT4, what you're seeing now. So the reason I don't show Metastock is because it's expensive and it's rubbish. You can sue me for saying that. I don't really care. I use MT4 because it's free and it's good. And you can do anything you want with it. So this is iView Charts. You want to use iView Charts, it's on MT4. And again, if you join InterTrader, put some money in an account, it's free. Now this is what I use to manage my hedge funds, everything. This is how I got sick and tired of being asked the same question a million times, a year. So what I did is I put it into a system. So you want to know how I look at Fibonacci? Here. You want to know how I look at support and resistance? It's here. It's there for you. What do you do? Sell the red lines, buy the green lines. Hello, money. Hello, money. That's it. So iView Charts is really my software that you use. It's all part of the same deal. It's all me. I don't even think the software is that big a deal, to be honest. I mean, it's helped a lot of people over the years. It's the mentoring. It's the kind of me talking to you about your goals, your aims, and how you trade. 15-minute conversation, to be honest, is much more valuable than just having some lines on a chart. But then again, I don't know. Maybe I'm biased.
Okay, fantastic, Steve. I think we'll leave it there. Thank you very much. That was another long. That was a good 20 minutes again. Thank you for that. Lots to say.
I'm always value for money, Simon. Always value for money.
Certainly are.
You take me out for a meal or a pint.
I will meet you for that meal and a pint very shortly. Yeah, the tab's growing all the time. Fantastic. Brilliant, says Paul. Thanks, says Rajiv. Joaquin, sorry we didn't get on to all your questions. Steve will be back tomorrow for doing that preview of the NFP. He's going to be with us at midday UK time. So if you want to trade that tomorrow, come back and spend some time with us tomorrow at 12 o'clock with Steve for that. So Steve, thank you very much again. Steve Ruffley, MT4 Switch, Trader Maker, iView Charts, and of course Chief Market Strategist at InterTrader. So thanks very much for your time. I'll take the attendee.
Yeah, I'll shoot up. Thank you.
Fantastic. There we are. Solid northern stuff, says Gren. Absolutely. Fantastic. So there we are. That was Steve Ruffley. Now, if you're just joining us, I can see a lot of people have been filing into the room over the last hour. So welcome to, this is day 4 of our London Investment Week event. My name's Simon Campbell. I am hosting and linking the various live trading webinars and speakers that we have taking part for the event. Pleased to say that we are just about to welcome in David Paul, old friend of the events, the round-the-clock trader events, and of course someone I've worked with before, so he'll be starting in just a couple of minutes, worry-free investing with VectorVest, of which he is the UK Managing Director. After David, well, we have a break actually after David between 3 and 4, and at 4 o'clock we will be welcoming Stephen Goldstein, trading behaviour specialist to the investment banks. He's employed mainly by investment banks and trading floors to help coach their traders onto winning ways. Tomorrow's schedule, David's asking, a bit of a light day tomorrow, with it being Friday. We've got Steve's non-farm payroll at 1 o'clock, and then at 2 o'clock we will have Zach Meir come to join us to giving us a roundup of the stock market, a week in the stock market, and a look at some stocks and which ones he thinks might be showing some promise for next week and beyond. So very much a stock-based event tomorrow afternoon, and non-farm payroll just before that at midday. So David's in the room now, David Paul, so we'll cross over to him and see if we can bring him in and say hello. There we go. I can see a green light, which means I think, David, you can hear me okay.
Yes, Simon, good afternoon. How are you?
I'm very well. It seems like a long time since we spoke on Monday, but of course, you've probably been doing lots of things this week. Are you in the UK or abroad?
I'm here. I'm at St Paul's, at our office at St Paul's, just opposite the cathedral. So I've been up to Manchester during the week to see our customers up in Manchester, and we had a lovely, really cracking meeting in Wigan, I think it was, on Tuesday night, full to the door, I'm glad to report.
Very, very good. Got all the glamorous places. David, for those of you that haven't heard you before, we are getting quite a lot of new names coming into these events this week, which has been great. So welcoming everybody that hasn't been. David Paul is the Managing Director of VectorVest UK. VectorVest is a tool for private investors to use to research growing the stock market and the various stocks within the markets in the UK and the US, in fact, most of the main markets around the world, and it has a unique proprietary system for ranking and weighting the stocks which are rising and falling the most within these markets. So an excellent software. I can attest. I'm a user myself. In fact, I used to work with the company for a few years. So we'll hand over to David, and he'll be able to tell you how he's making it work for him. Do that now, David, if that's all right. Make you the presenter.
Sure.
Fantastic.
You can see my blue slide?
I can see the blue slide. Can I ask those of you that are at home just to give us the usual confirmation that you're hearing and seeing David? Okay. That's great, Paul. Thanks. Wayne, thank you. Andy, great. Okay. I think we're all good to go, David. So I'll hand over to you, and we'll as usual, if we have lots of questions, I might nudge in.
Just chirp in anytime, Simon, if there's a question, certainly, yeah.
Will do. Okay, over to you. Thank you.
Good afternoon, everyone. Simon, thank you for having me. I'm David Paul. I've been trading in the stock market for a very long time. I put on my first trade in October 1982. I traded while I was working for De Beers, the Diamond people, until April 1988, and from April 1988 I've been trading on my own. Along the way, I started to do some seminars in the stock market, mostly at the institutional level. And I've done coaching for pretty much all of the big banks around the world. In fact, Barclays had a graduation day today of the people that went through my last coaching session. About 5 or 6 years ago, I went to a free talk that Simon, in fact, was hosting for VectorVest UK. I was so impressed with VectorVest after taking a 5-week trial that I got on a plane to North Carolina, where they're based, and managed to tie up the South African agency where my son lives. And my son has got a degree in music, and he was unemployed. So I started up VectorVest South Africa largely for him. He, in fact, got so interested in markets, and he managed to put together quite a strong track record. And he's now a fund manager in Johannesburg, pretty much using VectorVest to direct his decisions. And that means that I'm now running VectorVest UK and VectorVest South Africa. Simon decided to leave VectorVest to focus on the business that we're in today. And when that happened, VectorVest asked me to take over VectorVest UK as well. And I've been doing that for the last 3 or 4 years. So I think that pretty much VectorVest's the only promoter of investment software in the UK that's fully authorized by the FCA, and to that effect I've got to put up this disclaimer which pretty much says that I'm not allowed to give one-on-one financial advice. I can talk about what I'm doing myself, and I'm going to do that this afternoon, but before I could give you specific written financial advice, I would have to sit down in front of you and do a very long and elaborate fact find, so I can ascertain your stomach for risk. So in the absence of that, that's the disclaimer. So what we're going to talk about this afternoon, guys, we're going to talk about the VectorVest system itself. We're going to talk about market timing, and I think that's a very, very important juncture in market timing for the London market that I'm going to discuss in a reasonable amount of detail. And then we're going to look at the UniSearch facility in VectorVest to try and find some opportunity. Okay, and the thing that threads through all of VectorVest is the VectorVest edge. Whether we're going to use it for very long-term trading, position trading, maybe focused on income as opposed to focused on capital gain, or whether we're actually going to use it for 3 to 5 day swing trades. These 3 facets shine through. The first thing is that at VectorVest we combine the fundamental position of a share with the technical position of a share with the technical position of the overall market. Now, by fundamental position of a company, I mean the search for the true value of a company. By the technical position of the share and the technical position of the overall market, I use a definition made famous by the technician Martin Pring, where he in fact defines technical analysis as the study of trends and turning points. And very simply, when I can tick box 1, I can tick box 2, and I can tick box 2, the probability of me making a good decision goes up the page. I don't have a great deal of opinions in markets when I'm trading at my best. I'm very, very much a tick the boxes trader, and my second mentor, who was a bond trader here in London, told me very strongly once upon a time that when you come into the trading room, you take your opinions off at the same time as you take your coat off. He felt that there was nothing more fun than talking about what you thought was going to happen in a market over dinner or over a few pints of beer. But when you were on the trading floor, you just went with the flow. So that's what I try and do. So I'm very much a tick the boxes type trader, and when I put the fundamental position with the technical position together, then I find that my hit rate goes through the roof. So for the new people at VectorVest, we've got 3 questions to answer. What's the share really worth? How safe is the earning stream? And then some idea whether we should be buying it, whether we should be selling it, whether we should be holding it, which is a technical measure. So And VectorVest puts a number to all three of those things. And the first is value. And VectorVest puts a value to every share in the market every evening. So you can see at a glance whether your share is trading below our valuation or above our valuation. And as a default, we favor undervalued shares. Simple as that. You can eyeball it, or you can use our Unisearch facility, which I'm going to move on to probably in about 20 minutes time, and you can actually search for those, and it'll give you a short list of all those shares that are trading below the VectorVest valuation at a click of a mouse. Another measure of value is relative value. And as the slide says, relative value is an indicator of the long-term price appreciation potential. When we say long-term, we mean 3 years, a window of 3 years. So here's what the program does. It actually projects and calculates the earnings flow of every company in the London stock market and on AIM over the next 3 years. We assume that those earnings will be discounted into the price at some time over the next 3 years, and we work out what that projected price will be. We take the projected price and we subtract the price today to work out the upside. And we divide that upside by our measure of the risk-free rate, which is a AAA rated corporate bond, to work out relative value. So if your share has a relative value of 4, for example, that means that we believe that the share will outperform a AAA corporate bond by 40% over a window of 3 years. I firmly believe that's the most important number in VectorVest, and as you'll see on the little search that I'm going to propose today, I actually look at relative value and I sort my shares by descending relative value. An exceptionally important number. We'll see it in the program in a second. Now, I've just done this very simple search. I've looked at the top 10 shares since the start of 2015. And I've just done a simple linear test between the price then and the price now. And that portfolio has in fact outperformed the London stock market by 3x. That's just looking at the VectorVest valuation alone, just looking at undervalued shares. There's no timing whatsoever in that, and that's why I've given it a window of 18 months. So there is an enormous edge in just buying shares that are trading below the VectorVest valuation. And again, I put that into my little search, which we're coming to down the track. That second area that VectorVest looks at is earning safety. And we have a number called relative safety, which summarizes the consistency and the predictability of the financial performance. So every evening we suck in the fundamentals. We buy those from Thomson Reuters. So the algo looks at the balance sheet, the income statement, the cash flow statement, and 17 measurements, and from that it actually works out one single number which summarizes the financial performance. On a scale between 0 and 2, above 1 is okay, above 1.3 is excellent. This above 1.3, this is a company that's making lots of money and all the financial ratios, etc., are getting better. Okay. Now, if you are a long-term investor and you don't want surprises, then you would put relative safety very, very high in your set of criteria. If you are a short-term momentum player and you're managing risk proactively with stop losses, then relative safety is not that important. Okay? Because you're managing risk with stop loss orders. Long-term players, relative safety is absolutely vital. And certainly on Monday afternoon when I talked about our long-term trading, we actually used relative safety totally. Relative timing is a measure of the trend. Again, we mathematically massage the trend between 0 and 2. If the relative timing is above 1, that means the trend is up. The relative timing is below 1, it means the trend is down. The further above 1, the faster it's moving. So it measures both the direction, the momentum, and the dynamics of the trend. Then what Bart Toledo, the founder of VectorVest, did is they put all three together. And for the very first time in my career, and I've been at this since 1982, I saw somebody who'd engineered one number which combined both fundamental analysis and technical analysis. So VST, value, safety, and trend, combines relative value, relative safety, and relative timing into a one single number. And I'd never seen that done before. Now, as a default, ladies and gentlemen, all of the shares on the London market or in any market where VectorVest operates are sorted by descending VST. We calculate a stop loss for every share in the market every single day. It's quite a sexy stop loss in that it's adjusted for the fundamentals. If the fundamentals are good, we widen the stop loss. It's loosely based around a 65-day moving average, but it's in fact adjusted for the fundamentals. The objective is that if the fundamentals are good, we want to give the share more wiggle room. We put a buy, sell, or hold criteria to every share every single day. These are largely trend-following tools, and as you can see, the only fundamental input is that the VST must be greater than 1 for a buy. They can be used to time the market, but their main use is to work out the breadth of the advance, to be able to work out the number of shares on a buy recommendation divided by the number of shares on a sell recommendation. And I'm now going to go into the program itself and show you these things. So if I go into the VectorVest program, that's the front page, which we'll discuss in market timing in a second. I click on viewers, and the first time you go into this, folks, that spreadsheet is going to be empty. So you just need to click on Stock Viewer. And that displays all of the stocks. And they are, in fact, displayed by descending VST, value, safety, and trend. Well, this is a spreadsheet, and you can, in fact, just click on RV, for example, and that will sort them by RV. So we've got one share that's been perennially at the top as in fact sorted by VST for many years now, and that's JD Sports. Had a cracking couple of days, as you probably know, and it's trading at £15.73. Even after all of this, we still believe it's worth £21. So we can see at a glance that the share is undervalued. It was up 32 pence yesterday, which is 2%. That's hardly a proprietary number, but this is a proprietary calculation. The relative value is 1.52. And that's saying that over a window of 3 years into the future, we believe that this share will outperform a AAA rated corporate bond by 52%. The relative safety is 1.4 on the scale between 0 and 2. That's excellent. And the relative timing at 1.57, saying that the trend is strongly up the page. And when we put all three things together, those of you who are mathematically inclined by the sum of the squares, the VST is the highest in the pack. It's on a buy recommendation with a stop loss at 13.53. These numbers are our best shot at the fundamentals over the next year. And if we go right to the right-hand side, we can see dividend information. It pays a small dividend, 0.5%. But very importantly for conservative players, the dividend safety on a scale between 0 and 100 is 99%. And this is saying that although the dividend may be small, this company has grown that dividend and has got adequate resources to pay that dividend. The dividend is in the jargon well covered. We believe that the dividend is going to grow at 10% over the next year. And if we put those three things together, we get another master indicator, which is called YSG. Yield, the safety of the yield, and the growth of the yield. And if you were an income investor, you could certainly consider sorting your shares by YSG. And right on the right-hand side, we have the secret weapon hidden away. It's called CI. And the CI is called the comfort index. Now, if relative timing is a measure of the short-term trend, the comfort index is a measure of the long-term trend. Now, the comfort index does everything that VectorVest is supposed to do. It puts together the technical position and the fundamental position into a single number. And the comfort index is constructed of one, the long-term trend, the volatility of the long-term trend, and the fundamentals. If the long-term trend is strengthening with little volatility and the fundamentals are improving, that scores well, and that pushes up the CI. The CI is called comfort index, and I think you would agree that if you've got a share that's in the throes of a strong trend with little volatility and the fundamentals are getting better, that should give you an awful lot of comfort. So it's right across here. If I was engineering the program, I would bring it, and if I suggest that you just click on it and drag it and put it beside VST. I keep mine where the default is, otherwise I get questions because people say, why have you got a special one? So you can drag that across and put it beside VST. So RT measures the short-term trend, CI measures the long-term trend, and later on when we get into our uni searches, I'm going to be looking at CI. Okay, because I want to take short-term trades in the direction of the longer-term trend. That's good practice. So that's the basics of VectorVest, and in essence, we're looking for a share that's undervalued, that's growing its earnings aggressively, RV, with an acceptable level of safety. Now, if you're a hands-off investor, I assure you that if you only get involved in shares with a relative safety above 1.25, there are going to be few surprises. However, if you ignore relative safety and you find that your portfolio is composed of smaller companies and gold mining companies, there's CAS. CAS undervalued by 50%. It's got an RV of 1.56, which is on a scale between 0 and 2 is excellent. In fact, it's bloody marvelous. But the relative safety is only 0.89. And that's saying that over the last 5 years, there have been surprises. Now, this is a gold mining company, folks, okay? And gold mining companies have problems. One, the price of gold. Two, they're invariably pulling gold out of the ground in some godforsaken place where the currency's up and down and in and out. Three, they've got some executive at the gold mining company who fancies that they can hedge that currency risk out, and invariably they get it completely and utterly wrong. And I did tell a CEO of a FTSE listed gold mining company some years back that they should stick to jackhammers. I didn't take that well. Lots and lots of things that can go wrong in a gold mining company. And then, of course, there's safety. That is a major issue in these mines that tend to be getting deeper and deeper and deeper all the time, certainly the South African mines. There's another little company with really good numbers, Victoria, 335. We believe it's worth 591. It had a 5-for-1 split the other day. Did a nice acquisition the other day as well. RV 1.58, but the relative safety 0.86. Okay, a great opportunity for those people that have got a stomach for risk. Those people that don't like surprises and are hands-off would clearly leave it well alone. Simon, is there any questions out there about the basics of VectorVest?
David, no questions at the moment. I think we're okay. Does anybody have any questions they would like to ask before we?
I think the one thing that I can it is a stock market trading program. It doesn't trade currencies. It doesn't trade gold. It doesn't trade soybeans. We put together the fundamentals of a company, and we get those fundamentals from the hard, cold numbers that are in the annual and the interim reports. In the absence of an annual and an interim report, we cannot work out the fundamentals. And the core of VectorVest is putting the fundamental position of a company together with the technical position of a company, and as I'm moving on to now, the technical position of the overall market. And when I can tick all three boxes, then the probability of me making a profitable trade goes up enormously. Okay, so in the absence of any questions, then I'll move back to my PowerPoint presentation, and that's all about timing the London market. And we're at a very interesting juncture in the London market, that is for sure. So VectorVest, the mantra is that we want to buy rising shares in rising markets, and to add to that, we would want to buy rising shares with cracking fundamentals in rising markets, and we would want to sell falling shares with ghastly fundamentals in markets. Okay, to do that, we need to be able to make a judgment as to whether the market, the general market, is rising, whether the general market is falling. And working out whether the market is rising or falling is absolutely paramount, and everything else follows from that, in my opinion. VectorVest have been timing the market for over 20 years. We have short-term systems for traders, long-term systems for investors. We've in fact got 5 timing models, and we'll have time to look at 2 of them in some detail this afternoon. They all look at 3 things, whether it's a short-term trading system or a long-term trading system. And very importantly, they are totally rule-based. There's no subjective input, there's no scratching, whatever part of your anatomy you have to scratch to make a decision. Well, there's no scratching required. There's going to be a little arrow. Green is good, the market's going up. Red, not so good, the market is falling. Worked out for you in the background and all color coded, so you can actually keep it under control on the run. And there is an app available for the Samsung phone, the Android phone, and an app available for the iPhone with pretty much most of the functionality of the one that I have on my laptop. And certainly the very first thing that I do in the morning is to have a look at what's going on. Normally before I get out of bed, although I suppose I shouldn't really admit to that. We look at 3 things. We look at the price of the VectorVest composite. Now, what is the VectorVest composite, you may say? The VectorVest composite is a composite indicator of all of the shares that we follow in London, both on the LSE and on AIM. It's an equally weighted index, ladies and gentlemen, and around the world we've shown categorically that an equally weighted index reflects the sentiment of the market much, much better than a market cap weighted index, and we're not alone in that. Many of you will be members of Signet, and the Signet index, in fact, is an equally weighted index, so we're not alone in that. So we look at the price of the VectorVest composite. We look at the breadth of the VectorVest composite, and to work out market breadth, we use the proprietary VectorVest buy-sell ratio. And thirdly, we look at the momentum of the VectorVest composite. Those 3 things to measure the technical position of the overall market. Remember, the definition of technical analysis that I've adopted is the search for trends and turning points, the study of trends and turning points. Short-term systems are primarily based around a 5-day rate of change, and on VectorVest speak, the short-term trend is known as the primary wave. And the longer-term systems are based around a 21-day rate of change of price, momentum, and breadth. And the longer-term trend is known as the underlying trend in VectorVest speak. So we have another 3 measures between those 2 that I'll certainly educate you about in the user groups and in the online webcasts that I do, but I haven't got time to go into them today. So the primary wave, the shortest measure of the trend, and the underlying trend confirmed by price, the longest measure of the trend. Now, to minimize chart watching, these are color-coded, and two words describe the trend position. Now, as I write, or as I speak, should I say, the trend on the LSE is up and up. Now, the first word refers to the short-term trend, the primary wave, and the second word refers to the underlying trend. And every day, the first thing that you can do, or when the data comes through at 7:30 in the evening, is that you can in fact work out what is the trend situation on the London market. If you're a position trader, then the underlying trend is absolutely vital. If you're a short-term swing trader, then you need to know something about the short-term trend as well. And the best time to buy shares is in fact when we are in an up position, and we'll see that on the front page of VectorVest every day. Now there is the front page of VectorVest, and you can maybe see that we're in an up situation for the last 3 days. And on the right-hand side here, we can see that there is a confirmed up, which in fact is the underlying trend confirmed by price action. And that, ladies and gentlemen, has been up since the end of February this year. Brexit did not cause it to fall. The short-term trend, or the primary wave, is diagrammatically shown on this little traffic light called a color guard. And at the minute, that little pointer is in the middle, and VectorVest advocates caution when buying stocks at this time. And the best time to be getting into the market with new positions is when the little pointer is in the green, and it will say here, VectorVest advocates buying safe, undervalued stocks at this time. When it's in the red, it's going to say very simply, VectorVest does not recommend buying stocks at this time. Okay, so this actually tells you exactly what to do. Now, let's have a look at the VectorVest composite itself. There's the composite, folks, over the last year. This is an equally weighted index of all of the shares on the London market and on AIM. There's Brexit just here, and down below is our proprietary market timing indicator. The market timing indicator is used to measure the underlying trend, and it's a 21-day rate of change of the price of the composite and a 21-day rate of change of the breadth of the composite, all rolled into one.
David, I might just interrupt. Yes. Before we go too far along, you were talking about the company reports just a few minutes ago. Andy, it says, are these reports, are they preset, or do the clients have to write their own report? I think we're referring to the stock analysis reports.
No, the stock analysis reports are available for every share every single day. And those are an integral part of the program. So there's no input required by any customer. Okay. If I go into the program itself back here, for example, if I right-click and I go to full stock analysis report, it pulls up a stock analysis report of every share on the market. So this is Victoria. And it's on a buy recommendation. Valuation is great. The growth RV is great. Relative safety is fair. Okay. Timing is excellent. Goes through all of the VectorVest metrics. The comfort index. Okay. And then it looks at earnings per share, growth rate, dividends, dividend yield. Then it goes on to sales. Okay. Sales are excellent. 72% increase in sales. And that is completed for every single share on the London stock market and on AIM, and I have got many stockbrokers who cut and paste that and send it to their clients because it saves them a heap of work. So that's available for every share in the market.
Thank you. What about the sort of return on investment if you've taken all of VectorVest's recommended trades? I know this is a question that comes up quite frequently. So James is asking if you were to take all the recommendations, which of course is perhaps not understanding entirely the way the system works.
Yeah.
But
No, I think that it's not a black box, James. We would have to work together to work out what you want to do. For example, the position trading, and we've tested this back for the last 20 years, has produced a, not including dividends, produced on the S&P 500 a compounded rate of return of 17% a year. And that is managing, and in fact on average we were only taking a trade every 6 weeks during that period. That's not counting dividends, and that's not counting any other income. Okay, so if you were a swing trader, you can do clearly considerably better than that. But VectorVest is a massive toolbox full of tools, and you need to actually put a plan together to use it. So it's not a black box that gives you black box decisions. Under training, I put together a course on how to use it, and the last chapter of the course, which comes with our 5-week trial, is how to put a plan together, to actually put a plan down on paper so that you know what you're doing. So VectorVest can be used for income, it can be used for capital growth, it can be used for both. Okay, a Neil Woodford type portfolio where you are doing your best to grow capital and pay income at the same time, or it can be used for short-term swing trading. So before I could answer that question in any honest way, I would need some guidelines. Okay.
Okay.
I hope I made some sense there. Okay.
Mm-hmm. Yeah. Thank you.
Okay. Well, the VectorVest composite and the market timing indicator. When the market timing indicator goes up through 1, and the market is traded up for 2 weeks in a row, that's our longest measure of the trend. It's called a confirm call. And that has in fact been in place since February this year. And this is our longest measure, called confirm calls. In the first few days of 2016, we had a sell signal, and the market sold off into February. And then we had our buy signal, and that buy signal is still in force today, okay, at the start of October. So Brexit didn't in fact cause that to turn. Now, we are in quite a dangerous position because the MTI, the market timing indicator, has got some excellent leading characteristics. And when it gets down to about 0.6, invariably, that's a good time to be looking to buy shares. And when it gets up to about 1.55, that's invariably a good time to, in fact, to be thinking of taking some profits or not being very aggressive in the marketplace. Now, in February this year, we had the composite falling to a low, but the MTI, in fact, couldn't make a new low and made a rising low. And that's what technicians call bullish normal divergence. And invariably, when we get a buy signal, which is preceded by bullish normal divergence, then that's a cracking signal. Unfortunately, at the minute, ladies and gentlemen, we have the mirror image of this. We have the composite rising, and as you can see, there's a fairly well-defined trend line here. The composite is rising, but the MTI cannot keep up. We're also in a very, very overbought area. I think that this market can easily go up a little bit further, and it can probably get up to the top of this trend line. And if that's the case, then we have a rising wedge, and we've got bearish normal divergence on the MTI, and I think it's a time to be very careful. For example, if we got a sell signal, one of these red triangles, which is preceded by this divergence, which is already 6 weeks old, then I think that that would in fact precede quite a nasty little sell-off. So it's a time to be quite careful. Okay, so this is our longest term measure of the trend. The short term measure of the trend goes back and forward, and at the minute for the last 3 or 4 days, oh no, close. That was timely. I forgot to plug the darn thing in. for the last few days, the trend has been up and up. I wouldn't be at all surprised if this gets up and touches that top, but then we would have this divergence and we would have this rising wedge, which is quite a bearish pattern. I'm sure the technical analysts would attest. So a situation where I think we need to be careful, and I wouldn't be at all surprised if the annual high wasn't coming in somewhere between now and the end of the year. Okay. So that's my best shot at that. It is a very confused situation out there. We have the American election, clearly the dynamics over the next day or two of this non-farm payroll thing tomorrow afternoon. And we have the American election coming up, and we have the whole concept of negative rates, which I can't quite get my head around, but nevertheless. Quite a tricky situation. So let's go a little bit further, and that's just what I've talked about in terms of the MTI. So I now want to do a little bit of a practical exercise in Unisearch. Now, has everybody heard of the Turtles? I don't know. The Turtles were a group of youngsters that were trained by a guy called Richard Dennis some years back, and in the early 80s, in fact. And Dennis had a very, very simple trading plan in that he just bought breakouts initially of a 20-day high. And these group of traders went on to make more money than anybody else in history, believe it or not. And I got to know one of them exceptionally well, a guy called Curtis Faith, and he's written some books about the turtle methodology recently. Now, at VectorVest, our philosophy is putting together the fundamentals and the technicals. And this is very similar to what a gentleman called Nicholas Darvas did some years back, and he wrote a book, How I Made $1 Million in the Stock Market. Simon, I don't know if you've read the book or not, but this gentleman was a dancer. And while he was dancing in Japan, he made himself $1 million in the 1940s and the 1950s. And he was pretty much doing what we're doing, in that he, in this case, bought a breakout of shares with good fundamentals. And he was doing a lot of the fundamentals by hand. VectorVest does it for you automatically. So what I'm going to do now is that I'm going to propose a very simple little search which finds opportunity if you like breakouts. Now, there are two ways to trade, folks. Find a trend and buy a breakout of the trend. It's not something I do that often, but it works. The other way to trade, of course, is to buy a pullback within that trend. And I personally tend to do that much, much more often. Sometimes the pullback, in fact, turns out to be something much, much more nasty, in that it just keeps on going. So I'm now going to put this, so the simple Unisearch is the first criteria, value divided by price is greater than 1.2. So basically I'm saying that I want the value 20% above the price. You good with that? In other words, I'm looking at finding shares that are trading below the VectorVest valuation. And secondly, I want to find shares that are making a new 50-day high. Some people use a 25-day high. So I want to sort those shares by relative value. Relative value is earnings potential. Now, this is an aggressive search because there's no relative safety here. These are momentum trades where we're managing risk proactively. So I'm going to go to the program now and do my best to do that. My son helps me with this, but I'm getting better at it. So if we go to Unisearch, okay, and just click on here, New Search. No. Okay. And I've got to put in date and time because that refers to whatever date I put in here. And the first thing that I want to put in, stocks, capital appreciation, and I want to go down to VectorVest fields, and pretty much anything in terms of the VectorVest metrics that you would ever want has been, in fact, done for you as a VectorVest field. and I'm going to say greater than or equal to 1.2. Right? And the second thing I'm going to put in is to do with price again. Price and the high of price, new high, 50 days. So this is going to find, every day I run this, if I only want to run it once a week, I could in fact, rather than putting a 50-day high, I could put a let's say an 8-week high, and that means I would just do it at the weekend. Now, and I want to sort this by relative value. There we go. Earnings potential. This is a very, very simple little search. Run the search, and this now finds all of the shares in the market that yesterday broke a 50-day high that are undervalued. Okay. And we can now look at them. Let's look at the top down to Sainsbury's. And I can pull up the charts, graph selected. First one is, and let's put up our valuation. There's the valuation. Okay, so we've got a little company called Eon, and it's broken this resistance level. But the really cool thing here, folks, is our valuation and this step input in earnings. So earnings, this company's gone from a losing situation to a profitable situation. VectorVest has revalued it, but the price still hasn't moved, but it's getting there. It's broken this big high, and clearly, if we look back here, the 50-day high is probably about there. And it's in fact broken a 52-week high as well, as far as I can see. So that looks something that I want to know about. Now, if this company, folks, doesn't break a new 50-day high today, then clearly it won't show up on my search tomorrow, so you need to keep careful notes. Now, my son in Johannesburg does nothing more than this. This is how he takes his position. There's the stop loss. That's the target. Okay, so we would be risking, in this case, bought in slightly above £2. The stop loss is at 178, so we're risking 20p. And the target is somewhere above £3. So we would be, that's a 5-to-1 risk-to-reward ratio trade. What does anybody know the company? I don't, but it's a trade. My word, it's a trade. Now, you could, in fact, put a filter into the search where you only want to look for FTSE 350 companies, for example, or you could certainly put a filter in of volume, which I haven't done, and that would in fact exclude all of the companies that are trading an exceptionally low volume. But this looks good to me. This looks good to me. All right, so I like this. I like to see earnings per share moving up, and this is invariably a good warning signal that something's going to happen. When you see a step input here, really, really good. Okay, this is money for nothing. This is Kennedy Wilson Real Estate, undervalued, and as you can see, it broke this little trend line. I drew the trend line in after the fact because I hadn't noticed it. Again, I like the earnings per share rising, okay, and it's broken here. If I take the value off for a second, as you can see, it's broken this 50-day high, okay, made a rising bottom in the process, and this is the first rising bottom for a while, and with the valuation and the earnings per share, that looks really, really cool. So I hope that you get as excited about this as I do. This company has gone from earnings of 75p to over £1.50 in the last year. So it's doubled its earnings, and clearly we can now, if you like the look of that company, we can now right-click here. We can get a full report. We can also go to Reuters. For example, if I right-click and I view stock news, this will take us into to the Financial Times automatically, and this will give us everything that's ever been written in this company. Profile, directors' dealings, and folks, this is a paid service of the Financial Times, which is a part of the VectorVest subscription. I think it's nearly £20 a month for it, so you get all of that with the VectorVest subscription. So directors' dealings, all the financials going back for a very, very, very long time. Okay, so if you want to do really, really structured research, it's all there for you. All right. So let's have a look at some more of these charts. That looks good to me. That really does look good to me. Here we've got JD Sports. Now, JD Sports, ladies and gentlemen, came out. I've been holding and adding to JD Sports for a very long time, since £5. And there's Brexit, okay? And then all of a sudden, when I did this research every morning, it actually just about there, it broke above a 25-day high, just there. And that was my last entry into JD Sports. As you can see, when you see a stop running exercise like this, then you know 9.5 times out of 10 that the thing's going to explode. This is, guys, creating liquidity here. If you're in the city and you want to get aboard, you can't press the little button as we can. You have to generate the liquidity, and clearly what happened here was that lots and lots of people had tight stop losses, and it just went down until all the people in the know were in fact filled, and then it went the other way again. As you can see, earnings per share rising, undervalued, breaking up through these highs, just relatively easy money, okay? Relatively easy money. This is Johnson Services, okay? Again, earnings per share is rising, significantly undervalued, and then it started to break out of this 25 or 50 a day high here, became a buy just here. So this would have alerted you that this thing was starting to move up somewhere in this area. That's a 52-week high. Dr. Leda, the guy who put this together, loves 52-week highs. My 50-day high gets me in considerably before this 52-week high breakout. So, and that is in about 80 going the right way. Okay. Again, this is a little drilling company, and as you can see, made a rising bottom here, and yesterday produced a new high, which was a 50-day high. That looks fine to me. Okay, worth looking at. And again, Waterman Group, earnings per share rising enormously, undervalued, making a new high, looks good to me. This doing exactly the same thing. So I hope you're impressed, guys, of the ability to find these little companies out of nothing. Sainsbury's made a new high. So, and that's how I would use this little search to find momentum trades quite easily. Now, I can in fact decide that I only want to look at filter by watch list equal, and let's say that I just want to look at FTSE 350 companies. Put that in there. Just do the search again, and that in fact gets me down to 1 to 6 companies. Now remember, a company can easily make a 50-day high and then be still in a wonderful position and go off this watch list tomorrow. So it gives you new prospects to keep your eye on, and it does that by putting together both fundamentals and if you wanted something to give you solid trades and new trades every single day, then this will do it for you. Okay. Any questions about momentum trading and turtle trading? There's JD Sports, as I say. That was my last entry level just there, based on this one technique.
David, There might be some questions coming in now that we've asked for them. What about the size of account? Would you need a certain size of account to use the VectorVest portfolio? Andy's asking.
Well, I think that it would depend very much again on what you want to do. If you want to speculate in these momentum trades that I talked about a few minutes ago, then I think you could do that with a very, very, very small account. If you wanted to take build wealth slowly by position trading in FTSE 100 companies, then I think that you would need a much bigger account to give yourself a spread of 10 companies. Okay, but you certainly could make a start with some well-engineered momentum trades with an account with £5,000 to £10,000 in it, and have half a dozen trades.
What about the length of time? Paul's asking, how long does this search take? Paul, what search is that? Is it the one you've just been discussing, I think?
Well, I've just done it in seconds.
Mm-hmm.
That was the process. Now, I would in fact have this search. I wouldn't have to write it every time. I would just simply save this search and save it in, let's say, aggressive, for example, and then all I'd have to do would be click on it, and it's up there straight away. So it takes seconds to do.
Is that fast?
Yeah. Yeah. Seconds to do. I've written it from first principles today so everybody could see me writing it, but you would just save it and then just click on it. It takes seconds to do. You don't have to do it every day, but if you wanted a list of new possibilities in the evening to action the next morning, then by all means a second or two in the evening, and the program will give you shares with excellent fundamentals that are rising.
Fantastic. Yeah, Paul. So using the software to search for tradable stocks, search already. That's great.
Okay.
Okay.
Now, the last thing that I want to talk about, and I'm running out of time as normal, is using the.
David, sorry, but we don't have to finish on the hour if you need some more time.
I won't run over too much, Simon. Maybe 5 minutes at the most.
Yeah. No sweat.
I don't want to wreck everybody's tea time, but there are two ways to trade a trend. One is to, in fact, buy a breakout, okay, which I've just talked about, and that little search of mine will find those breakouts. You could decide to a breakout of 25-day high, 50-day high, or do what Dr. Lido does, very long-term breakout, which is a 52-week breakout. I like to get ahead before that. Now, the other way to trade a trend is to buy the pullbacks. And I've talked in your webcast many times about my method called lost motion, which is to buy a pullback. And I've set up a search to find those. So again, I want to trade in shares with exceptional fundamentals. I want to trade in a market that's rising. I like that the share pulls back and takes out a major low. Here I've written a 21-day low at least, okay? And then wait for a reversal, and then look for a move to the last significant high. Okay, so rather than waiting for the market to break out, we would do our best in quality stocks to get in well before the breakout. Okay, so my 5 rules. First of all, it's hard to do. That's why it makes a lot of money. The good trade is a hard trade. When the market is pulled back, then it's difficult to get in because we're full of doom and gloom. For example, when JD Sports pulled back after the EU, it was difficult to get in there. Just not difficult, emotionally to do, because we thought the world was going to fall apart. I fade the short-term trend in the direction of the long-term trend, and I define the long-term trend by the comfort index. So I like to buy pullbacks in shares with a high comfort index. Number 3 is my favorite rule. I put my entries where the masses place their stops. Okay. I only trade long in the very best shares. These have got the best combination of earnings growth and earnings safety that I can find. And loss motion in sync with the CI when the overall market is showing green lights on the color guard rarely disappoint. So, again, we have a little exercise to find these without a great deal of ado. Some days there's lots of them, some days there's not that many. If the market's very strong, there's not that many of them, and the market has been very strong. However, if we've done this towards the end of June this year, it pretty much encompassed the whole market. So here's the search. Again, value divided by price. I'm looking for a share that's intrinsically undervalued. In this case, I'm looking for a share to make a 50-day low. Again, more aggressive investors can use a 25-day low. And this case, I put the CI in. The CI should be greater than 1.3. I'm buying a pullback. I'm not buying a breakout. So I want the long-term trend to be at my back. And when I do that, I get noticeably luckier. Again, I'm going to sort by RV. So let me go out of the program and write that. Now, this, folks, I would have this search, in fact, pre-written and put into one of these little boxes. All right. So, but I'm going to write it now just to show you how easy it is. So, no, I don't want to save that because I've already got it saved. So we go time of search, parameter, stocks, capital appreciation, CI is greater than equal to 1.3. And that finds shares that are in the throes of a strong trend with little volatility, and the fundamentals are getting better. So by using CI, I've found some really cracking shares that are trending well. Then time of search, and we go back down to the VectorVest fields, and we go back down to value divided by price. It's greater than equal to 1.2. And then we go time of search, stocks, price, days low. Makes a new low. I'm going to say 50 days. So this is now finding me, and I want to change the sort to RV. Earnings potential drives the share price. This was Benjamin Graham said that earnings per share growth is the engine that drives the share price. So if I run that search, again, I'm looking for a share in the throes of a really good long-term trend. It's trading below its valuation, and it's in fact been sold off and made a 50-day low. Run the search. 2. Polymetal and Tarsus Group. That's all in the whole market. The market's very strong. So I've already been looking at these folks, and I'm waiting. There's Polymetal. As you can see, I'm sitting waiting for it. All right, so it has to turn for me. It's undervalued, growing earnings. This is a gold miner, Russian gold miner, as you know. I'm going to take the value off so we can see the screen a little bit better. And it's pulled back in a pattern. It's taken out this low, okay, taken out that low, and it stopped. The low yesterday was at 618 of the last range. Now, there's nothing to do here until we see a reversal bar. But I am looking at that, and I could also wait for the VectorVest recommendation to turn back to hold, to buy, okay, as it did here. There'll be plenty of time, but I've immediately found a high probability pullback, and there's not that many of them around. So I like this, and I'm watching it. I'm not aboard yet, but I'm thinking about it. I love this Gartley formation. I wish I had another day to actually talk you through H.M. Gartley's work written in the 1930s. By the way, does anybody trade the pound against the dollar here? Well, the pound against the dollar on a 15-minute chart made the mirror image of this morning and then fell 100 points. So this is a bullish Gartley, and the pound against the dollar, if you look on a 15-minute chart, made a bearish Gartley this morning, and it fell 100 points. A cracking trade this morning. My Gartleys rarely let me down. Harold McKinley Gartley, one of your countrymen, Simon. Okay, so really looking at that. Now let's look at the next one. Taurus Group, look at this earnings per share, rising nicely. And the one thing that I notice about this is that there's fibs at work, because if I go from this low to that high, that defined that bottom to the tick. Now this technique would have shown this share pulling back through that 50-day low, and then all of a sudden you get reversal bars and away it goes again. Now, I would suspect, ladies and gentlemen, that we're going to do the same again. Normally, if a market reacts to the fibs once, it'll pull back again. And I would suspect that we're going to pull back a little bit further, somewhere down into this area. It's already taking out these lows. Easily take out that low, and then a reversal, and then the ball is in. Okay, look at this. When you see a step like this, this is moving, and now we would have a potential of a trade with 20 or 30 pence of risk with all of this upside. And low today, there's only 2 shares come out of that particular search. If you run this search every day, you're going to get plenty of pullback trades in shares with great trends that are undervalued. So you've got a choice to make in your trading plan. Are you in fact going to buy breakouts, or are you going to in fact wait for the share to pull back? And maybe you do both. Okay, I certainly do both. Okay, I'm happier buying pullbacks. That is a little search that will find those for you automatically. Again, you could put in to the search criteria that you just want to do this on FTSE 350 companies if you were in fact spread betting. All right. So what I've tried to talk you through today is that's polymetal and the Gartley that I talked about earlier. What I've tried to talk you through today is the edge of VectorVest, which is the ability to find shares with outstanding fundamentals that are trending when the general market is rising. You've got a choice. You can buy the breakout, or you can wait for the pullback, and I've shown you how to write 2 searches that will find shares that are breaking out above, let's say, a 50-day high, and shares pulled back and have in fact gone down below a 50-day low, where the long-term trend in fact stands a high probability of reasserting itself. And I'm so confident in the process that I'm more than happy to allow you to test VectorVest UK and VectorVest USA for 5 weeks. It's going to cost you a whopping great £5.95. Then VectorVest is invoiced on a month-by-month basis. It's £44 a month. If I can't make you money, then you can stop it anytime you wish. This includes full access to the 5-week VectorVest Quick Start course, which will show you how to actually find your place in all of this. And that's unfortunately where you need to find your one little bit in this. And it includes full access to the VectorVest University. So Simon, I think, normally puts the code into the chat box. It's vectorvest.co.uk/RTC. And that's £5.95 for full access for 5 weeks to both countries.
Yes, David, I've put that link in there already, so We should have that. Keith was just asking what training is available to use the software, since it's obviously quite extensive. And
yeah, let me show you the training, Keith. If I go into training, first thing that we can see is this 5-week course, which, as I say, shows you syllabus is how to analyze any stock in 30 seconds. All about losers, how to get rid of losers, how to actually get money management in place. The third lesson is all about market timing. The fourth lesson is all about how to cherry pick the very best stocks that suit you. And again, in that we would use Unisearch. And then the fifth lesson is all about how to actually put together a management plan. Now, if we go down a little bit lower here, and we actually go into the VectorVest University itself, and this is much more product specific. An overview of the product. The home page is a video that'll show you all the facets of the home page, the viewers, charts, Unisearch itself, how to get the portfolio manager to do what you want it to do, and how to look at the back tester, for example. So all of that is handled in a great deal of detail. And the other thing, of course, is that at VectorVest UK, we have an 0800 number which gets you through to our call center. It's a free call, and that call center is open from 12 midday to 12 o'clock at night, 5 days a week. And any problems that you have, somebody at the end of the phone to take care of those. I run bi-monthly webcasts. I've got one coming up on Monday afternoon, and we have user groups around the country, and we're rolling out our user groups. We've got a really good one run by Susan Thornborough, and one in Guildford, one in Oxford, one in Bristol, one in Manchester, one in Belfast, one in Dublin, starting one in Edinburgh, and starting one in Birmingham before the end of the year. But the very first, if you've made your way through all of this, and if you have any problems whatsoever with anything on VectorVest, you pick up the phone, and there's a young man or a young lady on the end of the phone who will help you straight away. I think if you phone at about 3 o'clock in the afternoon, 2:30, when America is wakening up, you could maybe go into a queue. But if you phone at 12 o'clock, till 2 o'clock, and then from 4 o'clock till midnight you go straight through. Okay.
And he's asking how long each session is, each lesson. I think that must be the quick start course lessons.
Yeah, about 20 minutes, 25 minutes.
Mm-hmm. I mean, I think from my own experience, I remember presenting these seminars, this was something that came up quite a lot. David, you probably find it as well. At initial viewing, one might be tempted to think that VectorVest is a complicated program and that you need to be quite clever to use it, but in fact it's not. It has an incredible amount of information there, but you can start with it very simply, just using the very simple indicators like the color guard, and you don't need, just because it's all there, you don't need to be using it all the time. I think
it's a massive toolbox full of tools, and you're quite right. It would probably be easier to market if there was less in it, to tell you the truth. But there's something in it for everyone. It doesn't matter what investment style you want to take. There is something in VectorVest that would allow you to, in fact, get on with that. I think that if you just look at this, these two words summarize the short-term trend and the long-term trend, so that you can keep under control in a few seconds in the morning. We know today the short-term trend is up, the longer-term trend is up. And then if you go to viewers, you'll find all of the shares, in fact, rated by VST, and quite honestly, the winners are in the top 20. Writing a search may sound, may look complicated, but even I can do it, and I am not that great on computers. As Simon says, you only you can be very, very profitable only using a little bit of it.
What about shorting shares, David? Is this something that comes up on the seminars? People use the tool to look for overvalued, because we talked about undervalued shares. Is this something?
Well, yeah, by all means. I think that if the market does keel over and we get a confirmed down, then the only way to make good money in the market then would in fact be to short the market. Now, if we go to Unisearch again and we look at searches short, there are in fact all of these searches which actually do exactly what you said. They're actually looking to try and find shares with ghastly fundamentals that are falling. IG plungers, last hurrah, mini rocket short. And in the training, certainly there's as much talked about shorting the market as going long with the market. Okay. The market this year has been rising, so we haven't had a great deal of use for these. But certainly, I remember the London User Group run a portfolio, and in 2011, where we had the Euro crisis, and the market was falling for 6 months during the course of 2011, until Draghi stood up and said he would do whatever it takes. They made more money on the short side in 2011 than they did on the long side. Mm-hmm. So yes, if the market does keel over, then there are pre-written searches, and with any luck by that stage, you'll have the experience to write your own, if you wish.
And of course, one of the things I think people also enjoy was the transparency of it. There's no refitting of prices. It's there all the way back to, when have we got back to
about 12 years worth of data in the UK. In America, there's 20 years. Mm-hmm. Now, these signals don't repaint, I think is the word the Americans use. There's the year, and we put on the confirmed calls. That was one at the start of the year. And these, it doesn't matter what the market does or how ugly the price action goes, these just don't fit. And as you see, there was a bad signal there. There was a buy signal and a bad one there, so they don't repaint. I remember a lifetime ago, I bought myself a piece of trading software. I thought I was going to get rich in a day or two, and in fact, I got most upset once upon a time because there was a similar little green triangle on that software, and I bought the share, and then the next day when I looked, the green triangle had disappeared. It had repainted, so it always got it right. This was a long time ago, and I was quite naive. More naive, should I say, more naive than I am at the minute. But I'm a little worried about this market, ladies and gentlemen, and it's a very strange environment. I think everybody in the room has had this happen to them. Simon, are you listening?
Mm-hmm.
Simon, lend me £20,000, would you?
Yeah, sure, David.
Okay, well, that's happened to everybody, hasn't it? Somebody's wandered up to you and said, big smile, and said, lend me 20,000 quid. That's happened to everybody here. Whether you've given it to them or not doesn't matter. But Simon, here's the crux of the matter. Simon, lend me £20,000, and Simon, I'm actually only going to charge you £1,000, so to give you the benefit of lending that £20,000 to me. So please send me a check for £21,000, would you?
Yes, I think I know where you're going.
That's what's happening in the market at the moment. In that, in Germany, certainly in Japan, exceptionally capable people in the bond market are lending money for 50 years. And they're actually paying the Germans to hold on to that money for them. And I struggle to get my head around that myself. So I really do. So I don't quite understand that. So it's bad enough having lent somebody some money, but if you had to pay them for the privilege of lending them some money, that I just can't get my head around that, Simon. My Presbyterian nature can't get my head around that whatsoever, I'm afraid.
It's uncharted waters, that's for sure.
But the central bankers can keep it up for quite a long time. But certainly a sell signal from the VectorVest composite, one of these little red triangles, which is preceded by this brute of a divergence, that would be that. I'm not saying a crash or anything, but I'm talking about a fairly tradable pullback where you would be best short, or if you weren't short, you'd be best with a sizable part of your portfolio in cash. Market timing is everything. Everything follows from knowing whether the market is rising or falling.
Whether we're in a bull market or a bear market, I know there's reminiscences of a stock operator echoing in my head. It's very good, and of course the line, of course, that emphasizes the point that retail, ourselves, private investors, somehow we want to, we'll take risk, we'll risk more on a losing trade than we will. We're less risky on winning trades. Is that not what we used to?
That's right, yeah. And we get sucked in at the top and we get spat out at the bottom, I'm afraid. Took me a long time to get that right.
Around. Yeah. And scared to take profits. Oh, fantastic. David, thank you very much indeed for coming back, joining us again today.
Pleasure, Simon. Thank you for having me, and I hope that everybody enjoyed the presentation. And
just to remind us, when is the next group? I know you're coming to speak at our Round the Clock Trader Live event on the 5th of November.
We're at the Investor Show in London next Friday, the 14th. We're there the whole day. And then we have a seminar in London on the Tuesday after that, which is the 18th of October.
Fantastic.
If you go to vectorvest.co.uk, you can register for that seminar.
If you go on to the trial now, you could be on the trial now to make sense of it before you go along to the user group.
Well, yes. If you take a couple of weeks' experience now, then you can ask some much better questions at the seminar, or even at the investors seminar next Friday.
Next Friday. Well, I'll be there as well next Friday, David. So
okay,
nice to
you can lend me that. Bring that £21,000.
Well, I have it in my back. David Paul, VectorVest. Okay, always a pleasure. Thank you so much.
Cheers, Simon. Cheers, everyone. God bless now. Bye bye.
Bye bye for now. There we go. Thank you to David for another excellent presentation on how to use VectorVest to manage your portfolio. That brings us up to 3:20. We are just over half an hour away from our final presentation of the day, Stephen Goldstein, who is coming to talk about how to avoid emotional hijack, emotions in trading, and how to avoid the emotions getting the better of your trading. So trading psychology webinar coming up in just over half an hour, starting at 4 p.m. here in the UK. So we will take a short break until we start again at 4 o'clock. Many thanks.
Right, have you got that? Can you see the screen okay?
I can see the screen. Great. I can see the brain and and the computer monitor. Can we ask everyone at home just before we start, give us that little yes or something in the chat box just to know that you can see. Wonderful, Jeff. Thanks very much.
Okay.
So I'll hand over, Steve, to you and let you take it away.
Thank you, Simon. Thank you, and thank you. Welcome, everybody. Just to reiterate, that brain in the screen there is nothing like mine. Mine is considerably smaller than that. But there's been a lot of big brains over the last few days on this week run by Simon. And I know you can't answer me, Simon, but I think you've done a brilliant job bringing together some fantastic speakers and people. And yes, I know Carol very well, and you know, I highly recommend anyone who's got any serious ambitions about developing their trading to consider both following Carol as a technical analyst and also perhaps looking into any of her courses. She's more than just a technical analyst. She is literally a market guru. She understands the emotions and the way markets work. And I don't know if she's listening today, but if she is, maybe she'll give me a thumb up later on. Yeah, and actually, I've just looked through the list of some of your speakers, and yeah, you've had some real top quality on there, and you know, I just hope I could do justice to follow up on those. Where am I coming in on this from? What is my angle? To those who are new to who I am, just a quick overview. I'm no longer a proprietary trader now. I was a proprietary trader for pushing on close to 25 years. Actually, that's not quite true. I wasn't a proprietary trader all that time. I was a market maker. I was involved in arbitrage in a role, arbitraging between different derivative products. But I had the best part of 25 years working at some of the financial markets, leading banks in FX rates, fixed income. And actually, when Simon just sort of reminded me that tomorrow is non-farm payroll day, it takes me back to every first Friday of the month whenever I was a trader. And it was always the best day to be in the markets as far as I was concerned. It was a day when you knew there was going to be a lot of action after 1:30. And you know, now I'm not trading. I always slightly miss non-farm payroll day. I am now a coach, as you can see from there. I work with traders. I'm a performance coach. I'm an executive coach. So I work with managers as well, and I work with teams improving performance, or sometimes working with teams in the sense of helping them work more collectively together to improve how they function. But I primarily come at this from a person who's been involved in a trading role for most of my life, who's a risk taker, although perhaps not a natural risk taker, as many people would think. More someone who developed my risk-taking skills over time. As a coach, I work with lots of traders. I work from across asset management classes. So you know, I work with people in the energy trading business. I work with hedge fund managers. I work with credit traders, although there's less and less of them these days. Rate traders, commodity traders, FX traders, which is probably the largest group I work with. But I cover everything. And just to give you a sense from that, I don't work on a particular market. I'm not a technical skills trader. I'm not telling people to do it this way, to do it that way, to use this system, to be systematic or fundamental or momentum. Whatever method, whatever approach they use, it doesn't matter. There's a million ways to skin a cat, and there's a million ways to succeed in trading. I'm not going to say one way is better than the other. I think it's whatever suits you as an individual. You know, again, whether you prefer to be systematic, whether you prefer to be discretionary, you can make markets in you can make money trading successfully in any market if you use the right product or the right approach for you. Not necessarily the right approach. I wouldn't say there is one. So what am I going to talk today? I'm going to talk about emotions. I'm going to talk about how traders, how they affect traders, negatively and positively, actually. There is a feeling that emotions are a bad thing to have in trading, but it's a little bit, it's a silly thing to say because we all have emotions and we don't choose them, they choose us. and emotions are as hard to shake off as it is to shake off your shadow when you're walking along on a sunny day down the street. It is there. Don't try and hide them. Don't try and turn them off. They are part of you. If you're trying to do that, all you're doing is you're fighting with yourself. Which kind of leads me nicely into where I am and you know, the subject today. So as a coach, I consider myself someone who works on solutions, on helping people to solve a problem or to overcome a challenge, to overcome a particular hurdle they have. I don't try and fix them because that assumes that they're broken. And you know, I don't think anyone is really considered broken. In my opinion, if they are, then they need to see a psychologist or a psychotherapist. People aren't broken; they just have challenges, and it's incredibly hard to succeed at trading. It's one of the hardest things to be successful at. You know, I'm thankful I worked within banks, which gives you quite a big leg up into a trading career. You've got a huge support network behind you. You've got the flow often on your side, and you know, you have a lot of insight. You're working with good people who are mentoring you. It is a lot harder to be a private trader. I know that, and I've come to respect private traders far more, having become a coach. I work with quite a few private traders, and they really are the titans of trading, if you don't mind me saying. You know, no disrespect to banks and hedge fund traders who often earn a lot more money, but you know, having done some private trading myself after my career at banking, and then having worked as a coach with them, I realised that these guys are the real deal, the real heroes. But it is incredibly hard. I'm not going to beat about the bush. There is a common misconception that 10 to 15% of private traders are successful in their role. But when this actually was tested by some very smart professors from the field of behavioural finance, who were able to get something like 15 years of data available to them from day traders and short-term traders from, I think it was a Taiwanese stock exchange, they found that that less than 1% were actually able to achieve the sort of level of success that was able to sustain them in a career. So I don't use that to scare anyone. If perhaps in a year 10 or 15% make money, it's not the same 10 or 15% every single year. And then just making money is not enough. You've got to have enough to live on. You've got to have enough to outperform any alternative investments you could have that are less risky. So say to be successful is very hard. You have to reach the pinnacle of your career. You have to reach the top echelons. You have to become excellent at it. That's kind of what I'm saying. And services like this, which Simon's offering, and listening to some of the excellent speakers, the people who have been there, who have done it, who've worn a t-shirt and got the bruises, is something which I advocate for everyone to do at various times. Reading books about trading to improve your knowledge and experience helps. Finding systems that work for you, programs that work for you helps. But those alone are not enough, because they don't actually teach you how to manage your emotions. Now, again, you know, there is a degree that is sink or swim, but you can improve your emotional management. It's one of the things I do as a coach. It's not the only thing. Not everyone comes to me and says, you know, I've got problems with my emotions. Actually, people come to me, usually have already proved themselves as traders. They've been successful for a time, and actually they want to finesse their trading. They want to fine-tune their trading. They do want to improve how they manage their emotions, how they manage risk, because the management of risk is inextricably linked to emotions. Too much risk, and your emotional sensitivity will turn up, and you'll end up cutting out of trades which you might have liked. You know, not enough emotion, sort of trying to turn off your emotions, which is hard, but fighting with yourself can become a problem for some traders as well. Emotions provide an awful lot of input. So what is it they come to me? What is it when traders come to me for? So like I say, you know, they come to me really to learn how to succeed or to how to be more successful. Some people are surprised by that, but don't be. It's a little bit like if you were a sports professional. The higher up you go in the world of sport, the more coaches you have, the more you are offered by your sponsors, your backers, the people who are behind you. You know, it's become a big profession in sport. It's a growing profession in business, and it is starting to move now into the world of trading, although very much on the edge. Very few people actually ascribe to a coach. I mean, I'm not going to pretend that it's cheap. It's not. But it's one of those things. If you want to really develop yourself, you have to invest in yourself. As far as it goes, it's probably the most expensive investment that you might make as a trader, relative to compared to your actual trading. But it's probably the one that can lead to the greatest leg up. And a lot of my clients have actually, you know, they come back to me and they said it was the best thing they did. I had coaching myself in 2001. Quite fortunate it was paid for again by the bank, by my employer that I work for, the bank I work for. But I saw the value of how it can actually change you, how it can enable you to grow significantly, enable you to become much more in control of yourself. So what is it that, you know, in a sense, I'm going to take you through, not a coaching session today, but I'm going to share some of the experiences that I've had as a coach with my traders. What are the things we talk about? What are the common themes that come up? Now, going back to the context of trading, the solution that people come to me as a coach is how to succeed in trading, how to be better as trading. So I want to set some context here a little bit. There's two main problems for traders, or two main challenges. There's two main opponents. There's one is the market. You have to beat the market, which is why you have the screen in front of you and you analyze the prices and you find you're looking for value and you use the various tools and systems you have to try and identify value and identify opportunities, when to enter the market, when to exit the market. And the other side is beating yourself. That is the biggest hurdle, actually. You know, there's a lot of people that learn to trade that are very good at analysing the markets, very good at finding opportunities. Actually, most people that I speak to call the market much better than they trade it. And the difference is overcoming yourself. Some people call it overcoming emotions, overcoming your ego, overcoming your insecurity. It's all linked. It's connected to your central nervous system in some way. And I'm going to use an example to try and exemplify this. So what you see in front of you here is a real case of someone I coached a few years ago who was a trader at a hedge fund. His name wasn't Alex. I've changed the name for the sense of discretion. He worked for a very large European hedge fund. He was poached by them. He was a very successful trader at a bank. He'd been at the bank a number of years and was achieving some staggering performance every single year. He was what they called a big swinging dick at the bank. Wasn't his character, but that was, his character wasn't like that at all. But that was perhaps how people would have termed him. He was bringing in some huge P&L in the markets he was trading. He was a very diligent trader. He kept a record of everything he did. He kept a journal. He was very self-aware. He understood the role of perhaps of trying to sort of manage his emotions in with his trading. But he left the bank and he went to the hedge fund. And he didn't realise, perhaps until he joined the hedge fund, of how much the support network he had at the bank behind him, of how favourable his situation was. Now, when you go to a hedge fund, you're largely on your own. It's got a lot of similarities between being a private trader. Maybe you work in a team at a hedge fund, slightly different, but by a large extent you are on your own. You have no flow coming your way, and so you're facing the same sort of challenges. So Alex, like I say, he kept a record of everything he did, very diligent, and he kept two records. He kept a record of his virtual performance, and that was the equivalent as if he was trading without using money. So what would, you know, he would decide what he wanted to see in the market, how he wanted to call the market, what trades he'd like. He would decide how much size he wanted to put on, where his stops would be, where he would like to exit the market. There were a few what-if scenarios if conditions changed. And then there was his actual performance. So you can see in front of you a summary which he gave me of his virtual performance, of how he should have performed if he'd have followed everything he said he was going to do, and how he actually performed. So in his first year, his virtual performance was 37%. Had he literally stuck to his guns on every idea he had, he would have returned 30% on the assets under management. Now, I can't recall how much the assets under management they gave him were, but they were pretty sizable. So that would have equated to a very large P&L if he'd achieved 37%. He came in at 9.1%. That wasn't terrible, it wasn't shocking. His Sharpe ratio, which if you're familiar with that, wasn't as good as it could be. It was, in terms of this particular hedge fund, it was a mediocre performance from an individual there. I think he thought that, you know, most years his virtual performance and his actual performance were a lot closer than that. But he accepted that was his first year at the fund and that over time that should improve. Now the second year, you can see his virtual performance, how he called the market, how he decided he wanted to trade theoretically in that market. Brilliant performance, 68%. His real performance, though, compared to that, was absolutely shocking, 3.2%, with a very inferior Sharpe ratio. And again, the next year, his virtual performance, strong, still very strong. If he'd have come up with a 29%, in reality, it would have been brilliant. But actually, his real performance was 4.7%. And at this hedge fund, all those performances were very weak. So he was coming in close to the bottom 25% of their portfolio managers, which wasn't good at this hedge fund. They were starting to ask questions: does he have a future here, etc., etc. And someone suggested he should see a coach, and fortunately, my name came up. So I sat down and I when I speak to these guys, I do some analysis of their performance. I do some analysis of their personality. Some feedback from maybe a colleague who works with the guy, who knows with the guy. So I've got some objective feedback. And then we ask him to complete a questionnaire about his views on trading, strengths, weaknesses, where his opportunities lie, where his threats lie. It was very clear what was going on here. Something was affecting his actual performance, his ability to transact, stick with what he was doing. So it was an emotion. It was emotions. That's what it does. It was, you know, that you can't get away from it. You know, he wanted to put on a particular position. It sounded like a great idea. He'd stick with it as it went offside, and then he'd get a little bit nervous and he'd start to hedge it. He'd start to hedge it before it got to his stop level. So if you're a day trader, you know, he wasn't a day trader. His views were typically played out over several weeks, sometimes to 2 or 3 months. But he would, you know, he'd get to his line, and he wouldn't get to his line in the sand, and he'd hedged it. He'd hedged his bets. I'm sure some of you are familiar with that. He maybe even had cut the position to think, you know what, I'll get in somewhere else. I'll wait for it to get to a better level. Or he tried to anticipate the stop. And quite often his calls were right. The stop wasn't triggered. And then he missed the market on the way up. And he was at a far less opportunistic risk-reward scenario. Risk-reward was always a big driver in how he traded. And then he'd go in. He was feared that he'd missed that move that he originally called. So he would put the trade back on. And because it now wasn't a trade that he'd planned, it became a little bit erratic. and his emotions were fired up. They weren't calm. They weren't part of his planned process. And then as the market moved against him, he would get nervous because emotions were playing hell with him. They were hijacking his thinking, and he would end up getting out again or hedging it again, and then it would take off and move in a direction he had. And I don't think there's a trader in the world who can say they haven't experienced that many times in their careers. But this was happening far too often. This wasn't part of something that Alex experienced with the same regularity in his previous role. So worked with him, you know, sort of made things implicit, which weren't, which perhaps made things explicit, which were perhaps implicit. Now I won't take you through Alex's whole coaching, but I'm using this to try and draw an example of how emotions throw us off balance, how emotions disrupt our plans, how they are a very big part of what we do within our work. Now I'm going to share today, we've got an hour. I'm going to talk maybe for about another 5-10 minutes, 15 minutes, sharing some other experience which trying to exemplify this, and perhaps to also put it into a certain context that might be useful to you, useful to the audience to think about with your own trading. So I'm going to share a few stories which I'm deciding to take from some of the guys I've worked with this week. So I've seen 8 different traders over the course of this week who are part of the coaching program that I'm in. The coaching program runs pretty over a course of the year, and I probably see them about 6 to 8 times, maybe over a 6 to 8 month period, once a month typically. Those vary from role to role, coaching to coaching, but that's a typical performance. So I've seen 8 different guys this week, and it's funny because I thought about them before I came in today, and how many of them were actually related to emotions in some way. Just to give you a sense of the depth of people I was trading, I would say the average guy that I was coaching this week, or girl, there was some females in there as well, some women who probably about 10 to 15 years trading experience. One of the guys has been trading 25 years. The newest guy was 4 years into his trading career within that. And like I said, there's a lot of talk about emotions. It's a theme which runs and runs and runs through what I do. So I was coaching someone this morning who was telling me about he's on a very poor run at the moment, and he started to doubt himself. Doubt is a very strong emotion, and he said it's causing him to question himself a little bit, and to question whether he's good enough at the job. He is good at the job because he's at one of the world's largest investment management firms, and he's been there about 15 years. But it puts that doubt. It's putting that doubt into his mind, into his head. And I raised a quote to him, or I put a quote to him this morning when we were talking about that, and it goes along the lines of that doubt kills. Do you know what I'm trying to think? Just for a second, I've forgotten what this particular quote was. That's typical of what happens on these sort of things. I've got doubt kills more dreams than failure ever will. I knew I'd written it down somewhere. So that's a very common thing. So he was doubting himself. So I was talking with him about, what's going on for him at the moment, why this is happening. And this has been a feature of his trading many times over many years. He hits a rough patch, then he starts to question his ability. So I talked about this whole element, this whole idea of luck in trading, because there is a lot of luck. It doesn't matter how much we think about it, there is a process going on. We can't help that. So you can be a very good trader and have a very bad run, and you can be a bad trader and have a good run. What happens over time, though, are good traders tend to succeed. It's the long game. They will always come through. And bad traders, unfortunately, will go by the wayside. It doesn't mean they're not smart guys. They might be the most brilliant guys at analysing the markets, but they're not so effective at monetising those calls, monetising risk. Trading is all about monetising risk, emotional management, being able to deal with the swings and the fortunes that luck sends us on our way. So I talked about an analogy with this particular individual, and the analogy is about poker. And I bring this in from, I don't know if any of you have heard about Michael Mabussan. He's written a brilliant book, a very smart guy, and I'm going to recommend it to people, The Success Equation. It's a theme he talks about, the role of luck in life. That the book's more about, wasn't specifically about trading, although Michael Mabussan is an economist for, I think it's Credit Suisse. It's a brilliant book. He talks about the role of luck and chance in life, in everything we're doing. And that's a theme which I've actually focused on often in trading for many years. And I go back to one of the guys I coached about 5 years ago, who worked for an American bank in Hong Kong. And we spoke about poker a hell of a lot during his coaching program. Part of the reason was, and I only found out later, that he is actually one of the world's best poker players. He was in the world's top 250 poker players at the time on the World Poker Rankings, and he was a full-time market maker for an American bank in Hong Kong, which, when you consider that most of the guys in those top 250 were pro players, he used to go across to Macau regularly for tournaments. He took the theories of poker into trading. It was very similar to him, almost the same, in one and the same in effect. And he would say to me that, there is a lot of luck in the game of trading. The luck is how the cards are dealt. And you can be the best poker player in the world and get defeated on a hand by someone who's a very poor poker player, and the same across a game. You could lose to someone who's a novice, who's never played the game before, and you could be the world champion because of the role of luck in the distribution of the cards on that day. But he said that over time, the good poker players come through. And in a sense, I was reminding the guy this morning, who I was working, that there are always going to be patches where you're going to lose money. There's nothing much you can do about it. If you were to look at the distribution of winning and losing over your history, you can't win without losing. It's just a fact. You're engaged in risk, and you have to accept losses. So what I'm talking about is one of the things with emotions that gets an awful lot of people are they struggle with losing money, they struggle with the uncertainty, they struggle with believing they're less than perfect because they haven't won. And like I said to the trader this morning, you have come through over many years and proved yourself successful, and you have to remember that, particularly when you're going through these bad runs. And these bad runs are part of, they are part of your overall career, and you're going to get them again, and you're going to get them in the past. The important thing is not to let them distort what you do, because that's when it starts to go wrong. That's when it starts to affect you. That's when you get into that downward spiral as a trader, when your emotions start playing hell with you and havoc with you. One of the things this poker player shared with me was that one of the reasons why he was so good at poker compared to a lot of his the guys he played regularly with over time was that he was a much better loser than them. He said, I'm not necessarily a better card player than them. He said, I don't know the probabilities of the hands any better than any of them. He said, but if I look over time, what they do is when they're having a bad run, when the cards aren't, when the cards are coming up badly, they are going to affect your emotions. You know, this is the point. We're not robots. We cannot turn off our emotions. When emotions start to play havoc with us, they do then affect the decisions we're taking. That's part of it. Like I said, our emotions are part of you. But, and this is the point, right? He would say, do you know what? I'm walking away. This is not happening for me. If I carry on playing today, it might turn around. But the likelihood is that with my emotions imbalanced, I'm going to start playing a few bad hands. I'm going to start playing hands I shouldn't. I'm going to start losing the plan. I'm going to start losing the roadmap. I'm going to start going against people who've got an edge at me because they're sitting with a big pile at the moment, and they can afford to maybe just take a few risks that I can't quite afford at this moment. So he would step away. He said that's what he was really good at, walking away from the table when others wouldn't. Maybe an hour into a game, maybe 90 minutes into a game, he would close up. There was no reason that he had to finish. He might have gone there to be there for 4 or 5 hours, but that's him. He's walking away. No shame in it at all. And he said that's what a lot of the other guys who are really good card players when they're up couldn't do. They had to play. They had to carry on. And he said you could see them, and he said you could feel their emotions that they were struggling when they were struggling. And when he was having the good hands, he would play on that, and he knew he could play these guys. He knew some of them were going to play bad hands. He knew some of them were going to play desperate hands. He knew some of them were 90% bluffing because they were doing a Hail Mary type trade with what was left of their pile. So it gave him a massive advantage. But he said it was the walking away that really helped him. So I was sharing that with a trader this morning. I was saying, one of the things, and a lot of, most great traders will recognise this, is that ability sometimes to just say, do you know what, I'm stopping. I'm walking away, I'm not going to trade for a few days, or I'm going to reduce my size down to a very, very small size so it's not an emotional level, and I can get back into the groove, back into the rhythm slowly. And then once I do that, I can start upping risk. I remember reading Market Wizards many, many years ago, and I can't remember who the guy I interviewed, who was on the interview at the time. It was a very big futures trader in the States. At the time, when the Chicago pits and the US bond markets were massive. And this guy was a big name in the market. I was just a junior at the time. And you would hear his name come through the markets. He was buying, he was selling. That would come down the squawk boxes. And, when he got in there, you sort of made sure you weren't in his way, or, if you were on the same side of the trade as him, a little smile came over your face. But he was interviewed in Market Wizards, and he was saying that he would go down to trading one lot, which is a sort of size that, even if you were a junior and you on the floor, you wouldn't trade because it would feel a little bit like you're a nobody. But he would say he would just get down to that level, sometimes for 1, 2, even 3 or 4 weeks, just to get back into the rhythm, just to the point where he was more in control of himself, and his emotions weren't in control of himself. So I shared that with the guy that I was coaching this morning. He has to remember he's good. He has to remember losing is part of winning. He has to accept that these periods should not allow him to cause himself doubt. And I'm going to share a conversation I had yesterday with someone that I coached, a young trader at a bank, a guy who's been flagged up as someone with high potential. So rather nicely, they've asked me to. They do this to bank. The traders that they think are worth investing in, they send to me for coaching. So I started with him yesterday, and the thing that quickly jumped out at me was, which jumps out at me with a lot of people, especially early in their career, was this coping and managing in uncertainty, and how that changes our behaviours. Just quickly scrolling through this slide, the best loser is a long-term winner, which is going back to that story of the poker player just a few minutes ago. That was kind of a mantra he had. He was good at losing. Now that best loser in the long-term winner is a mantra which a lot of very good traders hold, a lot of very successful traders hold. It's losing well. Almost, there's a quote up there, losing is beautiful. in my own trading, when I kind of embrace that losing is part of winning and learn to love your losses, it's really about embracing the whole idea that losing is part of the journey. Actually managing your losses is probably more important. Bringing them in, factoring them in so that when they happen, they're not a shock to you. And this was something that I was sharing with the young individual that I was coaching yesterday. Who's going to be a very bright and very successful FX trader over many years, in my opinion. He's already started very strongly. I introduced him to a model which I shared last time, and a few people emailed me after my talk with Simon to say, could I send them the slide about this? And it's about systems theory. I don't know if not many people are familiar with systems theory. Some of you listening today may be familiar with systems theory. It's something which I came across a number of years ago. It's people are much more familiar with it as an academic field of study. But it's something which I thought, there's something within that idea of system theory that's really profound when it comes to understanding risk and understanding trading. And it's that as traders, when we come to trading, and we come from our, we come from our education system where we've been through school, we've been through university, we've been taught, in a sense, winning is everything, getting rewarded for winning is everything, being right is anything, and being less than right or less than perfect is somehow flawed, and that we don't want to be that. And then you come to trading and you suddenly find yourself, geez, I'm losing money. What is wrong with me? And a lot of people get very challenged by that. And they get challenged by the fact that they're not perfect, or they get challenged by the fact that, they should have seen that coming, There's a few guys now sitting out there at the moment who have been waiting for dollar yen maybe to break through 100 over the past week, who are now sitting there going, what's wrong with me? How didn't I see this big bounce developing? It's just the nature of randomness. It's the nature of the financial markets. It's going to cause us to question ourselves. It's going to challenge our emotions. This is the point here. If we look at this model in front of you, which is developed from system theory, the right-hand side is, and perhaps, if you can imagine putting your hand over the left-hand side and just looking at the right-hand side and considering the idea of a complicated system. This is what we've spent our entire life, our entire educational experience, and even the years after that, subscribing to. The idea that there are definitive answers which are obtainable and provable. This is the idea of science and technology. That is what a complicated system is. We think there's a defined answer. So if you use maths, if you use science, if you use technology, if you're an engineer, there usually is a defined answer. There's an equation which will give you a solution. You can work out the effect of gravity on a rocket pulling away from the Earth. It's not easy. It requires expertise. It requires a lot of intellectual intelligence. But you could find that out. There is a real answer. And the approach to finding solutions within this complicated system is sensing, analysing, and responding. So it usually means, if you think about it, the problem can be fixed, can be frozen in time, and worked out in advance. But this is the struggle. This is where people struggle, because financial markets are a complex system. They are on the other side of that, and we don't really learn to. We've never really learned through our education system to manage, or how to manage, in a complex system. And the people who I meet who are most successful, they've actually made that journey. They've actually learned how to manage in a complex system. Now, a complex system are where definitive answers are extremely difficult to find. You cannot find a difficult answer, only with hindsight. As I'm sitting here today, only with hindsight is it clear that somewhere down at 100 last week, that dollar yen was bottoming. We couldn't have possibly known that. I can't possibly tell you where dollar yen's going to be tomorrow afternoon. There is no way. There are so many different variables that will decide that answer. You know, I can predict it. I can predict it with a degree of certainty. You know, if it breaks 104, I suppose there's going to be a lot of stops. But we don't know, is that going to be stops? I'm going to take it to 104.20, 30, and then it's going to come down. There are just, we just cannot possibly know. There are thousands, maybe even millions of people all deciding what dollar yen's going to do. It's a domain of humans, a domain of people factors, a domain of emotions. Those traders making those decisions themselves will be driven by emotions. They themselves will be trying to predict what's going to happen to dollar yen. It's a derivative of a derivative. If you're familiar with Keynes's beauty contest theory, that's something he talked about back in the 30s. I'm not going to explain it right now. Look it up if you have the inclination. It is a fascinating theory. But so what we're doing about is success in the complex system requires emotional intelligence. It's not intellectual intelligence. Intellectual intelligence matters. I'm not going to pretend it doesn't, but it's skill, ability. That's performance. It requires interpersonal skills to a degree, because you're trying to understand what other people are going to do. You're not looking at it as a scientific fact. It has to do this, therefore it's going to do that. Yeah, a lot of people will be sitting there thinking the payroll number is going to come out with this, therefore the market's going to do this tomorrow. Therefore, as the number comes out, I'm going to buy it if it's this, I'm going to sell it if it's that. No, you're looking to see how people respond to that data. That's what matters. And quite often the response isn't always a response. Actually, it's very, very rarely the response that you think it's going to be. And the sharp guys will be responding to the response as much as they'll be responding to the data. So that's skill and ability. One of the traders I used to work with a few years ago, brilliant trader, he would sit there all morning. I'm not going to say he wasn't smart. He was very, very smart. But this was a guy who left school at 16. He didn't have any qualifications, and yet he'd made it to a very successful bank trader through the backdoor route. He had the most brilliant emotional intelligence, the most brilliant ability to think about what other people are thinking about. And he would sit there all morning going, if the payroll number comes out here, this group of people are going to be thinking this group of people will be thinking this, they'll respond to this, and if they respond to that in that way, this group who are already short will then jump on and start buying their positions back. It'll get to a resistance level where the guys who are really long will start selling. And you could see him trade around all that thinking all afternoon. He was thinking, what are the other people's emotions? It was the most brilliant way of thinking. I was sitting there in awe of this guy because I was mostly a technical trader. He was a trader just almost living Keynes's beauty contest through his mind. And like I say, he was a very successful trader, continues to be a very successful trader. You know, I stopped working, I worked with him, I think, up till 2004. It is that approach. Doesn't always work because, like we say, you cannot be 100% right all the time. You know, if you're right, for some people, they have a very successful track record if they're right 20% of the time. As long as their total rewards aggregate more than their risks and they have an approach for managing the downside of their risk. Now, in that complex system, the approach is to probe, sense, respond. So when I'm talking about what this guy was doing, he was probing, he was analysing the markets, he was analysing the data, he was working out what different people were thinking, what they were doing. For me, I would probe by looking at the technicals. I would obviously consider the fundamentals as well, the momentum, all these different things. But that is probing. You're playing around with everything. You're trying to make sense of everything, which is the next thing. You're sensing. You're trying to make sense of all that data. You cannot really analyse and come up with a sum like you can on the other side. So you're sensing it. You're feeling with it. And you hear there's a lot of good traders feel the market. And then you're responding. And actually it's a loop because you respond and then you've got to go back to the beginning and start carrying on probing again and perhaps recalibrating what you're doing. Now, I'm not saying everything works like that. A system, a complicated system, would suit a systematic approach, and some people like a systematic approach. For more discretionary traders, fundamental traders as well, and even those people that I know who are systematic will hand on heart tell me that they're probing their system all the time to see if they can improve it, to make more sense of it. So they are using the complexity side of it to improve their system. They're crossing that line between the two. I'm conscious that I've talked a lot about this subject. I probably talked more than I was going to do. I'm going to, if Simon's got any questions, if anyone's got any questions, please write it down on the right-hand side. I'm happy to answer any questions that you may have in this final 10 minutes. There's a final takeaway here, and it's a quote by Curtis Faith, who was, who, if you're familiar with the turtles experiment of the 1980s, he was the most successful of the so-called turtles. And he wrote a book, and one of the quotes in it was, "Human emotion is both the source of opportunity in trading and the greatest challenge. Mastering you will succeed." And I cannot say that there is nothing as true as that. You know, do not close off your emotions. Do not try and shut them down. Understand about them, learn about them, be conscious of them, put them within a context. Bring your risk management. Your risk management is part of how you manage your emotions. Understand how you're sizing and the effect it's going to have on your emotions. Try and think ahead. But I'm going to ask Simon, do you have any questions?
Yes, well, excuse me. Yeah, a few questions just been waiting. Thank you, Stephen. What books would you recommend to read regarding the psychology of trading from Jack?
There's some great books out there. I really don't know where to start. Definitely read the Market Wizards books. You know, they are brilliant. Different people, different personalities will tell me different things. The Mark Douglas books I recommend for any trader. Not everyone likes them, but most people are really, you know, they really find them useful. There's different things. You can understand the concepts. For me, I've always found reading things like the Malcolm Gladwell books, which are beautifully written, and they enable you to think. So it's useful to have trading books like the Market Wizards. Brett Steenbarger's written some great books over the years, and he's just come out with a new book actually about psychology of trading. A very smart guy. There's lots of great resources about it. I actually encourage people to learn more about themselves, though, than about the psychology of trading. I think that's what's more important. I think understanding your own psychology. You know, when I work with people, when I coach, the real power of it is getting them to understand themselves and getting them to think of themselves in the context of what they're doing, in the context of the background, the bigger picture, and in the context of the foreground, what they're doing in the smaller picture, in their trading strategically. So there's the usual books. There's the market books, such as Market Wizards, the Mark Douglas series, Gerald Ashley. You know, there's Brett Steenbarger. There's some great, you know, Elder, Van Tharp. They're all good books. I'm not going to knock any of them, and I recommend everyone to read them. But explore outside those books as well. Read books that inspire you, that allow you to know yourself. Like I say, I've always been a fan of the Malcolm Gladwell books. Books like, you know, Nassim Taleb, The Black Swan, Fought by Randomness. They're great books because they take you into another sphere. Read the Daniel Kahneman, obviously, Thinking Fast and Slow. Work your way through that, because he allows you to think about how you do your trading in a different way. And there's books which have nothing to do with trading at all. There's a great book called Mindset by Carol Dweck. Nothing to do with trading at all. It's actually more to do with education. But you can start to think about your own mindset and how you apply that to trading. And everyone may have their own books. You know, there's another one which a lot of traders a few years ago were telling me they were reading, which was It's Not a Game of Perfect, which is actually about golf, funnily enough. At the moment, there's, I mentioned Michael Mabussan, or Martin Mabussan, I can't remember exactly the name, but The Success Equation. It's a brilliant book. Black Box Thinking. It's a good book. It's a book that's out there now. I can't quite remember who wrote that. And there's another one. There's the Atul Gawande, the checklist theory, the checklist manifesto. I've downloaded it, but I haven't read it yet. Again, another fantastic book. Different people will find different things. And of course, if you're looking to improve some of your own skills, there's books about technical analysis. You know, I'd always recommend reading those. And then read autobiographical books, you know, books of successful traders. See what tick their boxes, and you learn a lot about yourself.
Just going back towards the beginning of your talk, you mentioned Alex.
Good old Alex.
The big swinging dick who went from the bank to the hedge fund.
Yeah.
What was his trading style, would you say? Asks Stuart.
He was more around relative value, finding value, looking at spread trades, so running trades along the curve, finding, looking at different currencies, so taking the dollar out of it, and maybe looking at maybe a block of currencies, South America against Eastern Europe. He had a very wide field, so he could be trading oil against gas, commodities against, and he was what he tried to do was, and I think I spoke about this on a previous thing. His particular personality was someone who liked to remove the emotion from his trading a little bit, so he could hold big risks. He would remove the noise out of it. So rather than taking a view on maybe US dollar 10-year or 2-year, he liked to have the curve trade, 2-year, 10-year. So he would look for that to flatten or steepen. And usually there's a lot less volatility in that, a lot less noise. So you do it in a lot more size. So, you know, you might consider it as spread trading. He'd use option strategies quite a lot as well.
Thank you, Stephen. Jeff's asking about books as well. So, Jeff, we've covered that question off. No more questions, particularly on this. Apart from to ask, do you actually do a course? No, this is something that we were working on, or certainly have it on the agenda.
We've got it out there, haven't we? So we are in the point of looking at that. So I do a lot of one-to-one coaching with individuals. I'm not going to beat about the bush. It is expensive. It's for. It's not to say that I don't do some traders who trade smaller size. I do, and it's made a big difference to them. But for a lot of private traders who tend to have smaller amounts to play with, it can be quite a costly sum at a certain stage of their career when they're trying to keep their capital and trying to live off their capital. So what I was talking about, Simon, was about doing some sort of group. It's something I've started doing recently, group coaching. So having learning groups. So it's not quite got the personal touch about it, but you still get an element of it. You start with, what the theme is to have maybe a one-to-one debrief first, to do a personality assessment using some of the risk tools I use that we've kind of pioneered over time. And then perhaps having a shared learning group, ideally face-to-face in a centre, and having a series of them, because the idea of coaching is that you do it over time, because then you get a chance to absorb behaviours, because behavioural change doesn't happen overnight. You know, your brain, I don't know if you're familiar with the theory of plasticity, but it takes time to adapt and to reshape and to develop new habits. They only happen over time. So a coaching program happens over a long period. So what me and Simon are talking about is trying to do some sort of group coaching. And actually shared learning can be really powerful, where different people bring their experiences and different people talk about those experiences, and then people around them will go, aha, that's me, I do the same. And so it can be very powerful. So hold that thought for now. I think you're right, Simon, and we're gonna come back to that. So I think it's one of those, watch this space.
It's a great format. Sometimes these online courses are just great, because the webinar is not enough. The webinar is often not just long enough to sort of let you know who you are, what you do, and we can't really get into all sorts of things. And to do live, courses all the time is impossible from a logistical point of view. So I think this is the answer. This is the way forward. So we'll work together on trying to get this done. As usual, the list of things to do is growing all the time. Okay. Here, another comment from Stuart. Rather simplistic opinion of mine, but isn't trading psychology largely tied to position size and risk that one can tolerate? If I was trading nano lots, I would lose a night's sleep. I wouldn't lose a night. Wouldn't.
It is one factor. It is one factor, and I say trading psychology is a little bit of a misnomer in terms of that. Trading behaviour, think about it themselves. It affects your analysis as well, how you analyse the markets. When you buy into a position, when you buy into an idea, you can start losing sight of reality in a sense, and then you start denying what's going on in front of you. You start actually denying the chart patterns which are coming up there. You start looking for corroborating articles. So it's not just about there's so many different aspects to it, and talking about these and sharing these, there's if ever you read the behavioural finance literature, and I would suggest reading Kahneman or Ariely or any of the books on behavioural finance, and understand that there are a million ways in which we trip ourselves up when trading. Position sizing is one of them. I talk about position sizing, I talk about risk management, money management. It's so often in my courses because it's inextricably linked. It's all part of an overall connective thing. So trading psychology is, you're not wrong with that. It is a big part of that, but it comes in so many ways. Yeah, and I even work there. The trading psychology affects, when you're sitting in a room and the guy next to you is making a load of money and you're not, and you start thinking, oh, I've got to take a bigger risk, right? And you start forcing yourself to do something which you shouldn't do. So it's about discipline sometimes. It's about, like we say, getting nervous and cutting the winning trade out. There are so many different angles of it. The interrelational aspect, like I say, when you work in a large trading room and you're working with other people, those really important. Sometimes working in a large trading room is brilliant because you can see someone who's actually in pain, and you get to know when that guy in pain, the market's never going to turn around. So you might add on a little bit more. There is that is trading psychology. It's always trading behaviour. We call it where we are. It's reading the field. There's so many different aspects to trading. Even technical analysis. That is group psychology. That's sort of, you are trying to read pictorially what the emotions of the market are, what what a large group of people are telling you is happening out there. So. Great question, by the way, not simplistic at all. Thank you very much.
Okay, thank you to Stuart for that question. Maybe one final question, because we're on 5 o'clock. Paul's asking, how can you overcome the fear of giving back your gains?
Again, I wish there was a simple answer to that. There isn't. It's a big part of having, first of all, having a strategy, developing a strategy around your trading, trying to contextualize your trading, trying to think, once you start, embracing the idea that you are going to give back your gains at times, but there are also going to be times where your gains are going to go a lot further. If you can have a plan, if you can have a structure, just yesterday I was talking about this with an individual, the idea of using trailing stops, of scaling into trades, of putting on conviction levels to trades and adjusting those conviction levels, and actually recording those conviction levels and looking at when they were right and when they were wrong. And there are so many different things, and I don't know how long you've been trading, so I don't know the context you're asking me that. But as you develop your trading experience, you do start to learn when to run trades a little bit longer. At some point you'll go, aha, you'll have that aha moment, and you'll just know that's the right trade to stay with. It's a skill you develop, a little bit like anything else you do. The more and more years you do it, the more and more years you go through the process of deliberate practice, which means stretching yourself finding what you're doing right, pushing yourself out your comfort zone, coming back in, analysing what you're doing. So not just going through the learning process per se, but actually learning about yourself as you're doing it. It's, you know, I'm not going to beat about a bush here. Trading is the most fantastic job. I love it. I loved it for 25 years. It's a constant, every single day you're challenging yourself, you're challenging yourself intellectually, you're challenging yourself emotionally, but you have to develop processes and strategies and methods ultimately which are much more process orientated. You know, if you let your love of trading sometimes get in the way too much, it can be sometimes a cause of failure. So I can't put too much into that, but kind of, you know, you do learn, and the great traders that I've worked with over time, they all started with those same questions early in their career, those same challenges, those same struggles, and some of them, believe it or not, still struggle with them, even though they make an awful lot of money, that they never go away. You just learn how to manage a little bit better.
Step away, paper trade, and then try again, says Stuart. Wise words.
Yes, yes.
What about paper trading, though? Because I've heard also lots of people, I mean, it's a valid point, of course, but I've also heard people say paper trading can sometimes give you a slightly false reading, because you tend to be a little bit more, maybe not reckless, but braver, perhaps, when you know there's not real money on the line.
Personally, I believe the only time to really paper trade is literally day 1 to day 10, maybe, of your trading career, when you're sitting around and you're getting used to the market, you're getting a feel for it, you're just practicing. It's a little bit like learning to tightrope by putting the bar 6 inches off the floor. You can't really hurt yourself, but you're learning the techniques, you're learning how to put one foot in front of the other. So you use it for that purpose. But then when you really start doing it, you have to start feeling the emotions, and you only do that by raising the bar to a level where it's a little bit dangerous, and you constantly raise that bar. But as we say, as you start to, when I use that analysis before of stopping trading, I don't really think of paper trading in those terms, but I do think when you stop trading, when you get back in on a small amount, or just reduce it to a small amount, a bit like lowering the bar very close to the floor, so you can just get used to doing the technique and feeling it right, and then you start to raise the bar again. And that's what the great traders do. I can tell you that. They all do it, because they all screw up, they all mess up, they all hit patches. Like I said at the beginning, they all hit these, you know, one of the beauties of what I do is I get to get the insights, the inner, and I share these with other people in my coaching sessions. I get the insights of so many different trades, and the one thing you learn is they all have the same insecurities that you yourself have. You're not unique. The great traders have it as well. You know, they just have learnt to park them a little bit, or to manage them, or, you know, but they still get them. They still get them, and it's learning to work with that. So I would say the beauty of that is that I meet so many people, and some of them are incredible guys, but they still have the same faults and the same flaws that we all have.
Okay, Wayne rather honestly says that, yes, when I paper trade, I always have a profit on paper, but when I trade with real money, I make a loss. So there we go.
So you're no different to Alex.
You're no different. Wasn't Stephen Goldstein, alpharcube.com. Thank you again for joining us, and I'm glad you were able to make it to the event. And again, I know that you're going to be coming along to our Round the Clock Trader Live event at the Grand Connaught Rooms on the 5th of November to give a talk as well, which will be great.
Yeah, I'm looking forward to it. There will be some fireworks that day.
Well, I promised fireworks, and I'm going to have some sort of fireworks. Hopefully it won't be the fundamental analysts arguing with the technical analysts. That could lead to fireworks. But you're in at 11 o'clock in the DAX Theatre on that Saturday morning. So
I look forward to it very much. Thank you for today. So I love doing these things. So I love talking and sharing my thoughts with people, and hopefully giving them some sort of insight into a broader world. And, you know, I love helping traders. I think, you know, they're all risk takers in their own way, or They're all trying to become risk takers. It's a great job if you can make a career out of it. Do the homework, do the hard graft, put yourself, expend your energy in learning about yourself and learning, beyond how to read a chart or how to use a system. Move yourself out into that space about learning how you can improve yourself as a trader. So great doing this, Simon, and I look forward to seeing you.
Okay. Thank you very much.
Take care.
Keep in touch.
Thanks a lot.
Bye-bye.
Bye.
Okay, well, that takes us to the end of the presentations for today. We are almost towards the end of our London Investment Week live. Just 2 presentations tomorrow. 12 o'clock, we've got the live trading non-farm payroll preview with Steve Ruffley at 12 o'clock. And then Zach Meir, who back already, he writes for Master Investor. He's a very well-known technical analyst himself, and he also presents on Tip TV, the daily trading channel. So very well-known investor and trader. He'll be here at 2 o'clock to provide a view on the markets, the week that was and the week that's coming, and of course any particular stocks that you have. That's the time to volunteer the company names, and he'll be interviewing, analysing them live on the show. So thank you very much again, everybody, for joining us, and we'll look forward to speaking to you tomorrow at midday.